Hello and welcome to the mentorship. Firstly, I'd like to say a huge thank you to everybody who is here. I'm extremely honoured and humbled to be part of the journey with you guys. Because I want to keep the actual mentorship as short and concise as possible, I want to use this introduction as an opportunity for us to get onto the same page to really understand what the mentorship is about, what to expect from the mentorship. I get swamped with questions on a daily basis, and you're going to have many questions throughout the course of the mentorship. Write the questions down and try to stick with it, because everybody's going to be at different stages throughout their journey. My job here is to really cut down your learning curve, and going through many years of learning ICT concepts, the experience and knowledge that I gained, I can now share that. And being a student of ICT, it puts me in a little bit more of a different position because I'm learning a concept that I can now teach you guys. You see, Michael's the author of it, and these are his concepts, it's something that he's created, and it's 30 years worth of experience that he's basically putting out there, and it's a lot of really dense material, and it can become very overwhelming. When I first started with ICT, not many people had even known about it back then, and there wasn't much information apart from actually learning on his courses or some of the YouTube material that I had out. The disadvantage was I had to learn it the hard way, but then the advantage was looking around social media now, there's so much false information out there. I get dozens of questions all the time about trying to clarify what somebody else has said regarding ICT concepts, and it just confuses a lot of people. One of the main reasons of creating this mentorship and this academy is to really lead the toxic environment of social media and create an environment where we all respect one another, and we're all learning, we're all on the same journey, and I just want to do my best to really help and educate as best as I can. ICT has 30 years of experience with these concepts, and he is the author of the concepts. I am in no way, shape, or form claiming to create these concepts. These concepts are not my own. They are the concepts of my mentor, ICT. I'm just super passionate about training, super passionate about learning. I study every single day still. To really get an understanding about what to expect in this mentorship and where you should be focusing on, the best way to really do that is to speak about my own experiences, where I started, the sticking points, the pitfalls, the pros, the cons, the adversities, almost giving up countless times. It's not been an easy path to get to where I am. I was a break-even trader for quite a while, and again, I learned so much whilst being a break-even trader. I learned what worked for me and what didn't. Of course, it's not going to be the same for everybody, but I can really shorten your learning curve about pointing you in the right direction, about this is where you want to spend your time. And I spent months and months looking at the wrong things or delving into the wrong things, and I'd end up with a lot of dead ends and more questions that weren't answered. And what you want to do is just really try to focus on some of the things I'm going to be teaching in the mentorship. I want to make it as concise as possible, hence why I'm using this introduction to really get a good foundation. I promise it's not going to be like this in the actual mentorship. One of the issues that I had learning under ICT is it would be 30 minutes of a rant or digressing, 5-10 minutes of really good material, and then another 20 minutes of digression. And I ended up losing my focus. I lost the purpose of what that lecture was about. So I don't want to repeat those mistakes in my mentorship. So I'm going to be a little bit more formal in the way I approach it and a little bit more to the point with it. So I'm going to give myself a little bit of introduction because you guys learn from me, I guess. With all the questions I get about people asking me about my own personal journey, this is probably the best place for me to really delve into that. I started 2017 is when I was introduced to trading. I purchased a course for around £100 on Trendlines, believe it or not. And I quickly found that this doesn't work. You know, support and resistance ideas, or why hasn't that level held the resistance, or that level held the support. And from there I ended up another dozen courses on Ichimoku, Elliott waves, all kinds of things that you can think of, EMAs, indicators, and charts were absolutely covered indicators. And I quickly realised that there has to be something more to it. In the books they teach you, you place your stop here, and that's not what always get hit. And that was a light bulb moment for me straight off the bat, because I realised, well, if the books are teaching you to place your stop losses here, then everybody's going to have the stop losses here. And that was like my first sort of insight into discovering that the markets must be manipulated somehow. Got a long story short, after around 6 months, I think it was maybe early 2018, ended up out with some uni friends and seen for a number of years. And as you do, which makes you complaining about wife and kids and life and whatnot, and trading got into it. And I'm speaking to one of my friends, telling him about I think that the markets are controlled, manipulated. He had done a bit of trading himself, and I said that there's something isn't right. None of these indicators work. I spent thousands of pounds on courses, and nothing's working for me. And as fate would have it, he started talking about a guy called ICT, Michael Wilson, and he had recently joined his mentorship program. And what he actually said to me was, he's kind of crazy, but his stuff seems to be quite good. He talks about how the markets are manipulated. And as fate would have it, my friend at the time was going back to uni. He started off in the states business and wanted to become a prescriber, and decided that it was time for him to go back to uni. And long story short, he asked me if do you want to use my login details for his mentorship. Now, sorry Michael, if you are listening, I didn't make up for it by eventually purchasing the mentorship myself. But of course, somebody's going to give you a free pass to Michael's mentorship. You're going to take it. The issue that I had with doing that is I got thrown straight into the deep end. Like I was going through his mentorship material and his core content, and I was absolutely lost. The advantage I had with being able to have the access to the mentorship was that his commentary teachings on a weekly basis, where he was analysing the markets, that's where my learning really excelled. 2018 is when I started learning ICT concepts, and in that time, I've learned a huge amount, and I learned that it's an extremely big puzzle. In order for you to ask the right questions, you have to answer the question that you currently have, and once you answer it, it will leave you with another 2 or 3 questions. And when you answer them, it will leave you with another 2 or 3 questions, and that's the rabbit hole, and it gets deeper and deeper. And with each question that you answer, your understanding deepens, and those barriers start falling down. But it's very incremental. It takes a long time, especially if you're not looking in the right places. And this is what my job is in this mentorship, is really to focus your attention in the right places. And I really want to use the mentorship to build on narrative building skills, on how to determine bias, of points of liquidity, points of interest, where the market is likely to move, as well as amplifying some of the teachings on the academy lectures. Those academy videos, they were a combination of hundreds and hundreds of hours of work. You see, ICT never made a concept and just put everything out in one place. It was big, it was all over the place. And I went through absolutely everything from his YouTube, mentorship, chartship, Telegram, Twitter, everything that he has his SoundCloud. Some of the old podcasts he's got in his SoundCloud. I've been through everything. He puts things everywhere. You can talk about an order block and it will be over dozens of different videos, and it's your job to piece it all together. And I remember when the commentaries ICT said that he's done this on purpose. He's purposely spread everything out because he wants you to work with it. So what I decided to do was just to really take all the important parts of each concept and compact them into a short little video where it had all the major points I needed to understand the concept. Now, as I said, I know ICT, and these are 100% his material, it's his concepts. I'm just a student who's extremely fascinated with how the algorithms work. I'm extremely passionate about trading, and extremely passionate about teaching. Your success here is my success, and I'm extremely grateful for you all to trust me enough to want to teach you. I want to make it perfectly clear that this is going to require work on your part. I am not promising you profitability. I think it'd be immature of any mentor to really promise that you're going to make money in these markets. It's going to be down to you as an individual. The best I can do is point you in the right direction, do my best to cut down your learning curve, and after that it's all on you. Every one of us is going to be unique in our own personalities, and we're going to view the market differently. And this is one of the beautiful things about trading, there's some sort of artistry to it, because it's all personal for each and every one of us. And I'm hoping that many of you will surpass me one day. You know, I love that. This is not an ego thing whatsoever. I get a buzz, a genuine buzz out of when you guys do well. You have to detach yourself, especially in the beginning. You have to detach yourself from making money. The money will come inevitably as a byproduct of your hard work. The more effort and energy you put into this, the more effort you put into backtesting and journaling, which every single one of you should be doing, is backtest journal everything, journal your good trades, your bad trades, and that will build the foundations of you understanding where the good trades are going to happen, where the bad trades are going to happen, and that's your foundations, and from there you build it. How I'm going to basically take it going forward is I want to analyze the previous week's price action, and then forecast the next week's price action, what could potentially happen. The best way to teach mentorship is in hindsight, unfortunately, the only way you can really do it. Obviously with forecasting future analysis, but in order to forecast future analysis, you have to understand what price is already done. So when you work that out, and that was a huge sticking point for me, was understanding that in order to work out what price is going to do, you have to work out what price is already done. Where does price come from? Where is it likely to go? Where's our points of interest in the higher time frames? Obviously going through the academy, you should understand by now what our model looks like. So I won't really be teaching any of the stuff that's already in the academy. That's taking me a long time to do. So I need to get back in sync with the markets when we start mentorship. I'm really looking much at charts during the course of all of August. August is quite a time anyway for trading, and what you're going to find is there's certain times of the year, seasonal influences, what the market relationships are doing, what the bonds are doing. There's a huge picture that you end up painting, and that's how you end up with your actual bias. Now, bias is a hard thing to come to. Realistically, we have 3 different things that we need to learn. Is what's the market going to do? Is it going to go up? Is it going to go down? Or is it going to consolidate? Think like an algorithm. Understanding that the markets work based on an algorithm and trying to think like an algorithm was a very huge milestone in my development as a trader. You see, my background is I've been a qualified pharmacist for the last decade. When the penny dropped for me was in the middle of COVID once. I was writing prescription for a patient, and you have to go through these cascade of different questions, and the yes or the no's are the true or the false statements. Based on each of those questions, you're going to arrive at this conclusion. From there, you're going to be thinking that why don't I look at prices the same way? And if you start thinking of the market in a series of if-then functions, that if this happens, then this will happen, or if this happens, then this will happen, and that was huge for me because it allowed me to look at market structure, allowed me to look at price, and many times like I can be wrong in my direction, still make profit out of it because I'm understanding. Like say for example, I'm a very short-term trader, I'm a very short-term scalper, and in the mentorship I'm going to try to establish and predict what the weekly range is likely to do, and all we're looking for is that expansion move from that weekly range. If we get in sync with the expansion move, we can go into the lower time frames and we can hunt for entries ourselves. Sometimes we can be wrong on that weekly move, but when we're at a lower time frame, frames, we can capitalize on understanding if the market's going to do this, or if the market does this, and this is the likely outcome. So we can get back in sync on the lower time frames. You'll find that the whole trading experience, you have to operate in a grey area. There is nothing that's certain in trading, and we're never going to 100% understand what the algorithm is because it's extremely complicated. So what we do is we wait and you learn patience, and that's one of the most important things, because realistically, when you've made your internal algorithm of what your model looks like and what price is likely to do, there's only three real things that you're going to do. You're going to buy, you're going to sell, or you're going to wait. And that waiting, you're going to do more than the buying and selling. So it's extremely important to know what you're looking for. You have to understand why am I waiting, what am I waiting for, and in order to do that, you have to understand and ask yourself questions: where does price come from? Where is it likely to go? What's the economic news drivers are about? What day of the week are we? What time of the day are we? Do you understand? So that's what you backtest. That's what you journal. That's where you focus your attention. You need to go back through your charts and say, okay, well, when was the highs and the lows made? What days of the week? What times of the day? There's many different things that you're going to start piecing together, and your journal is where all of this information is where you want to document it, and you want to be as detailed as you can. I'm going to be dropping one video a week initially on a Monday evening, and that will give me at least Monday's trading behind to give me some indication of where markets are likely to go for the remainder of the week. Sometimes I'll be right, sometimes I'll be wrong, and I have absolutely no problem with being wrong. We're waiting for our sales to perform, and if I'm wrong, the market's going to show me that I'm wrong. And if I don't see myself because I'm wrong, then I don't take a trade. So one of the problems I had earlier on is fear of being wrong, and at one point I was so crippled by it that I couldn't get myself into a trade, and most of those trades ended up being winners. But I just couldn't force myself to enter a trade because I just didn't want to be wrong. This is why we have stop losses and risk management. We're going to be wrong. Every single one of us, myself, even ICT himself, gets it wrong quite often. You know, there's times where I've had it right and ICT has it wrong. And he's obviously better than I am. We're going to have it wrong all of us at some point. So we have to make peace with that. We're going to be wrong. We operate in a grey area. We operate in market probabilities, and our job is to find out when that market is in its highest probability to go into the direction that we have basically arrived at the conclusion of our overall bias. Is it going to go up? Is it going to go down? Or is it going to consolidate? The algorithm is very limited to the things that it can do. It's going to go into a consolidation phase, an expansion phase, a retracement, or a reversal. And it's our job, once we understand all of that, where are we in that cycle? And the truth is, psychology plays a massive role. I can't really teach you psychology. You know, you have to figure that one out. You have to know yourself as a person, as an individual, and what trading will teach you, especially something over these 4 or 5 years I've learned, is a huge amount about myself. Things that I didn't even realize about my own personality, and how that's actually affected me in my personal life, in my relationships, in how I handle situations. And trading is going to change you. It's going to change you as a person. There's some things you're going to find that you don't like about yourself. You know, some things that you didn't realize that this is how I am. You have to get comfortable with that because you have to know yourself. Are you greedier than you think you are? You know, are you impatient? Are you going to get angry and revenge? I did that a lot. I did that a lot, and I learned from it. And this is the point: is that you have to learn from mistakes. You're going to make mistakes. You're going to lose money. You're going to. It's inevitable. The idea is to learn from that, journal it, log it, and go again. And eventually you'll get it. Eventually, if you take the timing element out of this, how long it's going to take you to do it, you'll eventually get it. If you're going to force it and say, I need to do this and learn it all within the next 3 months, within the next 6 months, you're putting a huge amount of pressure on you for something that actually can't really be predicted because it's different for everybody. So my best advice here while you're in this mentorship is just relax. Just let the content deliver itself. Backtest journal. There'll be a lot of drills. There'll be a lot of me training your eyes of where you want to look at. And you're going to hopefully do something every day. Just a small amount, half an hour, an hour. Take that little bit of time out of your day and just go and review the charts. Go back through the previous day's charts. Pick one pair, and I think this is how everybody should do it. Is pick one pair that you like to trade. My 2 favorite pairs are Euro and the S&P. So they're the 2 that I'm going to focus on in this mentorship. So you've got the index and the FX market. I'll throw some Bitcoin and some crypto in there as well. Although from my experience, they don't move as predictably as the FX bonds and the index market. Outside of ICT's mentorship, this is the best place for you to be. Just allow yourself time. There are some fantastic people in this group already. We've made a really, really good close community in there, and they will become absolute monsters in trading. It's just going to take a little bit of time. And now I'm super excited to start this mentorship. I'm super grateful for you all to be here, and I really want to just deliver as best as I can. You know, I really, really want to help you guys succeed in this. Times are getting hard, and I realize why ICT has put so much stuff out for free on YouTube, because he's always been ahead of the game. He's predicted things years before things have happened, and what he knows, where he knows information, I'm not 100% sure, but I'm certain that times are about to get a lot harder. And this is why I want to really help cut down that learning curve. So at least there's another stream of income that can come into the household. Like there's many people on the mentorship that have like different levels of experience with ICT concepts, so absolutely brand new, and some have been doing it for a number of years. So you're all going to learn at different paces. Many of you are going to have live moments. You may have already had them through the academy, through ICT's YouTube, and you're going to have many more. And because you're all at different stages, you're not even going to sometimes realize it's a live moment until later on. Because in order for you to understand that it's a live moment, you have to answer 2 or 3 questions previous to the live moment. So it's a very crazy way of how it works. And I still learn things, and that's the beauty of journaling and backtesting on a daily basis. But it goes deep. The good thing is you don't need to go ridiculously deep in order to make money in the markets. I guess that's our goal here. So it's a little bit of a longer one. I'm sorry for boring you. I promise you it won't be like this in the actual mentorship, but I want to get it all out of the way right now. Just study, work hard, have confidence in yourself. Don't be negative about you not being able to get it. You will eventually get it, right? And yeah, good luck to myself. So let's give it a good shot. But thank you for taking the time to listen to this video this far. And I'll catch you guys in hopefully the mentorship videos. Alright folks, welcome to the first lecture of the mentorship. I'd like to say a huge thank you to everyone for being here. Firstly, I've had a lot of messages from students who are a little overwhelmed with the amount of content and afraid they're going to fall behind during the mentorship. I'm going to start slowly and build it as we go. So one of the advantages of being here from the beginning. Today I'm going to be focusing on the E-mini S&P, just looking at the previous week's price action. From my experience, the best way to learn ICT concepts is going through hindsight price action. It's going to be slightly different how ICT has done his mentorship. I really want to focus on talking about the weekly expansion and then breaking that down from the higher time frames to the lower time frames. And really, I just want to point your eyes in the right direction. You should also have a study journal. You should keep that with you while you're going through the mentorship. There's going to be tons and tons of things that are going to come at you that you're not going to 100% fully understand, especially if you're new. But come back to them at a later date, write down as many questions as you can. And this is a journey. This is a learning process. And you will build on it in incremental stages. I've explained most of the things in the introduction, so I'm just going to keep it very brief. So without further ado, let's get into it. So we have the E-mini S&P, where this is the weekly time frame. Now, this is the week prior to last week. Now, one of the questions I get asked the most is how do you journal, how do you backtest? Essentially, this is what I'm going to be doing with you, is we're going to be reading the tape, and this is one of the most crucial skills you can learn in trading, because reading the tape allows you to understand how you can break down narrative. So the only way you can really take the best experience is going through previous data and previous charts, and really watching somebody who has a little bit of experience with ICT concepts, where I can show you how I'm breaking things down and what I'm looking for. Some of you are already in ICT's private mentorship, and if you're looking to be in that, you'll know one of the things Michael says all the time is that when you're backtesting and journaling, you have to backtest and journal as if you were in the trade and you was on the right side of the trade. This has been huge for my psychological development. You want to approach your backtesting, and this is essentially what I want to do during this mentorship, is we're going to be reading the tape as if we were in that trade, obviously from a hindsight perspective, but this is the best way for us to break it down and train your eyes. Eventually, things will start jumping out from the charts, and you'll be able to get a clearer picture. It's going to take time, it's going to be different for all of you, but my job here is to really cut down this learning curve and really apply the theory that you've learned to real life charts. Anyway, that's it. I'm going to keep it short and sweet. So this is the previous week's price action, previous to the week that's just gone. So what I'm going to do is to read the table, we want to see where does price come from and where does price likely to go next. So we can see straight away that we've had this expansion all the way up into this weekly fair value gap. So from this candle's low to this candle's high, we had these relative equal highs, and we've swept that into the fair value gap. We've seen price displacement and break below this last low close candle, which is the weekly order block. Yes, technically these 4 up close consecutive candles is one order block, but when you're looking at a time frame this high, I tend to use the highest low close. I'm going to find this on a small time frame anyway. We've taken sell side liquidity already down here, and we've already broken market structure above this high. So what we're really trying to do is predict what the expansion move is going to be for the coming week. Right? Again, like I said, this is hindsight chart, so we already know what's going to happen. I'll show you that in a second. But you want to see where price has gone and then work backwards. Now that's really the secret to how we backtest and how we journal is we already know through hindsight what price has already done, so we can unravel that and work backwards. So I just use a replay function I'm training you, which allows me to take out the candles, and we're currently at this price. Now let's talk you through like this isn't hindsight, and we're walking through what we can see in the charts. So we can see from this low to this high, we have this 50% area over here. Now, if we take an external liquidity and tap into a fair value gap, more often than not, price will be drawn back to equilibrium, which is that 50% level, right? So as a minimum, we are looking at the PD areas below 50% to see could price be drawn to one of these areas. So what do we have on the charts? Well, number one, we dipped into this weekly fair value gap from this candle's low to this candle's high. We have this buy side imbalance, sell side inefficiency, and we traded into it. We've come into the 50% level of that weekly fair value gap. So price is already at support level, but we're still in a premium market. Yes, sometimes it doesn't need to go below 50%. And if that's the case, you don't trade, you miss yourself. When you're first starting out, you want price to come minimum at least 50% or below. So you want to go from premium to discount and discount to premium. Since we've broken market structure, I'm looking at somewhere in this region. Can I see any PD areas that are lining up with sitting below 50%? Well, I can see there's this little gap over here. And this candle's low to this candle's high, we have another little fair value gap where we've just seen buy side delivery. Now, as this is a hindsight chart, we can see that we did in fact dip down into that fair value gap. Now, we went from taking external liquidity above these highs to internal raise liquidity, where we have this consolidation, the order block, and the fair value gap. Now, let's take this weekly candle, this previous week's price action, and let's go down to the lower time frame and start fleshing out the details. So this is the daily chart. We have these relatively equal highs, we have some buy side liquidity resting above that. And just above that is this fair value gap, which also coincides with the weekly fair value gap, and this is on the daily time frame. So we dipped into that, and then as you can see, we've broken lower. So this is last week's price action. The week before, on Friday, as you can see, we had a real big displacement, and into that consequent encroachment, that 50% of the weekly fair value gap. These three close candles is one bearish order block. As you can see, we traded below that. When we see price come up to a premium level, and then we see price break down below the bearish order block, this is a change in state of delivery. So from here to here, we've been in a buy program. And then as we've broken below these last three consecutive up close candles, we have a change in state of delivery. Now, these relatively equal lows, I should have on my chart, but this one's slightly lower than this one, so this classifies as a 3-bar swing pattern. We just dipped into that slightly. This is enough for a breaking market structure. Again, you can use the bodies of the candles. If you go below that, it can be again classed as a valid breaking market structure. If you're one of my CT students, we taught that even a dip below it is a valid breaking market structure. Now, price retraced, and it came into this volume balance and into that daily bearish order block. So from the open of this candle to the close of this candle, ignoring the wicks, there is no body in there. Now, since the majority of the volume is held in the body, the absence of a body is why ICT dubs this as a volume imbalance. It's very strong. It's stronger than fair value gap. So when you find a volume imbalance, more often than not, price wants to rebalance the volume imbalance. They can act as very strong support resistance levels in a lot of cases. And you'll see during last week's price action. So we open a new week with a gap down. This is algorithmic, and on smaller time frames I'll explain that in a little bit more detail. So I'll recalibrate that fair value gap to anchor it to the high of this candle. So from the high to the close of this up close candle, this is another daily fair value gap inside of the weekly fair value gap. We can see we gapped lower on Monday, creating this volume imbalance. And this volume imbalance also overlaps with this daily fair value gap. As you can see on Tuesday we trade higher and dipped into this fair value gap, taking out Monday's high. And this acts as a balanced price range. This volume imbalance coupled with this fair value gap acts as strong resistance. And as you can see, price rolled over and dipped into this is that weekly fair value gap on Thursday. So let's take this segment of price action, this previous week's price action, and let's go to the hourly chart. Right, so this is the hourly chart for the S&P. You want to delineate the opening times from New York midnight. So you want to break them down into separate days. So we have Friday, Thursday, Wednesday, Tuesday, Monday, and this is the Friday trading from the week before. So on Friday's trading, you can see that we had market just going up in steps, and this is pooling liquidity in the form of a retail trend line below these lows. And we dip into these last two up close candles. So we have a bearish order block on the 1 hour time frame, which also forms confluence with that daily volume imbalance and that daily bearish order block. So we have multiple arrays aligning in this area. As you can see, price tanks on that Friday. Now, this is important. Let's take this down to a little bit more detail, start building out some context and framework behind what happened. So as you can see, we had this really big range day on Friday. Now, after a big range day, typically you're going to see choppy price action or a consolidated market. Typically on Mondays, it's going to act like the accumulation in the accumulation distribution model, especially after a big move on Friday. You want to avoid Mondays, you're just going to get chopped about in this price action really. But we have the open price, so this is our weekly open price. Now, if we're looking for low prices and we want price to reach into this weekly fair value gap, then we're looking for price to go higher, to go lower, right? So ideally we want to buy above the open price for the weekly open. So New York midnight, that open price, you want to extend that in time. As you can see, on Monday we traded above it, on Tuesday we traded above it. But if we look closely, we have 1, 2, 3 drives into that daily fair value gap, which is inside the weekly fair value gap. And we also have that daily volume balance over there. So Tuesday ended up making a higher week, as we also came into this hourly fair value gap. So there's a number of arrays again that are lying for Tuesday. Now, 70% of the time you're going to see high and low form on Tuesday. And usually, if you see a high or low form on Tuesday, you're going to find the opposite end of the range form on Thursday. As you can see, at the high on Tuesday and the low on Thursday. So let's break this little segment down again. We have this retail trend line that's been forming from Monday. So from Friday's price action going up through to Monday. Retail stops are going to be built below these trend lines. We know that when we see these retail trend lines, there's going to be a pool of liquidity that's going to be resting below it. And if in a scenario where we're looking for low prices, anytime the market starts doing this in steps and moving upwards, we're anticipating one of those stops after price comes into a high time frame level, like this daily fair value gap, or this hourly fair value gap, right? As you can see, price rolled over and tap the sell side liquidity lower. So what else do we have here? We have these two down close candles. We have this swing high, this low, and then this high high, and then we break below it. These last two down close candles, if we extend that out, we can see price dips into it here, dips into it again, and dips into it again on Friday. Now we also have this fair value gap from this candle's low and this candle's high. As you can see, that's again offering resistance. But also if you look closely, this weekly fair value gap, the discount end, look how price is respecting that. When we traded through it like this, and we've seen displacement, this is an indication that price is now to go lower. So we've broken through that level, leading towards price action. So price will come to rebalance that. And this weekly fair value gap discount level is going to act as really strong resistance. When you factor in the narrative, the framework, and all the different arrays that are lining up in this area, you can see how price is sold off and traded down with our low of the week on Thursday. So I want to focus today on this area on Tuesday. So we'll go down to a 5-minute chart and see what we can flesh out. So this is Tuesday's price action. We have this line delineating midnight New York. So let's annotate this chart and see the underpinnings of what's really going on during Tuesday's price action. So as you can see, we have the previous day high, and we ran that. When did we quit? During London. So between 2 AM and 5 AM New York time, we can see that price had traded through the previous day's high. We then had a retracement and then moved higher, failing to take out the high made in London. When I'm trading the index market, I'm looking to trade after the news events. So the first one is 8:30. So the times I'm usually trading between 8:30 and 11. So I'll start hunting my model after 8:30. That doesn't necessarily mean that you have to do the same. I'm going to show you there are sales that can happen prior to it. So we have a breaking market structure. So from this high, low high, this is a breaking market structure. It is a valid breaking market structure, but because it's outside of the London kill zone, I'd rather use this one. This is the last stage of accumulation before we took out our previous day's high and before the market turned. So we can see we broke that with this candle over here. As soon as that happens, we're looking at how did we have a market structure break? Did we leave a fair value gap? And what are the PD areas can we find confluence to take an idea for a short entry? Of course, the sell side liquidity resting below these lows is an obvious target. So let's break this down to a little bit more detail and zoom in here. As you can see, from this candle's low to this candle's high, we have this fair value gap. So there was displacement seen as we broke market structure below this low. As you can see, we have this 3-bar swing, and this is important. So once that swing has been broken here, and we see this fair value gap displacement, we will now start building confluence to see what the arrays are around. I'm just going to give you a second to pause the video, and with the knowledge that we currently have, what the PD areas can you see that overlaps with this fair value gap. So we have this high, this low, and this low high, which means this last down close candle becomes a mitigation block. You can see that overlaps with our fair value gap. We also have this high, low, high, and then break below it, making these two down close consecutive candles a breaker. As you can see, the breaker overlaps. We also have this high, low, high, and break below that. So this down close candle is another smaller breaker inside of a larger breaker. We also have this last up close candle before the down move with the fair value gap, making this a valid bearish order block. So many different arrays are lining up after we see a market structure break and displacement. So this is going to be a very strong area to take a sell entry. Personally, it's not something that I would trade because it's outside my model. I like to wait after 8:30, sometimes 9:30, and as far as 3 PM. So that's what I start owning myself. So I know many people who like to trade pre-market. It's entirely up to you, but as you can see, it can work. The algorithm is working all the time. So if you see this and this is something that you're self-ism, so that this high to this low, and an optimal trade entry area, I'm putting below these lows down here. And let's put a little bit of a different perspective at the same price action. We have this consolidation, right? This is our first stage of accumulation, our second stage of accumulation, taking out the previous day's high and into a high time frame resistance area. Price then breaks down, going below this last close candle, which makes this a change in state delivery. So we had a buy program going up, and once this last close candle is broken, this becomes a change in state delivery. So now the buy program comes to an end, and we start a sell program. Now from this low to this high, we have all this back and forward price action, but it's all within this range. So this is a consolidation high, and this is a consolidation low, right? We also have this low and this low, so these are relatively equal lows with sell side liquidity resting below it. Once we break that low, and we sweep the stops below these last two down close candles, so this is a really good breaking structure for us because we've taken out the last stage of accumulation as well as this consolidation low from this low to this high. This now starts the first stage of distribution. As you can see from the previous slides, all the different confluences with the PDA waves that we could have got at this price, right? Now, because it's the first lecture, I want to give you a real gem here. So this is going to propel you trading in light years if you really start working with it, and you go out and you backtest it. It's regarding the market making models, right? So as you all should know by now through the academy that we have our initial consolidation, first stage accumulation, second stage accumulation, and we have our smart money reversal, right? Now we have this range, and this is our first stage of distribution after we've broken out that range, right? If we sweep below these last two down close candles, as we have over here at 8:30, now post 8:30, I can start going in there and looking for sells, right? Between the low of this candle and the high of this candle, you have a nice fair value gap post 8:30 a.m. New York. But let's take this one step further regarding the market making model, right? If this is the buy program, and this is the highest point of the buy program, if we put a vertical line, anything to the left is the buy side of the curve, and anything to the right is the sell side of the curve. Now, this is a market maker sell model, right? We're going up to go down whilst we're underlying the bearish on the high time frame, right? Now, in these down close candles, smart money is buying, right? As price goes down, smart money accumulates. So these are stage 1 and stage 2 of reaccumulation, right? So there's accumulating going over here. Now, this is more advanced when it comes to market maker models, but we want to pair these levels of accumulation with levels of distribution on the right side of the curve. So what we see on the left side should pair with the right side. Smart money is placing sell orders, all these sell orders, so the algorithm is consolidating in this area, which is overlapping with all the PDA rays and all the confluences that we've seen, with an old area of accumulation on the left side of the curve. It spends a little bit of time in there, and then it rolls over. 8:30, we break below these consecutive down close candles, which is another area of accumulation on the left side of the curve. We want to pair that with the right side of the curve. So old buying, new selling. Once you pair the left side of the curve with the right side of the curve, this opens up a whole new world when it comes to market making models. If you was paying attention to the academy videos, the second stage of distribution in a market maker sell model is usually the most explosive. When we got to this point, we hadn't taken out the sell side liquidity, but we had swept below the previous accumulation point on the left hand side of the curve. So smart money is hammering sell orders over here. And ICT describes this second stage of distribution on the sell side of the curve as silver bullet. Usually we're going to see the most explosive price actions from this area. And as you can see, that's what happened. We got the sell side liquidity below that, the sell side liquidity below these lows, and the sell side liquidity below these lows. 11 a.m. New York time. So there's my window of opportunity between 8:30 and 11, and price delivered beautifully. So for the coming week, what do we expect? Well, we've taken the sell side liquidity below this low. We dipped into this forward block. We have this fair value gap that's been rebalanced. We've taken the sell side liquidity below this low, so this is going to become a key low for us. From this low to this high, we're in a discounted range. We still have this fair value gap that's only just dipped into, so this is still a lot of liquidity resting above this, and they might want to take it up here to rebalance. We also have this fair value gap where the price wants to come in to rebalance, and if we get here, we want to wait for more information. If we go above it, it will become support, and then we'll be possibly attacking this high, filling some of this, and even these highs up here. We have this high to this low, so it's above 50%. They might want to dip into that to maybe then continue lower. And we can look at this as initial consolidation, first stage reaccumulation, second stage reaccumulation, broken below it. We could come down and clear these lows. We are, however, from this low, high, low, low, price is broken above it, so this is a weekly bullish breaker. And coupled with the fair value gap, the order block, sell side liquidity being taken, we could potentially see higher prices. I haven't incorporated the dollar index into this yet. I'll start incorporating things as we go further into the membership, but I'm not one to call the top on the dollar. I'm going to incorporate the dollar index and the euro into the membership at some point, but they haven't really moved over the last. Euro hasn't moved over the last month because August is typically a very quiet month, and if you go back and look at euro's price action over August on the hourly time frame, you can see the trend price action. This is why ICT is predominantly focused on the index market. We'll have to wait for more information. We have these relative equal highs over here, so we could pop up through that, maybe into this fair value gap. We have this volume balance still. I'm going to dip into that. But so you want to find the glory day time frame. Personally, I tend to use like hourly time frame as my daily log because I'm scalping 1 minute charts. So this is a really high time frame for me. For where we are right now, I mean, we could just consolidate. It's the beginning of September. We've had some of the runs out the way. We'll see what happens and how this week pans out. Of course, next week I'll do another recap and break down price action. We want to see displacement. We want to see the market move and volatility come into the market. Whether it's up or down, it doesn't matter. From where we are currently, based on it being inside this bullish breaker, and with everything that I've already highlighted, I'm not that bearish. I'm not that bullish. I don't want to really force anybody into a particular bias when I'm doing my analysis because I learned from experience again. A lot of times I was right and I listened to ICT and it was wrong. And you have to become independent in these markets. And this is one of the main things I'm trying to do is show you guys how to independently think, watching me and how I break down the narrative, how you can start employing this yourself. I will be doing a lot more analysis as we grow into the mentorship. But I want to keep this one, I say short, it's not really short, but I hope you found this one insightful. Like I said, we'll build them as we go and get a little bit more detail. There'll be a lot more gems coming. So try your best to go back through your own charts. Most of you are aware that there is a lot of information and it's not going to be easy, but hopefully you can see how all the elements on the academy you can apply that to real life charts and how you can really break down trades. And doing it in hindsight, the more you do it in hindsight, the more you train your eyes, the easier it becomes to predict future price movement. So hope you guys found this one insightful. And the wise words, Michael. And I'll catch you again next week where hopefully I can do a little bit more analysis and breakdown. But yeah, take care, guys. Alright folks, how's it going? So, firstly I'd like to thank you for all the feedback I had on the last mentorship video. There was a lot of gems in there, it was quite a detailed video. I had a few messages from people who were a little bit overwhelmed with it all. Every lecture is not going to be as detailed as that. Of course, with this being a mentorship, I'm going to do my best to teach as much as I can, especially when those teaching opportunities present themselves. But the main thing I'm trying to do in this mentorship is I really want to help you guys build like this contextual framework around narrative and bias. Now, one of the best ways of really doing this is learning a skill which we call reading the tape. Now, this is what I did with ICT every single week for years. Reading the tape gives you the foundations of developing narrative building skills. There's no real secret formula. A lot of it is based on market structure, and a lot of it is based on what price has already done. When I look at the market, I'm looking at levels where price has already gone, and I ask myself, does price need to go back there? And if it doesn't, where is it likely to go next? We're always operating in a grey area. We're not 100% certain of where price is going to go. It's just the likelihood of price going there, and then we work with that. Once we have a bias towards whether we're bullish, bearish, or we're consolidating, that's going to influence our decision-making process when it comes to finding entry setups. And sometimes you're going to be right, and sometimes you're going to be wrong. And you have to make peace with that. The idea is over a period of time and over X amount of trades, overall you want to be in profit, basically. If you manage your money well, you could potentially have quite a low win rate, but still be in profit at the end of the month, for example. Too many of you are being really caught up on you need to be right and just tell me what the bias is. And I know I fully understand where ICT was coming from that. To determine bias, it's a number of different things. So with that said, I'm going to take you into the charts. This is the dollar index. Now, we're on the daily time frame, and a lot of people don't like to use the dollar index. Personally, I think if you're not using the dollar index, you're trading half blind. There is a wealth of information that you can get from understanding where the dollar is likely to go. If the dollar index is likely to go higher, then foreign currencies and commodities and stocks are likely to go lower. So using the dollar index for intermarket analysis, in my opinion, is very important. It's not essential. Some people don't have it in their models and they're very profitable. But personally, I like to incorporate it. So I'm going to be using the dollar index quite often throughout this mentorship. So let's have a look at what the dollar index has done. We're on the daily chart. So what has price already done? So let's put some check on this. We've tapped into a daily volume imbalance. So to the left of the chart, which is out the view of this window, I probably should have had it, but we have the daily volume imbalance that we've seen price dip into. We again have to the left of the chart, there's an old weekly high that we've run through. We have this daily high that we've run through. So we've cleared a lot of buy-side liquidity above this high and tapped into a higher time frame premium level in the form of this daily volume imbalance. As you can see, we had 3 drives up into that volume imbalance, and then we sold off. Let's have a look at the dealing range. We took sell stops on this candle, and we took buy stops on this candle. So we can define our dealing range from this low to this high, and we have our 50% level. Once we dig into the daily volume imbalance, and we break below this candle over here, we're expecting price to come near that 50% level. And we can see that's a daily fair value gap from this candle's low to this candle's high. We also have this buy-side imbalance from this candle's high to this candle's low. We have a high, low, high, high. So this last up-close candle in this swing is going to be a breaker. It might want to stay above that. If this is the sell side of the curve, this last up-close candle over here can be a level of reaccumulation if we get back into it. From this candle's low to this candle's high, we have this fair value gap. Now if we extend that out in time, we can see that it overlaps this fair value gap, this wick, and we've dug into it today, right? This acts as a balanced price range. So we've gone down once, we've gone up once, and then we've wicked through it, so we've got buying and selling in the wick, right? Today we tapped into it. Now this will act as strong support. Now if we close above this could potentially set up a buying opportunity to run higher. If we break this low, then that would put bullish ideas on hold in the short term, and then we'd be looking to maybe fill some of this imbalance, maybe down here, or even attack the lows down here. We have this daily volume imbalance, so we gapped lower today, and if we stay below this, then we could potentially be bearish and want to continue down lower. If we close above it, this can act as support, and it might want to send us higher above these highs. From this low to this high, we have this 50% level, so we're in quite a deep discount relative to this dealing range. As you can see, we took out stops over here, we took out stops over here with this candle, so this low to this high is a smaller dealing range inside of this larger dealing range. And coupled with this balanced price range, I want to let price prove to me what it wants to do. We could just range in here between this balanced price range and this volume imbalance. So whether we're going to expand higher or lower, again, we want to see displacement. Once we see displacement, that will give us an indication of where price is likely to go. We never want to rush in and just assume that price is going to do something. We want price to show its hand, what the algorithm is looking to reach for. Once the algorithm shows its hand, and that'll be in the form of displacement, that's when we go hunting for ourselves, whether we're going long or short. Now, can we find any other clues that might give us an indication that this balanced price range with this fair value gap may want to hold as support, and do we want to reach for higher prices? So we have the euro dollar. Now, as you can see on the dollar index, we failed to take this low, so we made a higher low, and on the euro, we made a higher high. So this is S&T divergence at a strong support level on the dollar index. So this can suggest that euros may be coming higher just to take its buy-side liquidity, and the dollar is failing to go lower. So this can suggest that there's underlying institutional sponsorship behind the dollar index. So this is professional accumulation from an institutional standpoint. So we have the euro dollar on the daily chart. Now these last 2 up-close candles is our bearish order block, and we have from this candle's low to this candle's high is the premium end of our fair value gap. We've got this low, high, lower low, and this is the last down close candle before this up move. So it's quite a consolidated range over here. So I like this big beefy candle as a breaker, and you can see we dipped into this breaker today. So let's look at last week's range. So this is Friday, Thursday, Wednesday, Tuesday, Monday. Let's take a look at the hourly time frame and see what price action did. So this is the hourly chart, and this is our day dividers. So Monday, Tuesday, Wednesday, Thursday, Friday, and we have our midnight New York open, so we extend that out in time. This is going to be our weekly open, right? So as you can see on Monday, we dipped lower, took out the lows in Asia, and we started to move higher, found support on the weekly open. Now, Monday's trading, I tend not to trade, as you know, so I like to see what price is going to do on Monday. Now, price was moving in this trend line on Monday, and then on Tuesday, we opened up here, so we extend that out in time. Straight away from New York open, we moved up, and we cleared Monday's high into this fair value gap, this low, high, lower low, this last down close candle. That's our breaker. We extend that out in time, and we dip into it. And then, obviously, attacking the trend line and Monday's low, we can see that on Tuesday, we made a low of the week, and we cleared Monday's low. We consolidated, moved into Wednesday. Wednesday's open, extend that out, we dip below it, we cleared the lows in Asia. At the same time this was happening, we looked at the dollar index, and we were dipping into that daily volume imbalance, right? Now, the euro failed to go lower and take out Tuesday's low, whereas on Wednesday, the dollar index went higher, took out Tuesday's high, and dipped into that daily volume imbalance. So we have a few things behind us now, where we can start painting a picture of what the rest of the week is likely to do. On Thursday, we open, extend that out in time. We have this area of accumulation. We expand higher, taking out the stops. This is our manipulation phase into this last up-close candle. That close of the up-close candle is a rejection block. And if we extend that out in time, we can see how we hit it there nicely. Price then drops. This is our distribution phase into, from this low to this high, we're looking at 50% or below. We have this fair value gap with this order block. And notice the bodies of the candles, it respects that 50% level quite nicely. We dip lower into it, yes. But what else can we see? From the close of this body to the close of this body, that's our volume imbalance. If we extend that out, we dip into that nicely and add to support. Look at the premium end of that volume imbalance. It overlaps really nicely with the order block, 50% level, and the discount end of this fair value gap. And as you can see, price moved higher going into Friday, touching the discount end of that breaker on the daily time frame, and then off into the close. So now I want to take attention to today's trading. Normally I don't trade on Monday, but I thought this would be an opportunity to, again, do a trade breakdown. While I was making these slides, it just set itself up, so I decided, you know what, I'm going to take the trade on it. It was quite a decent trade, so I'm going to break down what I was seeing based on the framework that I've already set out. So let me get into what I saw today and break it down for you. So as you can see, this is Sunday's trading. This is Monday's trading. So right from midnight New York open, we dropped down into this fair value gap, took the Asian stops, and into this down close candle, which is our bullish order block, below 50% from this swing low to this swing high. So this fits our model. And then price rallies higher into London, making the high of the day. We then come off the highs and make a failure swing again during London. At the same time, whilst we're failing to make a higher high in the euro, we had made a lower low in the dollar index. Right? So this again, at a time where we're at the premium end of the order block, we've dipped into the daily fair value gap, and we've seen a failure swing. This is an indication of potentially weakness in the euro and strength in the dollar. Now, I didn't take a trade just based on that alone. I wanted more information. So I've seen this breaking market structure, and we've seen displacement. So this is a good breaking market structure for me. What I also found was we have this buy-side imbalance, and we have this sell-side imbalance. So one buy-side pass-through and one sell-side pass-through at that same price level. When we come back into that level, now I'm expecting this to act as a balanced price range. We didn't actually fill the fair value gap. Now, when you see something like this, when you see two fair value gaps overlap, so you've got buy-side imbalance and sell-side imbalance, this is when you expect institutional order flow entry drill, or IOFED, as ICT dubs it. With IOFED, we expect the fair value gap to only partially fill. There are ways we can determine how much it can be filled, but that's going to be later on in this mentorship because it's a little bit more advanced. But we can use this to build context. Now, when I seen price was running higher into it, I want to see, are we going to reject from this level, and are we going to drop? And as we drop with this candle, we broke below this last close candle. This is algorithmic. After this big long run up in London, now this is going to induce buyers. When retail traders see these candles pushing up like this, they're going to come in and they're going to be buying it, and then they're going to take the market lower because there's an inefficiency here that's going to be closing. So when we had one pass up through this price level on the buy side, one pass through the same level with sell side delivery, when we came back up to it, I'm anticipating this as a balanced price range, and I'm still waiting for more information to see does it act like a balanced price range. When we break below the low of this candle, this becomes a valid order block for me because now we have a change in state of delivery. Now to give me more confidence, we had this accumulation over here, so we got the buy stops, and we had left the sell stops, so all this liquidity that's pooling underneath these lows. So initially, as price is running higher, my eyes are going down to this level. Once we have this high that forms and we break below this candle, you can see that we came higher into the daily fair value gap there that acts as resistance at premium end, and this was my basis for taking the trade today. So I'll go into a little bit more detail in the lower time frame. So this is our 1 minute chart. Now at 8:30, I was already anticipating volatility to come into the market, right? So these last close candles that went up to balance that price range, this was one order block that I showed you on the 15 minute. So once we had broken below the low of this order block, that for me was a change in state of delivery at 8:30. So when we had this price higher, I was looking to take an entry. I was a little bit late, but I'll explain where my entry was in a second. I noticed that there was this fair value gap that was left. So we had displacement, a breaking market structure after balancing a price range. So with that framework behind me, this imbalance was something that I was looking to key off. Now, admittedly, I actually missed that imbalance. I was a little late with my reactions, to be honest, because I was in the middle of still making these slides, but I noticed that once we moved higher and dipped into this fair value gap, which also touched the premium end of that higher time frame fair value gap on the 15 minute, and this 15 minute order block, once this candle closed below these two up close candles, just as we did on the 15 minute time frame because price is fractal, I took this entry over here. So as price was going up, when it came to the body of this last up close candle, I put my first entry in that market order, which is 1.01436. So 1.01436 is when I first entered. My stop loss was around 10 pips. 0.01531. I could have actually put my stop loss above this order block, because with the framework behind me, I was confident that price isn't going to go back above the balanced price range, especially after the news driver and we've seen a breaking market structure with displacement. So I was fairly confident that we're not going to breach higher than this. But because we've got high impact news, a 5 to 10 pip stop loss is perfectly fine for me. I'm usually looking for a 2 to 1 trade. So with a 10 pip stop, I had a 20 pip take profit area, roughly. I was aiming for the liquidity below these lows over here, because this for me is a market maker sell model. Now, typically around 5 pips below this low is a good area for me to take my first profit. Also, I noticed that we were trading at this 300 level. So normally when we break below a big figure level like this, we're looking for price to really expand through it and really dig deep into that liquidity, especially with all the liquidity that's resting over here. We're not just looking for a shallow dip, we're looking for it to run lower. So for me, this was a safe area because it was below these lows, and we had this big figure level where I anticipated a drive lower. There was something else I will explain in the next slides. Now this is just a little side point as well. I see a lot of people who really rush to get their stops down at break even or trail stops. With the market volatility, especially after a high impact news event, you don't want to trail your stops. Like, I'll only move this stop to break even or maybe 50% from where it is after this swing low has been broken. And then as it moves further down, stop to break even if I'm planning on taking partials. Because this was quite a quick trade for me, I wasn't really messing about with my stop. I was looking to get in again. I wanted to see how quickly we're going to go below these lows and if it would give me another selling opportunity. So when we made this low over here, and we had these relatively equal lows, and price started to trade higher, I put in another sell order at market. 1.01371 was my second one. And the reason I did that is because we hadn't yet taken out the sell side liquidity resting below all of this. So for me, this was coming up into a fair value gap, into these 3 consecutive up close candles, one bearish order block. Extend that out in time, we hit it there nicely. My second take profit area was at 1.1138. I was aiming for this level down here, but actually missed it, so I was a little bit late reacting to it. I'll show you that again in a second. But this trade typically lasted me, I think it was about 10 to 15 minutes during the New York session, so this is ideal. So we had from this low to this swing high. One of the reasons why I didn't think price was going to really travel lower than where it was is because this is our 50% level, and below the 50% level I noticed that we had this buy side imbalance and the sell side liquidity resting within that vicinity. So I expected the run lower to take out the sell side liquidity and rebalance this fair value gap. I would again just lapse in concentration and miss it very low, but just literally dipped into it. Because we are at this 50% level, I expected, being a Monday as well, and having this really big range during London, I expected the algorithm to go into consolidation towards the end of the day, and that's exactly what we see over here. Which is why I wasn't prepared to hold on to a trade to see, okay, well, we have sell side liquidity down here, are we likely to go lower? And we also had the discount of that daily breaker, so there was a few levels over there. Also, this fair value gap from this low to this high, we have the consequent encroachment levels to that 50% level, so I expected maybe a run on these stops at least into that 50% level. So as you can see, that 0.1234 was the level that I got at initially, and then that was like my first take profit and then the second take profit. So that's one of the reasons why I had that level. I could have gotten very low over here, so I'll explain why I could have done. This is something I get asked all the time. I can be very, very precise if I want to be, but what I discovered over the years, and something that I wrestled with a lot, is trying to be too precise. I just want the lion's portion of the move. So if I'm up, 2-3%, I don't need the very best exit. The aim of the game here is to just be profitable and try not to leave anything on the table if you can. Whether we get out the exact high or low, it doesn't matter. As long as we're in profit, take your money and you run. So this was the 8:30 open. The open of this candle to the close of this candle. So from this candle's body to this candle's body. If we project standard deviations down, you can see 1, 2, 3, 4, 5 standard deviations goes that very low. So that the retraction swing after our opening price from 8:30, we can use standard deviations of that target projections. So E-mini, so last week I said that we're likely to come into this fair value gap based on what market structure was doing and being inside of the weekly breaker. Now from this high to this low, we're at 50% level. Now we're likely to see price maybe consolidating here. Now we've got some high impact news coming out towards the end of the week, so that's going to give us a displacement. Whether we break above this fair value gap and it comes back down as support, and then we might want to dip into this volume imbalance, close out some of this fair value gap, or even go higher into the remaining of this fair value gap is yet to be seen. But this gives us some indication of where price could be likely drawn towards. We obviously have these last two close candles, so we have our bearish order block. We need to obviously get through this. The mean threshold is what I'm looking at. We have this volume imbalance, so today we gap up. Now we can go and see throughout the week whether that will hold as support. If we stay above it, then we may want to travel higher, take the highs up here or even up here. If we end up closing below it and that acts as resistance, then we're likely to come into this volume imbalance or even these lows. If we come down here into these lows, then we're likely to attack sell side liquidity down here. Now notice what I'm saying is if this happens, then this is likely to happen. Right now we're at 50% from this high to this low. So between this order block and this fair value gap, with it being 50%, without expecting high impact news towards the end of the week, it's likely that this also might consolidate. Now here's another little tip. When I'm in the 50% region, this is where I'm looking for a run on liquidity on both sides of the market. So this is when I'm scalping and high frequency trading. When I'm towards the opposite end in premium and discount, that's when I'm looking at my one shot one kills, that's when I'm looking at my swing trades, that's when I'm looking at my day trades, because they're less likely to consolidate. So one for your notes is when we're at 50% of the dealing range, this is an area where we're likely to consolidate, and the probability of consolidation is increased if we're also inside a fair value gap. Right? This may want to change his mind and we'll get some volatility throughout the week and push higher, like I said. But when we're at an area like this, you want to get away for more information. I ended up trading, I think it was Tuesday or Wednesday this week on the E-mini. I should have put up the slides on this, but couldn't be bothered to lie. Funnily enough, it was the exact trade that ICT took, literally almost to the pip where he got in and where he got out. I wish I actually put it up, but it was too much effort. It's been my daughter's birthday today and I'm knackered, and if you've got kids, you know how stressful a birthday party can be. But we did fulfill our objective for the week. I also said when we get to this area, I want to wait for more information, and the reason for that is what I've just outlined now. We've also got this trend line over here, so this might be something that we want to watch. If the dollar index continues to push higher, that's going to put downward pressure on the stocks and index market. So we've already come to a higher time frame level. Now we want to assess what price is going to do. You never jump in just for the sake of it. You always want to let price dictate where your next move is going to be. Always let price show its hand first, and from there we can start filtering out trade ideas. So I hope you guys found this insightful. I'm sorry if I've waffled a little bit in this one. I'm really tired. It's quite late over here and I haven't slept much, but I hope you all have an amazing and profitable week, and I'll catch you guys again next Monday. Alright guys, welcome back. So just before we begin, I'd like to say a quick thank you for all the feedback for the last mentorship videos. All of you are at different levels, some brand new people, and some really, really good experienced people in this mentorship. Extremely impressed with the growth of a lot of you. You should give yourself some credit for how far you guys have already come in such a short amount of time. I've had a few questions regarding mentorship, which I'll just get out of the way quickly. Been asked by quite a few people about whether I'm going to be giving signals and trade setups. No. I'd rather teach you guys to fish. That's the whole point of doing this mentorship. I want you guys to become self-sufficient and independent. I don't expect you guys to be here forever. I want you guys to use this mentorship to just speed up your learning, really. Eventually you guys will be able to do this on your own, and if you want to hang around the mentorship, cool. If not, then I hope you guys can spread your wings and go off and do your own thing. As far as trade signals and trade ideas, that's something that I won't be doing. I'm really conscious about trying to force you guys into an opinion or my own bias. Like I said, we're all going to read the market differently. So I'm trying to give both sides to the market, so you can listen to my personal internal dialogue of what I'm looking at. You want to have these levels on your charts, and especially throughout the week on the lower time frames. You want to see how price reacts at these high time frame levels. Like I said in previous videos, one of the problems I had earlier on was relying on ICT too much. I may be wrong in my bias. So when I'm giving my internal dialogue, I'm looking at what the market can do, and I'm always making a case for both sides of the market. I really only trade when it's so heavily weighted in one side, and I might not get that on the daily time frame, but on the lower time frames when I'm trading, it just might be clear. So number one, you don't force any trade. Don't let anybody force their bias on you. It's very common, especially at first, to second guess yourself, and this is what you're doing here. You're training your eyes. You're learning how to read the tape. You're learning how to internalize that dialogue to flesh out the bias in the narrative. And unfortunately, there's no easy way to do this. So it's just repetition and a lot of backtesting and a lot of training your eyes. You're not going to win every trade. Try not to be too obsessed about being right. Look at a lot of ICT trades. It can be wrong, but with good money management, it's still profitable. And this has happened to me time and time and time again. And don't fear losing money. A loss is just an expense. It's a business expense in this market that we're in. We don't have shop fronts and we don't buy stock. Our losses are our business expenses. So don't fear the business expense. You just want to be up in profit over X amount of trades. You're not going to win everything. I mean, this crippled me for a long time, and there's a few of you that I've spoken to this week. We're really struggling with that fear of losing. There'll just come a time how you deal with those losses is going to affect how you're going to become a trader. So you want to be emotionless as much as you can. Try not to get married to your trade idea. It's important to be fluid in these markets because they can change at any given moment. So understanding which levels are key levels that are going to invalidate a trade idea is super important. It's just as important as knowing where the market should go. Knowing where the market shouldn't go is also just as important. Anyway, that's enough of that. Let's get into the chart. So we have the dollar index on the daily time frame. Now, that balanced price range from last week, it did hold, and we had obviously that SMT divergence that I pointed out. I went to close above this volume imbalance, and this was the CPI news that came out. We obviously closed above that volume imbalance. So we have the buy side liquidity resting above the market. So that's the volume imbalance. This last close candle in the swing, the highest close is a rejection block. We hit that nicely from last week's trading. So this low to this high to this low, we broke back above this high, which makes this last close candle our bullish break. As you can see, we've dipped into this and then had a really big displacement. This becomes an intermediate term low after filling in this imbalance. So this has already ran stops and done its job. So we don't expect this low to be broken, especially being inside of this breaker. We have this displacement, obviously shot straight through that volume imbalance. So this looks like it's going to be drawn to the buy side liquidity. There's a lot of strength in the dollar at the moment. This is obviously causing weakness in the foreign currencies and in the index market. So it'll be interesting to see what we do for the following week. From this high to this low, we're in a premium level. Now we have this volume imbalance in the discount, which would be around optimal trade entry as well from this low to this high. So it'd be interesting to see if we're going to stay above it. We could come down into this area and maybe bounce higher. It might not even need to do that. We have like this little balanced price range over here. We also have this low, high, low, low, and then we're currently trading inside of this last close candle over here, which is a breaker. I don't really like these two candles over here, it's very wicky, so I tend to omit those candles. So this candle here and this candle here could act as one breaker. So we're currently trading inside of this. We may consolidate for a couple of days in here. When the market starts making small candles like this, these small candles usually lead to another large candle, so I'm expecting maybe more upside. But again, we'll have to see how we trade throughout the week. So euro dollar, so we traded up into this breaker last week. I got a couple of questions about why I use this candle, why not this one, because this was the last down close candle before the swing. That's correct, but this last down close candle is in the range of this down close candle. So you could have potentially used this down close candle, but because I don't like this wick, it's a very indecisive candle, I wanted to use a big beefy down close candle, so this was like the lowest down close in this swing. So your low, high, your low, low, and obviously we've mitigated positions over here. We have these consecutive up close candles, which is a higher time frame, one bearish order block. The lowest body, if we extend that out in time, that overlaps these two up close candles, so there's another one bearish order block. We had a fair value gap from this candle's low to this candle's high, so it's a grey shaded area. And the low of this up close candle, you can see how the body's respected that low quite nicely over there. Obviously the CPI came out and tanked. Because I still see strength in the dollar, I see weakness in the euro. So it may want to push into this fair value gap from this candle's low to this candle's high. We also have this volume imbalance in there as well. We might want to see price come into this area and maybe continue lower to take out these lows down here. So let's go on to the hourly chart and let's look at what price did over the previous week. So Monday, Tuesday, Wednesday, Thursday, Friday's trading. So this is Sunday's trading, and you can see we got higher. From the body of this candle to the body of this candle, we have the 50% area. And we dug down into around 50% of the opening gap, which also overlapped this fair value gap. So Friday's high was taken here on Monday, and we shot up right through it. And then we sold off. On Tuesday, we went straight up, and this last close candle, which also overlaps with that daily order block, into 8:30 AM when the CPI news released. As this was happening, we were making this failure swing on the euro, and at the same time, we were going and making a lower low on the dollar index. So this was your cracking correlation. At the same time, we were coming into the high time frame level after taking out previous day high. So we had a number of confluences over here that overlapped. Now, I didn't trade this, and I wouldn't recommend anybody to trade it, even though we had all the framework behind us. This is all manual intervention. They can run it both sides of the market sometimes. So it's nice to see that the algorithm still works even during high impact news events. And in hindsight, yes, we can see it working. But this isn't something that you want to trade. ICT has told us many times throughout the whole private mentorship, don't trade NFP, FOMC, CPI. So these high impact news events is something that you just want to stay on the sidelines for. So another question that I got asked recently is, when can we expect a seek and destroy profile after a really big range day like this? Highs are taken here, lows are taken here, lows are taken here, highs are taken here. So expect the market to become choppy and just basically work both sides of the market after the really large range day. You don't want to trade in this. This is still, you can still find accuracy. We have this TGIF trade as well, which is on Friday, where we cleared all the lows and made the low of the week on Friday, and then we moved 30% up into the range from this high to this low. This is known as a TGIF trade. Some people like to trade it, I generally don't. But when you have the framework and the context behind you, you can get quite accurate with this. And I'll show you something here to show just how accurate the algorithm can be. The algorithm moves in ranges, right? So after this large range, we had this consolidation profile. Now from the bodies, because this is where all the volume is, from the bodies down here to the bodies over here, this started this consolidation. So all of this rangy back and forward price action was between this range. So if we take the lowest body and the highest body, and we project half a standard deviation upwards, we get 1.00363. If we extend that out in time, we get the very high. The cursor's hovering over this candle, and if we look, the high of this candle is 1.00363. So absolute perfect precision with that. Now, did this just come to a random level and stop because we had one deviation? Well, no, we look closely. The algorithm is seeking macro price points. So in its logic, there's going to be certain price points that overlap with these standard deviations that Ipta is going to remember within its logic, and it will reach for these prices. These are the reference points for Ipta to reach. If we extend this back, and this high to this low to this high, and we break below it, this is our breaker. This last down close candle in this swing, the low comes in at 1.00363. Perfection. It hits it perfectly. And they say there's no algorithm. So this isn't something really that ICT stores. This is something I've learned personally over the years. I call it IRD, the range deviations. Based on certain times of the day where we expect ranges to form, it will use that range to project deviations of that range. And we already know this from the central bank dealers range and the Asian range. And this is essentially how IPTA will hunt price based on the deviations of these ranges and time. But they both have to align at the right time. And I think that's the hardest thing to really get your head around. With a lot of backtesting and study, you'll start seeing things yourself. Anyway. S&P. So I said last week I was watching for the mean threshold of this order block. Now, why this last close candle and not these two consecutive candles? Yes, this is one bearish order block, but there's two reasons here. Number one, this order block is separated by this volume imbalance. And number two, from this candle's low to this candle's high, we have a buy side imbalance, sell side imbalance, and then we tagged it. So this becomes a balanced price range. Now, I don't expect price to go above this high, and because this is the last close candle in that balanced price range, I expect the mean threshold to act as strong resistance. We hit that nicely and then sold off. We took out this swing low. So taking out this swing low, it's most likely with the dollar index looking to go higher, we're going to see weakness in the indices. So these lows down here now look susceptible. It's likely that we may trade below this, but it's not going to be a straight line if we do get there. So we have this close candle broke market structure over here, and then went to consolidation. So from this range is that initial consolidation if we're looking at market maker sell model. So we could potentially come down and sweep these lows. However, if you're familiar with ICT concepts, you'll know that the initial consolidation in a market maker model, one of the areas we aim for is the 50%. So from the highest body here to the lowest body here, the 50% range, which is also these consecutive down close candles act as one bullish order block. The mean threshold of that, we extend that out in time, which is also the 50% of this range. We've tapped that nicely. So from here, since we've taken these lows, we want to see what price can potentially do. Do we have the legs to continue lower to clear these lows? And with the dollar looking to go higher, this is a likely scenario, but we may want to retrace higher before going lower. So from this high to this low, we have our deal range. 50% is right in that imbalance. So that might be a draw on liquidity. We have these relative equal highs over here and this fair value gap. We also have this volume imbalance, so we need to see how price reacts to this volume imbalance. Do we want to go up and close it and then roll over? Or do we want to go above it, act as support? And if that happens, then we're looking at these relative equal highs, this fair value gap, and this volume imbalance over here. And then maybe aim for the sell side liquidity resting below these lows. We also have this high, low, higher high that took out the buy side liquidity above this high, and we drop below it. Now, this is a breaker, so we might want to keep this in mind. The high of that breaker sits nicely in that volume imbalance as well, but we could see what happens over here as well because the low of this breaker is within this volume imbalance. So we want to see how price reacts. Personally, I like it to be drawn down here because it just makes sense. We've taken out all these highs, we've rebalanced, we've respected the balance price range, respected the order block, had a really sharp move down, broke market structure over here with these lows. So it looks heavy to me, especially looking at the dollar. In the coming weeks, it's likely that we're going to run below these lows over here. Let's go into the hourly time frame and let's see what last week's price action did. So Monday, Tuesday, Wednesday, Thursday, Friday. So as you can see, from the midnight open, we created this low and just made this trend line going higher. So again, Mondays is always good to watch, especially for high impact news event on Tuesday. And start seeing price move up in steps, leaving all this pool of liquidity in the form of trend line liquidity down here. And as you can see, we hit the mean threshold of that order block inside of the daily order block, inside of that balance price range. And when the CPI news came out, we absolutely tanked. We closed over here below this volume imbalance. So you can see how that acted as resistance. We also had this fair value gap, so came around consequent encroachment, taking out the sell side liquidity below this low. We started a buy program from here, and this was to engineer liquidity below this trend line. So if we take a fib and anchor it to the low of this candle, then the high of this candle, and we project 1.5 standard deviations down, we get 39.38.5. If I hover over this candle, you can see the low of that candle comes in at 39.38.5, which is just below the sell side liquidity, which would have been our target. Beautiful delivering price. The next day, we had a seek and destroy profile because after a large range day, expect choppy price action. So we were just taking the highs, taking the lows, taking the highs, taking the lows all the way through. On Thursday, we dropped, and I'm going to zoom into this bit of price action on the 5-minute chart. Lows all the way through. On Thursday, we dropped, and I'm going to zoom into this bit of price action on the 5-minute chart. We're going to flesh out a little bit more detail. So this was London's high, where the buy side liquidity rested above it, and we just swept above that. And then we sold off, taking out Wednesday's low. Now this is going to be a key low. It's the previous day's low. So this is going to be a high time frame breaking market structure. And we have a low time frame breaking market structure over here, but this now becomes a high time frame breaking market structure, which is stronger. And as you can see, price dips below it and then comes back into the range. Now we broke a market structure over here, and then as price comes down, we have this little fair value gap with this order block. People who've been looking at ICT's model without really understanding narrative and context behind it would have been taking that as a buy. But what time are we? It's the start of New York lunch. So as a rule, we don't trade between 12 and at least 1:30. So This is why, because we go into a dead time where the algorithm can do a number of things. So post 12 o'clock, we don't want to be in any trades. But if we're seeing an entry forming this close to the lunch hour, don't take a trade. I've been caught up and stung in these far too many times to know that that's not myself. So during the lunch hour, we travelled higher. So from this swing high to this swing low, we have our premium and our discount. So we went back into a premium market at around 130, and we have this balanced price range. So from this candle's low to this candle's high, we had the buy side and then the sell side. So this is going to act as a strong resistance. We're already expecting low prices with the heaviness that we've seen throughout the week. The body of this candle to the body of this candle, all these down close consecutive candles is one larger breaker block on a higher time frame. So we have the high, the low, the higher high, and we broke below it. So between these two black lines is our breaker. If I hover my cursor over this very high, it comes in at 39.63.5, and the open of that breaker comes in at 39.63.5. So again, perfect. After coming into the opening price of that breaker and into that balanced price range, we sell off. We have this swing low, and on a lower time frame, you probably found fair value gap to enter over here. But once we broke market structure over here with this candle, we then had this fair value gap that was left. Price dips into it, and this is institutional order flow entry drill. Again with this balanced price range over here. I'm sorry I should have annotated this a little bit, but I've been pressed for time today, so I do apologise. We then touch the close of the breaker, and then we see another nice displacement leg lower, leaving this fair value gap. We come up into the order block, closing that fair value gap, and then we again sell off. So really, really nice price action, despite having such a volatile week. And don't get me wrong, this was not an easy week. This is all hindsight. I took 2 trades last week. I got stopped out at break even on one of them, and I got halfway to my target on one of them. I didn't lose any money, so it's a win for me. I just got money management. But it was a really tough week. A lot of people I spoke to last week really struggled with it, so you're not alone in it. You're going to get weeks like this, especially when you have high impact news. Again, for this coming week, we've got a lot of news coming out. So really cherry pick yourselves. Do not over leverage. Weeks like last week and this week with all the news that's coming out, and it all seems to be happening now at the same time. There's a lot of stuff going on in the markets. They're not moving as over the years. This is the hardest conditions I've ever seen. So you guys are learning in the hardest conditions, and this will make you incredible traders. So learn patience. If there's one thing that you can learn during these markets, is just learn to sit still and learn to be patient, and don't FOMO in. People are blowing accounts left, right, and centre. So capital preservation is the key to longevity in this game. So we'll see what the week brings us. I just want to finish on a little bit of a bonus. This is something that isn't taught in ICT's mentorship. It's not taught in his private mentorship. Again, it's something that I've discovered myself through his teachings, of course. Like I said, he leaves us breadcrumbs, and you just got to go out and find it. Now, it's to do with SMT divergence. It's a little bit more advanced, and you'll have to really backtest this one. It's slightly different to the normal SMT where we're looking for a run on stops. This is more SMT in regards to the PDRA matrix, right? So I'll explain that. So we had the CPI news that came out this week, and I've already shown you what we see on the euro with the SMT at the same time as the CPI news came out. Well, we didn't have the exact same thing on the indices, but we had something similar. Now, this is another way I use SMT. We have this fair value gap on the S&P 500. Again, this is the Dow and this is Nasdaq. And as you can see, with the S&P 500, as we were in this buy program, engineering this liquidity, we had dipped into this fair value gap, and then we tanked. If you notice, with the other two averages, in the Nasdaq, we hit the discount end of that fair value gap, and in the Dow, we didn't even get close to it. So the S&P dipped into the fair value gap, which was its high level premium array, whereas the Dow and the Nasdaq failed to get into the high level premium array. So this was showing underlying weakness in both the Dow and the Nasdaq, and the S&P was coming up to target its high level premium array. So this is again how I use SMT. Again, you can use it across the averages. You can use this in the forex market. It works in all market classes, and it's something that I've kept close to my chest actually for a while, but I'm going to share it with you guys. So yeah, please don't share this outside of the mentorship. Backtest it, and you'll see quite a few times, especially when you've got high impact news events, that yeah, we may not take the buy side or sell side liquidity, but if we categorize in terms of the PDRA matrix, and one of the averages dips into a high level premium where the others don't, this is another indication in this case of smart money distribution. So I hope you guys have found this one insightful. I was just standing on it, I'll say it. I'll catch you guys again next week, and like I said, I don't want you guys to really get burned this week, so tread with caution and navigate these markets accordingly. I'll catch you guys again. Take care. So last week we were. Alright guys, so we have the dollar index on the daily chart. So last week we were around this area, so today's trading Monday, Friday, Thursday, Wednesday, Tuesday, Monday. Now, in last week's video I was looking for the buy side liquidity of this high. I said that we could potentially reach down to the volume balance, but we didn't need to because we had this balanced price range, and we were also inside of this breaker. I also said after small ranges, we usually have large expansion moves. So as you can see, at the beginning of the week, we really pushed higher. I didn't expect to get this kind of volatility, I must admit. I didn't think we'd move this high up. But it's again just signs of the market right now. Things are very difficult. It's very difficult to get a real strong read on what's going on. We broke above and swept the buy side liquidity above this high. Notice how we closed. So it was with displacement. We then came back and filled in some of this range left with this displacement and into this last close candle. So we have our order block. Now, this is a question I get asked quite frequently. When do we use the bodies and when do we use the wicks? Now, narrative plays a huge role in this. When you have overlapping of PD arrays and a fair value gap, this is when you're likely to see the wick to the body be the most sensitive part, and often you might not even need to trade into the body. If we'd already traded into this wick, like say we had a consolidation around the wick area, and we'd already dug into the wick a few times, then I'd rather use the body of the candle. But when we have something that's like a clean break and we've had this displacement, with all these PD arrays overlapping, that's when the wick is going to be very sensitive within the order block. Notice how we again travelled through the 112 big figure. We had buy side displacement, we left this fair value gap, and we traded through the discount end of this monthly fair value gap. I will show you the left hand side of the chart in a minute. But the levels that I have noted over here, which you might want to have noted in your charts as well, I have this monthly fair value gap, the discount end. This is the premium end of that monthly fair value gap, and the consequent encroachment, so it's a 50% level. I have an old daily volume imbalance, so the discount end and the premium end, and we have this in these two blue lines, this weekly fair value gap that is still yet to be traded to. So this might be something that we want to look for. Whether we get a retracement lower and then go higher, it's hard to say at this stage. To be honest, it's been quite neutral. Last week's range was quite big, so I expect some sort of choppiness, at least going into Monday. We've got a lot of high impact news coming out this week as well, so you really want to be careful. Don't, again, with these market conditions, you don't want to be over leveraging and really cherry pick yourselves. So let's have a look at the left side of the chart. So this is the dollar index on the monthly. So this is the fair value gap on the monthly. We have the premium end, the discount end, and the consequent encroachment. This yellow line is Monday's high, so we didn't fill in the whole fair value gap. But I mean, there's a lot of levels on here that we could well just reverse from where we are, given the strength of the dollar and the current economic climate. I still personally feel that the dollar wants to go higher, potentially up into this area or maybe even above these highs yet. We have to wait and see. On the weekly time frame, this is that weekly fair value gap that hasn't been traded to. As you can see, we have these relative equal highs over here as well. So if we do get any more upside, this is something that I'm looking at. On the daily chart, this is that daily volume imbalance. So we went up through it, came back down, and we've gone through it again. So this could offer us support if we do decide to come back down. I did think we were closing this premium end of this monthly fair value gap and go into this last close candle, which is our order block. We also have this volume imbalance in here, so we've pretty much come into like the mean threshold of that. We need to get through this, and if we do dig up into the weekly fair value gap, we also have this little volume imbalance and this fair value gap on the daily chart inside of the weekly fair value gap. So we will see. I'm not calling the top on the dollar. We are overextended, so we may see a retracement going into the week, but I'm not going to be calling the top anytime soon. So Euro, I obviously explained this part last week. I said that we had, from this candle's high to this candle's low, we had this fair value gap. And we also had this volume imbalance. And I specifically pointed to this area last week, saying the price might want to come up and then attack the sell side liquidity below. And it did that beautifully. Again, I didn't expect it to overextend like this. It could have done, of course, because, as if you recall what I was looking for on the S&P 500, which we'll get into later on, I did think that we were in a market maker sell model. So it made sense for the dollar to go higher and obviously the index market and the foreign currencies to go lower. We really dropped through that 100 level. And we took out an old low, so the sell side liquidity is a weekly low. We dug into that. We also have a weekly fair value gap as a premium end and discount end, and we also have an old weekly breaker, a bullish breaker as a premium end and discount end. So we dug into this nicely. It'll be interesting to see where we go from here. Like I said, for the time being on neutral, we could come back up to fill in some of this imbalance and then maybe go lower. We obviously gapped lower on the Monday, so it'll be interesting to see what we actually do. Whether we want to come back up, fill this gap and go lower. But again, like I said, if we go above it, it'll have to support, maybe dig into close on this range and even up here. It's unlikely with the given strength of the dollar at the moment, but we'll get into a little bit more detail when it comes to market analysis in a minute. So this is the left side of the weekly chart for the euro dollar, and this is that old weekly low. This yellow line is Monday's low, so where we ended up trading today. Between this candle's low and this candle's high, this is our weekly fair value gap, so the premium end, the discount end. From this low, high, lower low, after running these stops, we broke back above this high. So this last low close candle is our breaker, which sits nicely in that area as well. From this high to this low is our dealing range, and all this back and forth price action, which was in here for years, accumulating. We broke above it and then traded back into it. At the 50% level, we have this fair value gap. So as you know, we look for a draw on liquidity is 50% of the initial consolidation, which this could potentially be. So we'll see maybe price wants to dip down here. We also have the 900 level as well, so it'd be interesting whether we're going to get that low. I'm not 100% sure yet, if I'm being honest with you. Looking at it on longer time frames of the monthly chart, this was this consolidation over here. So you can see if this is the initial consolidation, we split that range in 50%, we have this fair value gap. So price might want to dip into that. This looks like it could potentially be a market maker sell model, so your initial consolidation, your accumulation, reaccumulation. Around the high, smart money reversal. From this high to this low, we're inside of this dealing range, so we spent a long time in there. Broke below it there with displacement, and then it's redistribution. So again, from this dealing range high to this dealing range low, we're in a range for a long time. So we may, because we're in a range for a long time, may want to dip below this sell side liquidity. We could also have this accumulation, manipulation. These last down close candles is one order block fair value gap, which we've dug into today. We took this low. So the two fair value gaps here. So we dug into the higher of the two fair value gaps, and we took out this low. So we could see accumulation, manipulation, distribution above these highs. From where it is, it could happen. I'm looking for some sort of institutional sponsorship behind it, so in the form of an S&T or something. We've dipped below this low and traded into the higher of the two fair value gaps. And on the dollar index, this is the same low that was here on the euro. We traded well above it and dipped into the higher level fair value gap. So this is a PDRA S&T divergence. It's not enough for me to say, right, this is the top one going short. So we'll still have to see what happens. Again, we have potentially a market maker buy model where we've gone lower to go higher, and that yet remains to be seen. On the British pound, this is the 1st of February 1985. Today we dipped through that. It's crazy. So we've been in this sort of consolidated range for a while now. It's only a shallow dip, so it's potentially go even lower. If we're looking at the equivalent low in the 1st of February of 85, we're nowhere near it on the euro. So there's, like I said, the market's moving strange. This is the hardest I've seen in the last 4 years. It's really difficult to make a really sound judgment of where prices like to go, which is why I'm really just sticking to my scalping on short-term models at the moment. We'll see how we play out over the coming weeks. So let's go into the hourly chart for the euro. We have our standard annotations now, so Sunday, Monday, Tuesday, Wednesday, Thursday, Friday. As you can see, Friday's high, we had buy-side liquidity resting above that, and we ran above that into the daily fair value gap and that volume imbalance. So this little area is where I was pointing to last week, with the overlap between the two of these PDRAs. Again, on Monday, we just started moving higher like this, and when you're bearish and you see this happen, we've seen it over the last 2-3 weeks now. Monday starts trading higher, we're looking for lower prices. On Tuesday, this is our opening price. We move higher and then lower to attack Monday's lows. We've got these equal lows. So we've engineered liquidity in the form of these equal lows and then moved higher, and we haven't taken any sell side liquidity until we obviously break market structure and then attack the sell side. So look how many candles it took us to just move higher, and then quickly we break below it. This is our valid breaking market structure taking on Monday's low, because again, Monday's low, the algorithm is going to keep in its logic the important highs and lows. So when we have a daily low, this is going to be an important macro for the algorithm to refer to. When we have a break below it, this is again important in the algorithm's logic. We don't need a wick, this little wick below it, we don't need to see the body close below it. This for us is enough for a breaking market structure. We then move higher, we have this balanced price range, and from this high to this low, we come into optimal trade entry as well. Why have I used this swing high and not this swing high? Because this is the one that had that energetic move, that broke structure. So we have that 3-bar swing time, so this is the leg I want to run my fibs from. We obviously then consolidate throughout the day. On Wednesday, we have FOMC, 2 o'clock. We open and just dip above it slightly, and then roll over. We run higher, clearing some of this fair value gap. So this is institutional order flow entry drill. Why? Because we're above these lows, and we've seen displacement. So we're not expecting this to fill. Retail will look at these lows over here, and they'll say that's support broken, turn resistance. So this is why when we break below lows, we don't normally see the fair value gap fill. We broke lower. They had the old sell side liquidity. This is what we're looking at on the daily time frame. So FOMC came through, wicked right through that fair value gap, order block, and then we close out the day, going below the low of the candle that created that back and forward whipsaw during FOMC. Thursday, we have a consolidation day really, so we open here and we close over here. Friday, 12 AM, we go above it, order block, and we sell off into the close of the day. Sunday, we actually took the sell side liquidity. I don't tend to look at what price is done on Sunday, apart from the opening price. As you can see, we gapped lower, and then we found a low resistance. This price action over here, even though we did wick through the old low and then came straight back up, I'd like to see maybe a deeper run on the sell side, just to sweep below that low again. So we might see that going on today. This might have already happened by the time you're watching this anyway, but during the time of this recording, we still have a little bit of time left in the day, so we might actually see us roll over. Maybe go below this, I'm not sure, but I want to see it dig a little bit deeper, not just wick straight through it like we have seen on Sunday. Now, if you look at the weekly range, and you try to categorize this into a weekly profile, we can see that on Monday, we had this Judas swing going higher, so there was an expansion move. On Tuesday, we had this reversal. On Wednesday, we have continuation going lower. Thursday, we have a consolidation, and Friday, an expansion move lower, closing out the week. So if you take Monday's low to Monday's high, because this is that Judas expansion going higher, the algorithm is going to project 1, 2, 3.5 standard deviations lower, and we actually nail the low of the week. So this is something you might want to backtest when you're doing your range analysis, and 3.5 standard deviations is something you're going to see quite often. So this is Tuesday's price action. Let's zoom into Tuesday's price action and get a real deep dive about what happened on Tuesday. So we have our opening price, 12 AM. This is our midnight candle. Let's put some lipstick on this to show our kill zones. So we have Asia, London, New York, and London close. From London close to Asia, all of this price action is dead time. We don't trade it. In fact, I don't even look at price action over here. So I get rid of this completely. And this is our daily range when we're looking at euro or the forex market. Let's break this one down. We have our New York midnight open. Prior to New York midnight, we have our Asian range. So from 8 till 12. As you can see, we dropped in the Asian range, made a low, and these equal highs, and these equal lows. So from this low, and these highs, we're in a range over here. Now, ICT says that we should use the Asian range, and that's okay for certain things. When I'm seeing the Asian range drop, and then I see this elongated consolidation, what I'm looking for is really consolidation. even if it goes after 12 a.m., and this is going to take a little bit of experience and really bad testing this, but the consolidation, in my opinion, is what starts the standard deviation cycles that's going to dictate where prices are likely to go. Obviously, this has to align with time, but I believe the standard deviations are worked out by price points within ranges. Now, this range, we have a low and we have a high, so we already know that there's going to be buy-side liquidity above these highs and sell-side liquidity below these lows. So it is going to specifically remember this price point for the sell-side liquidity and this price point for the buy-side liquidity. The opening price is also another macro price point that it is going to remember its logic. You can see just how we moved up into it. Yes, there was a fair value gap overlapping here as well, but again, that's algorithmic. We stop directly at that price and then we drop lower, taking out the sell-side. How far down is it going to go? Well, if we run it from this low again to this high, because these are two macro price points now stored in Victor's memory, 0.5 standard deviations down, we get a low, and 0.5 standard deviations up. If we look left, we see this fair value gap, which is also in close proximity to the 0, 0 level. At the same time, we're seeing these three drives higher, really digging into the liquidity above this buy-side liquidity and into this fair value gap. And then we see price breakdown and we break market structure. This was the initial low made in London. So again, with it being a 0.5 standard deviation of this range, this is again going to be a macro price point. Again, remember in Victor's logic, we break below that and we just fall short of the 1, 0, 0 level. So this is a major level. Now, already, if we go below this, ICT tells us that we're looking at 40 to 50 pips below a big figure level like this. So this is a 1, 0, 0 level. Normally we're looking at 10 to 30 pips when it's a standard 0, 0 level, but when it's like a big figure like this, it's like a whole number. We're not just going to be dipping through it like this, we're going to really dig into it. So when we see this, I'm waiting for another expansion lower. But where do you get in? This area between 5 a.m. and 7 a.m., this is again dead time. The algorithm is not going to refer to the price action in this area, right? It's only going to refer to price action and macro price points within kill zones, right? We had this in Asia kill zone, so for the standard deviations. We got this low and this high in the London kill zones. And not only is it remembering the highs, it's remembering the PDRAs that are in those time zones as well. Remember, time has to blend with price, and that price is a macro price points or PDRAs that we call it. That it is going to again remember its logic and refer back to when time aligns with those price points. So this point between 5 a.m. and 7 a.m., this is dead time. It is not going to be referring to anything in this area, so again, we don't even consider it. Now look closely. This 0.5 standard deviation, which is again in its logic, with this low, which was a breaking market structure, right? With these consecutive down close candles, so we have a high, a low, a high, high, and these consecutive up close candles, which makes one order block. If we extend that out in time, plus this fair value gap, that's where your entry is. Just as New York opens, we have our opening price, we rally up, look at the bodies of the candles respecting that perfectly. At the same time, as we are coming back up into this level, we have an SMT divergence between the dollar index. So the euro failed to make a higher high, whereas the dollar index made a lower low. So again, at a time we were expecting low prices, because this was our low for our sell-side liquidity that we were reaching for. We're seeing SMT divergence. This is when SMT divergence can be used as an added confluence. You don't want to ever just trade on SMT divergence on its own. If we take the low from this candle and the high from this candle, because now this was a Judas swing, so we had cleared stops on both sell side and buy side, and this was a Judas swing that ran higher into our premium array in the higher time frame, as well as this fair value gap. So now all the buy side liquidity has been gone, and we broke market structure. So this becomes the fulcrum point from this low to this high. If we project this down, so we'll get 1, 2, 3 standard deviations, and this level that we get with 3 standard deviations is 99550. If we extend that out in time, we get 99550. And if I hover my cursor over this down close candle, and we look up here, so the low of the candle comes in at exactly 0.99550. So absolute precision. And notice, it comes exactly 45 pips below that 100 big figure. So between 40 and 50 pips is what we're aiming for. 45 pips below the low lines up with 3 standard deviations down, and we nail the low of the day. There are tons of things in this chart I could spend an hour just talking about, but I think I don't want to confuse too many of you. So the E-mini, last week, I said that we had this breaker, so from this high, low, high, high, we break below it. I was drawing your attention to this volume imbalance, and we had this order block. So we had again a number of nested PDRAs, and I said this could act as resistance, and we were likely to see the sell side liquidity attack below, because I had this as a market maker sell model. We didn't clear the sell side liquidity below this, but we did clear the sell side liquidity below the rejection block. We'll get into rejection blocks further on into the mentorship, but generally when I'm taking profits, I'm taking it below the rejection block, and I'm not waiting for the sell side liquidity to be run. There's reasons for it, but again, so we'll have to understand rejection blocks and it gets a little bit more complicated, but I'm looking for the low hanging fruit objectives. So the liquidity below the rejection block is something that I'm looking at. Where we currently are in price, I mean, we could still roll over and attack the sell side liquidity down here. If you look at the 3 averages, we haven't taken our sell side liquidity on the S&P, we haven't taken the sell side liquidity on NAS, but we have dipped below the sell side liquidity on the Dow Jones. So it'll be interesting to see whether these want to stay above the sell side liquidity and whether we do get some relative S&P divergence. And obviously, if that happens, we're not just taking trades based on that, we're looking for further confirmation on lower time frames to see if we're going to get anything. So to maybe see some buy side objectives like this fair value gap, maybe, but we'll look and see what happens. So ES, ES 1 hour chart, Monday, Tuesday, Wednesday, Thursday, Friday trading. So we opened on Monday, we dropped below, taking sell side liquidity, and then rally higher into that daily order block and that volume imbalance. On Tuesday, we open, rally above it, take out Monday's high, and then attack the sell side liquidity resting below this low. At the same time as this was happening, we made a higher high in the S&P, and we failed to make a higher high in the Nasdaq. So again, this was a cracking correlation, so it was valid S&T at a key higher time frame level, so we're at this daily order block low. And then we distribute those shorts to the sell side liquidity below these lows. On Wednesday, we open, drop lower into this order block, took out the lows made in Asia. This is typical for FOMC. We start moving higher. And we're not taking any sell side liquidity, we're just moving higher until FOMC comes in and we have this big whipsaw back and forth. We're not trading this. I've been burned way too many times trying to trade it. The rules are, by New York session on Wednesday, we want to be out. So, to be honest, I'm not trading anything on Wednesday. I'm closing out my positions on Tuesday. As you can see, we moved higher into this fair value gap on Tuesday's range. At the same time this was happening, we had an S&T divergence, so we failed to make the high high in the S&P, and we made the high high in NAS, and then price absolutely rolled over. We open up on Thursday, move higher, and rebalance all this fair value gap. This becomes now an intermediate term high as we rebalance, so all this price range is rebalanced. When we drop below and break market structure here, we have this fair value gap and the order block. We're not expecting price to come up here. So you put your entry at the low of this candle, and then your stop above the high of this candle. And again, as you can see, look at the opening price. You see how the bodies respect that a lot. So this is a really strong level. I always believe people should have the opening price extended throughout the whole day. On Friday, we open up small little fair value gap into this order block, and we really sold off on Friday. And really dug below that sell side liquidity resting over here and that rejection block that we see in the daily chart. So this low, the bodies of these two candles, and the body of this candle, this was the Judas before FOMC. We break below this low over here, so we have a breaking market structure. So this becomes the fulcrum point. This body is low to this body's high. We project the standard deviations down. 1, 2, 3 standard deviations, and again we nailed the low on Friday. From FOMC, we had a really big move down. So if last week's price action was a really big move, especially on Friday, we again had a really big move lower. Monday's price action, we're going to expect a seek and destroy profile. We're typically going to see consolidation after a large range day anyway. But on Mondays, this is why I don't really like to trade Mondays, because especially after a large range week and a large range day like Friday, with it being FOMC last week, this is typical. Just highs swept, low swept, low swept, high swept, low swept, high swept, back into that old low. This would have been the setup for the day if you traded it. You'd wait for all the choppiness to get out of the way during London, then we ran up back into that old low, and then we've seen a breaking market structure here in the market maker sell model, taking liquidity below this, and again dipping back down into the rejection block and taking out the low that was made on Sunday's trading. So it'll be interesting to see what happens. We cleared the board as far as Monday goes, both for buy side and sell side liquidity. So we'll again see what happens throughout the week, whether we want to retrace higher or not. Like I said, dollar index still looks pretty bullish to me, so we'll see how things go. Don't rush in and don't take any silly trades. Stick to your game plan. It's super important, especially in the climate that we're in, that you follow your rules. The worst thing you can do in these environments is overtrade. Wait for high impact news events. Wait for liquidity to be swept, and then enter the market. If it's really high impact news, give it at least half an hour on either side before you take any trades. Personally, I like to wait after news. It depends on the context and the narrative that's presented to me at the time, but most of my trades are after news. And then usually I can find a setup somewhere to work with. But again, low hanging fruit objectives. Don't overstay your welcome in these markets because they'll slap you about. So yeah, with that said, I hope you found this one insightful, and I'll see you guys again next week. Alright guys, welcome back. I hope you had a great weekend. Just before we start, I have to apologise because I created these slides on Sunday yesterday, and my intention was to record it. I'm going to try to get these videos out on Sunday evening if I can. But I had an emergency I had to attend to when I started recording, so depending on what time I end up getting this out, we may have already moved in terms of price. But with the daily timeframes and the teachings, it's still salient to what we're looking at. So we have the dollar index daily time frame. And last week we were trading with this candle. I said that I'd like it to touch that premium end of that fair value gap, which was on the weekly time frame. We had this order block volume imbalance and that premium end of the monthly fair value gap. So as you can see, we touched that on Wednesday, making the high of the week, and then we rolled over, targeting the monthly fair value gap low. We also have this down close candle, so we've got this order block with this fair value gap, so we closed in the range of this fair value gap from this candle's low to this candle's high. We've got consequent encroachment, so the 50% level of the fair value gap. We haven't really left any imbalances on the daily chart, so this all looks to be fairly balanced. However, because of this down close candle, the fair value gap, this is likely to go higher still from where it is, because there's a few reasons why, which we'll get into in a second. From this low to this high, we're at that 50% level, so inside of the fair value gap, so it's likely that we may see a day or two worth of consolidation in here before it leaves one way or another, so you want to be cautious over the fact that we could be in a consolidated market for a day or two. If we should break below this candle's low, so these three up close consecutive candles is one bearish order block, so if we break below that, we'll have a change in state delivery, so we may go into a sell program, and that might take us down into this fair value gap. If we get below that, and then we break this low because there's liquidity resting below here, then the next level that we're going to be looking at is this fair value gap. If we trade to it, through it, and then come back up, it'll act as resistance, and the next area that we're looking at is these relative equal lows with this fair value gap resting below it. So notice it's if this happens, then this is likely, and if this happens, then this is likely. So based on what the charts are presenting to us, there are certain key levels that we want to pay attention to, and whether these levels act as support or resistance is going to determine the likely outcome of where price might want to reach for. Personally, I still think that unless we break this low, because it's the last swing low in this leg, I'm still bullish on the dollar. I still like this weekly fair value gap, and I think we might want to trade up into there. We've rebalanced, obviously, this monthly fair value gap. We went higher, went lower. We closed above it, so this may act as support, and then obviously consequent encroachment, and maybe back up to these levels up here, but again, time will tell. The euro dollar. So last week, we dipped into the old low where we had sell side liquidity. We had the weekly breaker, so the bullish breaker. The weekly fair value gap, consequent encroachment. So the body's really respecting that nicely, which was between obviously the weekly premium end of the fair value gap and the weekly discount end of the fair value gap. We moved up above the volume imbalance, and this would on a lower time frame act as support, and that's taken us up into the premium end of this fair value gap from this candle's low to this candle's high, and again consequent encroachment. We seem to have rebalanced again in this area. We've closed below the premium end of the fair value gap. If we get any more weakness on the dollar index, then the drawn liquidity for euro is going to be this fair value gap. From this high to this low, we're around that 50% range. We've dipped into the premium side, but again because of this fair value gap being in close proximity to the 50% range, it's likely to consolidate here for a little bit before either going higher or lower. It's worth noting that on the 23rd September's high, we slightly poked above it on the euro dollar, but on the dollar index, that low that was created on the 23rd of September, we're nowhere near it, so this looks like it could be building up for that valid SMT divergence. So this could be under accumulation as we speak. This might consolidate and build up orders and then maybe shoot and aim for the weekly fair value gap and take out these highs. But again, we'll have to see how the week plays out. If we get above the premium end of this fair value gap, then we may want to see either consequent encroachment or the premium end act as support and then drive price higher. So keep an eye on the levels and we'll see how we play out throughout the week. So dollar index hourly chart, so we've got our day dividers delineated on the chart. So on Monday, we open up, move higher into the daily volume imbalance, find support at the premium end and the consequent encroachment, and then we dig again just below that old sell side liquidity. And if you remember me saying I wanted to see it maybe really dig deeper into that, we see that on the Tuesday, so we open higher, find resistance at that weekly fair value gap premium end and that daily volume imbalance. Again, I'll look at the price action around that old low. You want to keep the old lows. Normally what I tend to do is like, right now I have it delineated with this blue line. If we've traded through it, I tend to darken it out a little bit like a grey line, because I want to keep that level on there, because it's a PD array at the end of the day, so these levels are going to be obviously sensitive in the future. But when it's a blue line, this is like a fresh level, that's a fresh pool of liquidity. Of course, it isn't right now, but because we only sort of dipped through it slightly, I wanted to see that run below it, so this is raided the sell side liquidity below this low, and then we've obviously dipped into that weekly fair value gap as well, so there was a lot of potential here for a reversal midweek, which is what we've seen here on the Wednesday. We open, we trade lower. We have SMT divergence with the dollar index over here. I'll leave that one for your studies. The sell side liquidity was taken over here, and the last down close candle after we took sell side liquidity is this down close candle. This is the order block, and then we break and close above the high of that down close candle. After closing above this order block, we create these two down close candles and then break market structure. These two down close candles are going to be a propulsion block, and from the high to the open, it's going to be extremely sensitive. As price dips back into that level, look at the reaction that we see from there. This reaction, we break market structure over here, and we have a short-term high to the left and a short-term high to the right, so this is an intermediate-term high that gets broken. This is a significant break in market structure. After we break an intermediate-term high, we retrace, so from this low to this high, we got the 50% level. We dip below that into this fair value gap, So we have a low, high, lower low, and we break back above that high. The last up close candle in that swing is going to be our breaker. So we have our bullish breaker over there, which overlaps with our higher time frame weekly breaker. So this green dotted line, this overlaps nicely with our weekly fair value gap. So there's a lot of nested PD arrays in this area. We break market structure over here from this low to this high. We again dip below that 50% level. We find support at the daily volume imbalance, that premium end. We have this low, high, lower low. So similar fractal to what's going on over here. We have this last up close candle as well. So again, a lot of support. And then obviously price takes off. We have these last down close candles as your order block. We break above it, and when we come back down, we can create another order block after we've created our initial order block. This is again that propulsion candle that we've seen over here. So after dipping into the propulsion block, we rally higher, and then on Friday, we take out these equal highs, we just about dip above it, and raid Thursday's high, and then drop lower. From this low to this high, this is our TGIF trade. So we're looking around a third, so 33% of that weekly range created is the retracement that we expect on Friday. So I'll leave this one for your own studies, but it's quite a nice little setup on Friday that takes us into this fair value gap, which overlaps with that 33% level, and this old intra-week high. So again, we see a lot of overlaps over here to confirm that TGIF trade. E-mini. So last week, I said that we may dip into this area and then potentially go lower. We did it there on Tuesday, where we slightly dipped above it and then rolled over and just dipped below that sell side liquidity. But again, it's a shallow run on both sides. On Wednesday, we see it a lot more meaningful, where we tap that consequent encroachment level of this fair value gap, and then we roll over and go lower. And then on Thursday and Friday, we really dig below that sell side liquidity, tapping a monthly fair value gap premium level. So we hit that quite nicely. Our next downside objectives, we have this monthly fair value gap, so we might want to dig into this. And we have this weekly volume imbalance. So over here, we're currently below market price. This might be something we want to trade to. So we'll see how things pan out over the next few days. We might want to retrace a little bit higher. We obviously have this order block that we already dig into, and we fail to go above the mean threshold of this. So we have this little fair value gap still left over. Again, by the time you're watching this video, this might have already been traded up into. We obviously have this old low, we've got this order block, and we've got this little fair value gap. So we might trade into that and then go lower, digging deeper into this monthly fair value gap. As a longer term objective, we're looking at this weekly volume imbalance. But it might not trade there as a straight line, like I said. We'll have to see how things work out. But from where it is, it looks more bearish than we are bullish, if I'm being honest with you. So the hourly chart on the E-mini, again, our day divider is delineated on the chart. So Monday, we take out our intraday high, and then we roll over and attack the sell side liquidity that we created on Friday's low. On Tuesday, we open, rally higher, we find resistance on the old daily low and the discount of the daily fair value gap, and then we drop and dip below that old sell side liquidity again, and then consolidate between that old low and the rejection block. On Wednesday, we open, dig deeper below that sell side liquidity, and then rally higher, and we can see another order block formed after our initial order block, which is going to be our propulsion candle. As you can see, look at the reaction that we see just from the high of that candle, and then rally higher, attacking the relative equal highs made at the beginning of the week into the daily fair value gap consequent encroachment area. Consolidate a little bit. On Thursday, we drop lower. There's some SMT that we see between the averages, and again, drop lower, digging below that old sell side liquidity again. So we really attack and digging into that sell side liquidity. And then on Friday, again, we open higher, order block, take out these relative equal highs, and then we roll over and touch that monthly fair value gap, the premium end, taking out all the sell side liquidity made intra-week. I mean, realistically, we've got a seek and destroy profile over here. When the market's doing this, you're just seeking liquidity, highs and lows. So going forward in the week, I'm still potentially looking for lower prices on the E-mini, and especially since the dollar index could be, again, under institutional accumulation, and that doesn't really bode well for the stock, so again, we could potentially be going lower. This is Thursday's price action. I'm going to zoom into and show you a little bit of precision elements. We have our 8:30 news embargo, our 9:30 opening price, so I always have these delineated on the chart. Prior to 8:30, we had these relative equal highs. Now, we had SMT divergence before the opening price, so this is tipping us off what was likely to already take place after the news was released. As you can see on the NAS, we failed to make that higher high, which can be seen on both the Dow and the S&P. So this was tipping its hand prior to the news. Once the news was hit, we obviously seen this displacement breaking market structure to the downside. Between 8:30 and 9:30, we rallied higher and came into this 5-minute order block. And from this candle's high to this candle's low, we dip above those highs and then break below it. So these consecutive down close candles are going to be our breaker, and we traded around 50% level of the breaker, which overlaps with that 5-minute order block. Just zooming in, so these 3 up close consecutive candles on the 1-minute chart is that order block. We also have this BISI and this SIBI, so they overlap creating that balanced price range, and we hit exactly the discount end of that balanced price range, so ridiculous precision on this one. Just after the opening bell, again we have the SMT divergence between the averages. I'll leave that one for your studies. So after 9:30 opening, we see this SMT divergence and we see this displacement which breaks market structure over here, leaving this fair value gap from this candle's low to this candle's high. Also, this high to this low, and then we break above this high. Once we go back down below it, we've got this breaker, so these last 2 up close candles is our breaker, which is nested inside of this fair value gap. This is when we expect IOFED. Retail traders are going to think this is support, broken turn resistance. The algorithm isn't even permitting it to go higher, and this is where we have IOFED. And obviously we sell off another little IOFED over here, and again roll over. How low can we go? If we take the bodies between 8:30 and 9:30, so this is the lowest body here, 36,850, and this is the highest body over here, 36,999 and 3/4, and we project standard deviations of this range, we get 36.32 even, so we just slightly dip below that during the AM session. And then in the PM session, 36.22.5, we actually nailed it very low on this candle. We slightly wick below it on this, but still very, very precise. It's interesting to see this was an old daily rejection block and see how the bodies of the candles respect that nicely before going lower. I would have traded this because we're in the lunch hour, but let's do some standard deviations on a weekly range. So this is Monday's trading. So if we take our highest body and our lowest body and project standard deviations of this range, this can give us an indication of like weekly targets. So this first deviation is half of the deviations projected from this high and this low. If we project another half a standard deviation of that, so we get 0.75 standard deviations, we get 37.51.5. So we're actually 0.25 off there, which is again really, really precise. If we project 1.25 standard deviations of again this range created on Monday, we get 35.96 even, again 0.25 off the actual low. So very, very precise. It's worth looking at Monday's range to predict the high and low of the week. You can also do this for the FX market as well. I like to look at Monday's range just to give me projections of like a sort of a roadmap of where prices are likely to go. You're obviously going to have a lot of different confluences. Like we have this monthly fair value gap, which is bang on 35.96. So this was obviously a level that I was looking at all week. And again, ICT would have looked at this level when he did his standard deviations on the Friday range. It comes very, very close. So there's an overlapping effect, which is again why he knew this was likely to come to it. You don't need to get this precise, right? You just want to catch the lines portion of the move. I'm nearly 5 years into this versus ICT's 30 years. So I'm learning the precision elements, but I've stung myself far too many times trying to get to the absolute point, and you just want to get the lines portion of the move. You want to take your chunk of flesh and be out. I just use these as guidelines. So I had a few questions of people thinking I'm going to get in and out at the exact highs and lows. No, I don't do that. I just use them as reference points, and I don't think anybody should try to be this precise. Over time, yes, I'm hoping that I can reach that sort of precision where I can see it beforehand and then have the balls to really stick and hold the trades. I'm not there yet. I know that I'm throwing a lot of information in these videos, and they're really concise and packed with a lot of information. And I know that there's a few people who are really struggling to absorb all of this. This is going to take a while. You're not going to suddenly be able to learn everything overnight and apply all of these things to your charts. Every week when you sit here, I'm just trying to help you train your eyes. And eventually over time, you'll start seeing these things yourself. Try not to get disheartened if you feel like you're not getting this straight away. This is a lot of detail. And like I said, it's taken me a very long time to get to the stage anyway. So the key to this is just trying to do a little bit every single day. After a while, these things will start popping out of the charts and you'll start noticing things yourself. And that's really the key to this mentorship, is to help you train your eyes. So with that said, I hope you guys found this one insightful, and I'll catch you guys again next week. Alright guys, welcome back. I hope you guys enjoyed your weekend. So we have the dollar index, as you can see what transpired over the past week. If you recall from last week's episode, I said if we get below this candle, then the next area was this fair value gap that we'd be looking to target. And obviously if we got below there, then we were looking, the lows over here in the volume imbalance. When we came down into this fair value gap, we balanced it and moved away from it. So that offered us quite a good support, coupled with the bullish breaker that we'd already highlighted, and the fact that it was still more bullish than bearish on the dollar index. We've seen a midweek reversal when we turned. We obviously had NFP last week, and the initial move from Monday, Tuesday, we dug down into that fair value gap, so we closed the imbalance, found more support at the breaker, and then again, we move higher, which is typical of NFP week. You're going to get the move in one direction, which is going to be a Judas. NFP can, a lot of the times, create the Judas swing for the month, so I'm expecting the monthly low to be in place now for the dollar index, and I'm expecting higher prices. We got back above the volume imbalance, and then if you go into the lower time frames, you should see we found support, and then traveled higher, so it's a good study for yourself. Also that order block, if you go down to the lower time frames, see how we had some entries around the order block, and we had a few decent setups around there as well. We have the mean threshold of these up close consecutive candles, so I'm looking to get above the mean threshold, above the premium end of the daily fair value gap, so below this candle. And I want to find support, and then again monthly consequent encroachment. We did close above the monthly fair value gap at the discount end and found support on that as well. So I'm looking for higher prices at the moment. Just to zoom in, we've got these last two down close candles, so we've got our bullish order block that we closed above. We may want to see it retrace maybe a little bit, dip into maybe the wick area, and we have like obviously the fair value gap that's been left open. We might not even want to do that again. We have this old area of distribution, so that'll become accumulation. I'm really looking for the buy side liquidity above here and get above the premium end of the monthly fair value gap, which is this black line, then potentially dip into the weekly fair value gap that we've had on our charts now for a couple of weeks. So I'm bullish dollar still, like I said, I don't want to call the top in this market at the moment. So euro, last week's price action, as you can see, obviously further downside in the dollar index, which allowed euro to reach its premium fair value gap. We also just came short of the 100 big figure, so this is going to act as quite stiff resistance for us. We balanced the price range, we went through it, then came back down and closed below the fair value gap, so that fair value gap was going to offer us resistance, so we dipped back into it, and then obviously the rest of the week we rolled over. Got below the consequent encroachment of this fair value gap. So I'm really looking, again, back through this daily volume imbalance and potentially these lows down here, and this is the discount level of the monthly fair value gap that we still left open, so we have sell side liquidity resting above that level, so I'm still looking for potentially more downside on the euro, especially if we do keep going higher on the dollar index. The British pound, we obviously had this massive sell-off, came back. We found resistance at the monthly volume imbalance, so we kind of rebalanced that, so this was like a balanced price range, and again found resistance, and then traded back again through the lower monthly volume imbalance. I should have really pulled that up onto the chart, but you can check this out on the monthly time frame yourself. From this range low to this range high, we're around the 50% level, and we also have this balanced price range below us. In all honesty, I'm not 100% sure what the pound looks like it wants to do. I don't really trust this pair at the moment. I haven't traded it for a while, and ICT again hasn't traded this for quite a number of years now actually, because of moves that are happening like this. So we're still between this high and this low, so we may consolidate as maybe the euro runs lower. E-mini S&P, so we had this volume imbalance, and we had this volume imbalance. When you get two volume imbalances that overlap, you should expect that to act as a balanced price range as well. As you can see from last week, we retraced higher than I thought it would be, to be perfectly honest with you, but nevertheless we ended up back into that volume imbalance, and then we sold off, closed below the rejection block over here, and took out liquidity resting above this high, rebalanced this fair value gap, and we obviously gapped lower. We've already dipped into the monthly fair value gap. We may want to come back down, take the sell side liquidity and close that. As a longer term objective, I'm noting the weekly volume imbalance still on the weekly chart. From this range high to this range low, we obviously dipped into the premium level, so we went back into that volume imbalance. So from the highest closed candle to the lowest closed candle on this range, this is an old area of accumulation. And when you come onto the right side of the chart, so the sell side of the chart, this area, which is old area of accumulation, becomes a new area of distribution. So I dub this as a distribution block. ICT has never mentioned a distribution block before, so this is the first time you will be hearing it. A distribution block is going to be an old area of accumulation on the right side of the curve in a market maker sell model. and we flip that around if it's in a buy model, and an old area of distribution becomes a new area of accumulation, and I dub that as an accumulation block. I'll give you more examples of this as we go, but we have this area, so we've got this volume imbalance between these two candles, and we also have this balanced price range. Within the balanced price range, we've got this old low, and we also have the discount end of this fair value gap. So a few nested PD arrays in here, of course, with the order block. So we may want to see a retracement into these areas. It might come up as far as this volume imbalance as well, to be honest with you. We have this high, low, higher high. We're currently sat inside these two up close candles, so we're inside of a breaker block. So we may get more mitigation around this area as we retrace and then go lower, filling the downside objectives on the higher time frame. Bitcoin, I had a few questions about Bitcoin to see if I could do some analysis in there. Again, bearish, like I am with everything else. We had this balanced price range on the weekly, and we tapped into consequent encroachment, filling in some of this imbalance. The body is really respecting the discount end quite nicely. Then we obviously sold off. We've got sell side liquidity below this low and this low, and we have a fair value gap down here. So I expect still more downside, potentially below 15,000 from where we're currently at. To zoom in, as we came to the consequent encroachment of that weekly balanced price range, we dropped below this last down close candle. So this becomes our order block, change of state of delivery, displacement. We come back up into the order block, rebalance a fair value gap, and again break lower, taking out the sell side liquidity below this low and this low. So we have these relative equal lows. This is a very shallow run for me, and obviously we have some more laid liquidity in the form of this sell side liquidity pool too, which also rests above the weekly fair value gap. So I'm looking at the mean threshold of these two up close candles. We're also inside of this distribution block. So again, we may be mitigating orders, pairing orders, and again running sell side and then rebalancing. So I'm still bearish longer term for Bitcoin at the moment, unless anything changes. We'd have to get back above this high. And then we want to find support back above the balanced price range, so around 25k, 26k. Anything below there, we're still bearish, and this is my objective for downside targets. So let's get into the euro dollar. So this is last week's trading on the 1 hour time frame. So as you can see, I've already got the levels marked up, and nowadays will be delineated. We have that daily fair value gap. That was the initial draw if we had any more downside movement on the dollar index. As you can see, last week we moved up into that area. Our old low, these red lines are our daily fair value gap. So we have the premium end, consequent encroachment, and the discount end of that fair value gap. You can see we found support quite nicely around here. So it's important that you have these high time frame levels on. I normally trade with naked charts, but I still keep the daily time frame levels on. I think it's super important. Again, most of the institutions are looking at the daily time frame. So if there's any time frame that you really should focus on, in my opinion, it is that daily time frame. So Sunday's trading, we had these lows, so put the sell side liquidity below that. We ran that sell side liquidity and dipped into the consequent encroachment, so 50% level of the daily fair value gap. We found support there, just refused to go lower. And then we broke market structure above this high. We retraced down into this last down close candle that took sell side liquidity, so this is our order block. Inside, we have obviously our fair value gap, which is also a balanced price range, so we don't expect it to fill. So from this low, high, low, low, then we break back above it, so this last up close candle is our breaker. And from this high to this low, we went below 50%. So if you look at what our model is in the academy, it's pretty much textbook in here. And obviously incorporating other things like the balanced price range, narrative, order block theory. This is where we start getting into details of how we can apply those concepts into real life charts with a narrative behind us. If we're expecting, okay, this could be a draw on liquidity because it's a high time frame fair value gap, and we're seeing weakness on the dollar, this gives us an insight into where the number one the market is reaching for. We can start breaking down that PD array hierarchy. So really nice setup in here on Monday. I didn't trade this because I don't trade Mondays, but because it's NFP week, ICT tells us that we want to move to the sidelines by Wednesday New York session. If you're still in a trade, then you can manage that trade but no new positions. So some people like to trade Monday, Tuesday when they know that it's NFP week. I'm busy doing these slides, so this takes my priority on Monday over trading. I am going to try hopefully moving them to a Sunday at some point, but I'm really detailed with these slides and it'll take me a long time to do. So I have to spread it over a couple of days because I want to give you guys as much value as I can. And I do hope you guys are getting value out of this. I've had a few people leave the mentorship this week simply because they're finding it far too difficult and hard to follow. So if you're still here, congratulations. You can give yourself some credit because this mentorship is going to filter out the week, and there's no other way really I can say it. This is not easy. It's going to take you time. You're going to have to put the work in there, and the people who are putting in the work love this. They follow it and they're learning so much, and the growth that I've seen from them is incredible, to be honest. So I'm glad that I'm being able to at least guide some of you in the right direction. But stick with it if you are struggling. I promise you, the value that you're getting in these videos, and especially people who have got experience with ICT concepts for a number of years, will tell you that this is exactly what you need, this is what you're looking for. There's one thing understanding and knowing ICT concepts, but to apply them is a whole other story. The way I'm trying to deliver this mentorship is a way I hoped ICT would have taught it, where I am giving you the extra details, I'm cutting through the candles, and yes, it's sometimes repetitive, and I appreciate it's not easy to follow, especially when you're new, but the more you stick at it, the more this will train your eyes. So that was just to answer a couple of questions I had again about people struggling to keep up with the content. Whilst you're watching these videos, you should all be taking notes and writing down questions that you have. All the questions I see in the mentorship chats that I get DM'd, and there's a whole lot that I get. And sometimes my inbox is so clogged that I can't get through all the messages sometimes. But what I'm doing is I'm noting down all the questions, and I'm trying to answer them through the mentorship teachings. So there's, like I said, there's a lot to still come. Anyway, I digressed a little. So we have this old low, and how did we travel through that old low? We left displacement. So this is an algorithmic signature that indicates prices rushing to go higher. If you look on the other side, how do we trade back below it? So again, with displacement. This is a little thing I learned over the years, is when we have old highs and old lows, seeing signatures like this is going to give an indication of what IPTA is looking to do, what it's searching for. And again, if you see displacement through key levels like big figures, institutional figures, 20, 50, 80, 00 levels, that gives an insight into what the algorithm is trying to reach for and if price is in a hurry to either reach premium or its discount arrays. So it's worth noting. This was the daily fair value gap. So we ran through it and then came back down through it. So this became balanced. We went up, we went down, and then we shouldn't need to go back up to the premium end. So this will act as resistance. On Tuesday, this candle's high and this candle's high. We had an SMT divergence between the dollar index. And we've seen this break in market structure at the same time. So we've seen displacement through that. Again, this is another algorithmic footprint. How did price trade below these lows? As you can see, it held it in consolidation. We ran up, cleared the buy side liquidity, SMT divergence, and then we ran right through it, leaving this balanced price range. and as you can see, we had institutional order flow entry drill. Didn't need to go all the way back up to fill this fair value gap, because retail are going to look at these lows and say, okay, these lows, they've been broken, so this should now be support turn resistance. We don't even give them the opportunity to get in. So we know that we have a balanced price range. We have old lows that are sitting above market with displacement. We're not expecting price to fill here, so this is your institutional order flow entry drill. And as you can see, price rolls over, closing in the remaining of this fair value gap and dipping once again below the old low. So we have a market maker sell model over here. So this is your initial consolidation. And there's going to be plenty of examples of this, but I'm just going to really introduce this concept. Again, this is something that ICT hasn't taught. It's something that I've, over the years, picked up on it. So we have our initial consolidation over here, mainly because of the bodies of these candles. This is something that you'll just pick up over the years, where you can start recognizing in the initial consolidation areas will jump out to you. But this is how I define the initial consolidation in this market maker sell model. We left the consolidation here and dipped back into a macro price point within that consolidation, which is a higher time frame level on the daily, so that premium end of the fair value gap. So for me, this is the beginning of the buy program, right? So if I run my fib from this low to this high, this is a part of grading price swings. Now we'll get into more detail later on in the mentorship, but again, just introducing this concept over here. From this low to this high, we have that 50% level. What do you notice at that 50% level? We have this fair value gap right in the middle of that 50% level. We took out the lows here, we took out the highs here, so this dealing range is extended. Now, in this 50% area with this fair value gap, on the right side of the curve, I'm expecting some form of a bullish or a bearish order block, depending on what narrative is going to tell me. Now, because this was, in my opinion, the Judas swing for a week prior to non-farm payroll, we find this down close candle within the 50% of this dealing range within a fair value gap. So this order block now becomes higher in probability. As we break below this, we need displacement. We have buy side liquidity near its vicinity, and we also have the higher time frame balanced price range with this daily fair value gap. And also, from this high to this low, we've come back into the premium end. So a few things over here that have overlapped. So this should give us stiff resistance. And as you can see, the following Thursday, price rolled over. Displacement, order block fair value gap, institutional order flow entry drill, also finding resistance at that daily fair value gap, the premium end, and then we roll over and attack the sell side liquidity underneath the initial consolidation going into Friday. So let's zoom into Wednesday's price action and see a little bit more precision elements. So I had a question about turtle soup entries and how do we time turtle soups? Turtle soup entries are buying above all highs or below all lows. Now, they are the hardest entry pattern that you can have. It takes experience. And normally how I trade it is I'll put a small position on and then wait for breaking market structure and put the majority of my position on when I've got more confluence and confirmation that the market's going to go one way over another. We have sell side liquidity that's been taken here, and we have sell side liquidity, which was the Asian lows, which were made earlier on in the day. We dip below that, and then we start consolidating, right? Now, I'm trying to find my initial range and my initial price macros that IBDA is going to refer to for standard deviations. It's a part of the IRD concept that I'm using. We took out sell side liquidity, and then from this range high to this range low, we ended up staying in a consolidation, and we moved above it here, but it was prior to the London open kill zone, right? So I'm going to extend my dealing range from the lowest body candle to the highest body candle prior to the London open, and that's going to give me this candle's close and this candle's open, right? So from this low to this high, we have this is one deviation that we project upwards. So one deviation going higher, where does that take us? Well, number one, above the buy side liquidity pool. So this is a good area for a turtle soup short entry. We also have 15 pips above this high that was created prior to the London kill zone. So remember, time and price should align, and we get one standard deviation above those highs, which is also 15 pips above this high. That's a turtle soup short entry. Now, if you want to drop a little entry in there, that's fine if you've got the confidence to do it. I like to see a retracement lower, or I'll catch a smaller time frame fractal. And as you can see, that Judas swing going higher, taking out the buy side liquidity, was created in London, and this was the high of the day. We can see that we had a breaking market structure over here, which left displacement. So how do we break below these lows? We left displacement in the form of a fair value gap. Because we close below these lows, we don't expect price to go higher and fill in this fair value gap, because again, retail are going to look at support turn resistance. We don't give them the chance to get in. So this is our institutional order flow entry drill again. If you decided to enter here, it's still within the London kill zone, so this would have been an entry. New York kill zone. So if we had the high in London, New York's going to give us a continuation. And as you can see, took the initial high that was created. We drop lower, breaking market structure, leaving the sell side displacement. We come up to rebalance that fair value gap and dip into this order block, and then price again sells off. We also have from this high to this low, we have our optimal trade entry. We could see that we were forming this phantom trend line as well prior to the New York open. So the sell side liquidity was initially ran first, and then with the displacement moving higher, optimal trade entry. We also have this high, low, higher high. We break below it, so we have a break. We're also inside of a breaker. So a number of nested PD arrays over here, which would have got us short, with having London behind us, and having a sell side liquidity objective below. So a few confluences again. How low can we go? We get the low of the day over here in London close. So 7.5 standard deviations of that initial range that was formed below the London open, we get pretty close. So when time and price align, this gives us a decent guide. But to find more confluence, if we take that initial low in the New York kill zone and we anchor a fib from the low to the high that was created in this optimal trade entry that gave us our setup, which rebalanced and dipped into our order block, so this is going to be a key swing, and we project that 2.5 standard deviations down, and we project that out, we get 98, 36 and 4 pipettes. The open and the close of these two candles come in at 98, 36 and 4 pipettes. So again, really, really precise and overlapping with the 7.5 standard deviations of that initial range. With time, you get time aligning with price, and you can get your almost very low to the day. We went through that slightly, yes, but again, algorithmic. So I hope you guys found this one insightful. I'll be building on a lot of these concepts as we go. Like I said, I know this is a lot to take in, and I'm probably doing a disservice to myself by being so detailed, because there's a lot of people who are leaving the mentorship, but no disrespect to those who can't keep up with this. There's a lot of free information on YouTube, or there's other courses and indicators, and if that's what you want to do, then that's what you want to do. I'm not saying you can't make money with any other concept. ICT, I think, that just stands on its own, and in my opinion, it is how the markets book is the absolute truth. But People do make money with other strategies and indicators and good money management. That if some people just want that, they want the easy way of doing it. But you're in the hardest industry in the world with sharks swimming around you, and if you really want to be consistently profitable in this game, then you've got to put the work into it. For me, I wanted to make sure I knew what I was doing, and it was practice and backtest and forward test and journal, and a lot of it's not being easy. Especially trying to juggle your family life, your personal life, and businesses. And I know there's quite a number of people in here who have, family, spouse, kids, and it's something that I really still struggle with. And the way I look at it is, I don't care if this is going to take me 10 years to get it. I'm going to be consistent at it. And the best advice that I can say is, don't force this. Put your main priority should be your family and stuff. And I understand that learning how to do this and becoming successful in this is a part of taking care of your family. And don't get me wrong, I fully appreciate the fact that you've got kids and mouths to feed. I was prepared to spend 5 years without earning a penny to get a degree so that I could get a job in a profession. 5 years without a penny. So when you're coming into the hardest market in the world, which can also be one of the most lucrative things you can ever do, you have to give this at least 5 years. And that's an honest opinion of mine. People can do it earlier, of course. I've seen people who have really smashed it with ICT stuff and they're making money. And don't get me wrong, there's people who, you don't even need to go this detailed to make money with ICT. You can get a few concepts, a few moving parts, good money management, and you can make it work. But I want a pyramid accounts, I don't want to, the number of sales I can get within one swing. I don't need to work hard with it, but eventually it'll come to you. Anyway, I hope you guys found this one insightful. I'll catch you guys again in the next video. Alright guys, welcome back. I hope you guys enjoyed your weekend. So this is where we currently are on Sunday, and depending on when you watch this video and when the editing's done, we may be into Monday trading, so we'll see how things go. From where we currently are, we have obviously still the buy-side liquidity above this high, and that weekly fair value gap that we may still want to push into. We've obviously had quite a decent run up from the balanced price range where we found support, so we're in quite a high premium level over here. We've obviously found support on this accumulation block a couple of times, and obviously we closed in this fair value gap, so we found quite a decent amount of support around this area. The current range what we're looking at is the buy side above this high, and the sell side liquidity below these equal lows. Now, we also have this fair value gap that is sat beneath these equal lows, inside of this order block, and obviously our accumulation block as well. We also have the discount end of the fair value gap. We may consolidate in this range for a few days, because we have obviously this buy side imbalance, and then we repriced, we redelivered, and we've rebalanced. So, do we need to come back down into this fair value gap? Because we've got that sell side liquidity, it looks like it might want to gravitate towards it before going higher. We are from this low to this high in a premium range, and we also have that fair value gap with those equal lows sitting at a discount level. So we've rejected from the consequent encroachment of the monthly fair value gap, so these two levels. So this looks like it could act as a draw short term, and then we assess once we get there. If we close below that, and then we've got the mean threshold of these two down close candles, this is the one I'm really looking at, then we might want to attack the sell side liquidity below these relative equal lows, and then down here. But from where we're looking at, it might just want to dip into this and then potentially go higher. I'm not calling the top on the dollar at the moment. However, there are a few things that we should all be noting and maybe use for our own personal study as we're going forward. We have the 5-year, this is the yield price versus the dollar index. Now, the bond price and the yield price are inversely correlated. So as bonds are decreasing and going lower, yields are going higher. Now, the dollar index, it follows yield price. So as the bonds are going lower, the yield is going higher, and the dollar index is going higher. So the dollar index and the bond yields are correlated classes. Now we can see, this is on the daily chart, we have quite a big divergence between the yield and the dollar index. Although the actual bonds, so we've got the 5-year, the 10-year, and the 30-year, these are all posting lower lows, so we are in a bearish climate for the bonds. But interestingly, it's worth noting that we posted a higher high on the 30-year, whereas we failed to post the higher highs on the 5-year and the 10-year. So this could suggest that we may be going further down in the bonds, and if that's the case, then the dollar index could potentially reach for higher prices. This is a monthly chart on the 5-year. As you can see, we cleared all these relative equal highs, and then we absolutely nosedived. So this is a huge, huge sell-off. It's just been going straight down for months, had a little bit of a retracement. We obviously had this balanced price range we stayed in, and then we've tanked. We've got this buy-side imbalance, and then the sell-side imbalance. We have this wick and this wick, so this looks quite nicely balanced to me. And we're mid-month, so this looks like this could have posted the high of the month. This yellow line is a current low, so where could we potentially reach? This is just on the left side of the chart, so I'm zooming in. We have this old low, and we have this buy-side imbalance, sell-side inefficiency. Why is this a buy-side imbalance, sell-side inefficiency, and not a fair value gap? The fair value gap was from this candle's high to this candle's low, so that was the initial fair value gap. We dug into that fair value gap with this candle, right? So that wick, we wicked right into that fair value gap. The remaining portion of this area is known as a BISI. This is how we categorize a BISI in a fair value gap. There's certain rules for each of them, and timing element plays a role as well, but we'll get into that further on down the road. So they might want to fill in the remainder of this buy-side imbalance, sell-side inefficiency. We also have this volume imbalance between these two candles. We're inside of this larger order block, so all these down close consecutive candles is one order block. So around the mean threshold of that, we also have this imbalance. If we get below that, then we have the sell-side liquidity resting below these relative equal lows, which sits above this buy-side imbalance, sell-side inefficiency, because we've wicked into it already over here. So this could act as a longer-term draw for the bonds, and if the bonds are going to be drawing lower, then again it can make a case for a higher dollar. I mean, there are other factors that we obviously have to consider, especially the SMT divergence between the bond yield price and the dollar index. I'm not calling the top, but like I said, we want to keep an eye on it. If we're going to get further downside, this is going to be the draw for me. And if the bonds are going to gravitate towards sell side, that's going to give upside potential for the yield, which in turn is going to give upside potential for the dollar. So we'll see how things go. Because there's no major divergence between all three of the bonds and the yield prices, the higher low posted on the dollar index might just be a pause for a continuation and move in sympathy higher with the yields. So like I said, that little fair value gap on the dollar index, it might want to dip into that before continuing higher. So we don't want to rush into anything, especially in this climate that we're in. You have to appreciate the risk. If you listen to ICT's last Oh, he has a few rants, doesn't he? It was one of his Twitter spaces, and he was talking about the volatility of the CPI numbers that came out, and he hasn't in 30 years seen that kind of volatility. So we have to learn from his experience and respect the level of risk that we're in. We're all at a stage where we're continuously learning, myself included. So if somebody with a lot more experience than us, who is the author of these concepts, is telling us to respect the risk, we should respect the risk. Saying that, I did trade CPI, and I'll get into that in a minute. But so the euro dollar, we've pretty much stayed within this daily fair value gap from this candle's low to this candle's high. Should have extended that out. On Thursday, we dipped below and swept the sell side liquidity, and also tapped the premium end of the monthly fair value gap. From where we currently are, we still have the fair value gap sat above. We may want to reach into that again. We'll have to see. It's worth noting that we posted a higher high for the euro, and we failed to post that lower low on the dollar index. So SMT divergence here, and we are at key level. But this alone isn't enough for an entry. We may well want to dip back into the fair value gap before potentially going lower. If we do get any more sell side delivery, then the sell side liquidity below this low, and the remainder of the monthly fair value gap. So because I'm not calling the top in dollar, I'm still more bearish than I am bullish on the euro right now. If we were to get back above this high and above the 100 level, then that would put any bearish ideas on hold for the short term. British pound. So I said we'd likely to consolidate between these areas. We did go down and tap into the balance price range and fill that, and then found resistance on that monthly volume imbalance order block. So we may want to just, like I said, continue to consolidate in here while the euro is permitted to go lower. If that's the case, we do have these relative equal highs over here, so we might want to dip up into that area. Like I said, I don't really trust what's going on with the pound right now, so we'll keep an eye on how things play out over the next coming weeks. The E-mini S&P. So last week I said that, and I highlighted the volume imbalance on the weekly. Now, I'm not going to lie, I didn't think we'd get that. I had this as a longer term objective. I did think that we were going to most likely gravitate towards taking this low and filling in the monthly fair value gap, and then as a longer term objective into the weekly volume imbalance. And I didn't know we had this area that we were likely to trade up into, and the balance price range, where we had the discount end of the daily fair value gap, so this red line, which was an old low in there in a few of the nested PD arrays. Where we go from here, if we're looking at any downside objectives, I'm looking at the mean threshold of this wick, so this would be a draw on liquidity for me. If we manage to get below that, then again, we'll completely close in that volume imbalance and potentially go even lower. Again, this comes down to what's going on with the bond market and the strength of the dollar index, so it's why we want to pay attention to intermarket analysis. We may still want to come up and close in this volume imbalance. We have 1, 2, potentially we could have 3 drives higher, clearing out all the sell side liquidity. People are going to be trailing their stops, so we may want to dig into that one more time. It's less likely from where we are, to be honest with you. I have this volume imbalance here, which I should have noted really. So price might want to get up into there and then go lower. If that becomes support, then you're looking at the mean threshold of this candle, and then potentially above here into this volume imbalance as well, and the consequent encroachment of that daily fair value gap. So there's a few possible draws on both sides of the market at the moment. So again, really cherry pick your setups, and don't overstay your welcome in this current climate. Oh, I did know the volume imbalance. We also have this high, low, higher, high, and these last two down close candles is going to be our breaker. We respected the high end of this breaker, so we haven't gone above it, so that looks promising for more potential sell-side delivery. I'm watching this volume imbalance first to see where we go. It's likely that we might trade back up at least into there as a draw. We'll see how we open up on Sunday as well to see if we leave any gaps. If we do leave a gap, we may want to come up there, close it in, and then that'll act as either support or resistance one way or another, and then that'll give us some indication of whether we want to reach for buy-side or sell-side liquidity first. So, euro-dollar, 1 hour time frame. This is last week's price action. So this is a good little study for liquidity runs. Now, the fuel of the market is liquidity. Right? Nothing moves without liquidity, and the algorithm is designed to seek this liquidity. It's how they make the money. Now, what we've seen over here on Thursday, from hindsight, we can see obviously the CPI numbers that came out, and we cleared the board. But notice what we were doing prior to these numbers coming out. The market was being held mainly in a range, right? So we had the London low that was created on Monday, and we ran that first. Then we had the New York high, so this is our buy-side liquidity, and we ran that on Tuesday, coming into this little fair value gap. So what does the algorithm do? It seeks liquidity, and it rebalances inefficient areas of price. So when we came up on Tuesday and took out buy-side liquidity and rebalanced, there was nothing else over here that I could see that needed rebalancing. Yes, we had this little trend line over here and buy-side liquidity resting above that, but in terms of any imbalances or anything, this had been sufficiently balanced. So the next area of liquidity was down here, and we ran that liquidity on Wednesday. The next area of liquidity, after we run the sell side, was the high created on Wednesday. On Thursday, prior to the CPI news releasing, we had cleared the buy-side liquidity and then rebalanced the remainder of this fair value gap. So we had the sell-side imbalance, buy-side inefficiency. We tapped that and then ran the sell-side liquidity below these relative equal lows, tapping that monthly premium end and dipping below the old sell-side liquidity, which was an old daily low. So after we ran the sell-side liquidity below this old low, the next area of buy-side liquidity was above this high, because retail traders would have trailed their stops, and when they see this massive move down, they think it's going to keep going lower. This is again engineering liquidity, and the market reverses, attacks the buy-side liquidity above this high, and these highs over here. We retrace down one more time, IOFED, and then run this high, and tap into the premium end of the daily fair value gap. Now we've reached a higher time frame macro level, after we've cleared all the stops. So the objective for the week has been done. We've cleared liquidity and rebalanced. So on Friday, we're going to sell off back into the range between this low and this high. There's your equilibrium point. From Monday's low to Monday's high, we can get deviations from the range created. So this was the low created in London, and this was the high created in New York. Everything else over here, as far as the algorithm is concerned, is price that is being held within this range. So these two price points are going to be macro levels that the algorithm is going to retain in its logic and project deviations of this range. Why not this? Because this moves outside of our time window. So from this low to this high, if we project two standard deviations up, so that comes at 0.98082, and the actual high here comes in at 0.98086, so 4 pipettes off the actual high. It's pretty close, especially in this current market climate. If we have 1.5 standard deviations down, we get 0.96344. Actual low came in at 0.96315, so about 3 pips of the actual low. So the variation is up to 5 pips when we're looking for standard deviation, so that falls within it. But again, incredibly accurate. Considering the amount of volatility that we've seen last week, this is still amazing precision. Let's zoom in on Thursday's CPI news. Now, before we get into this, right, I do not recommend you trade CPI, especially in the market climate right now. I don't recommend you trading the high impact news, FOMC, CPI, NFP. They're very volatile. And again, ICT has told us a million and one times not to trade it. I did trade it. Okay. Now, I'm going to be honest, I used a quarter of my normal risk, and to be honest with you, the only reason I traded it is because how my analysis lined up, and I'll show you everything I was looking at. And it gave me the confidence to enter a trade. Granted, it was with a lot less risk than I would have normally put into the trade. Now, there's a lot of school of thought around trading high-impact news events like this. Some people argue that it's a missed opportunity. In my opinion, it's foolish of us to not listen to Michael's experience on this. However, if you see something that looks very clean to you, then if you want to trade it, by all means, do what you want to do, but respect the risk and really deleverage on your positions if you're going to do it. My advice, especially whilst you're learning, is not to trade it. I've only started recently looking at high impact news events and trading them like on a small scale, even though this was a proper A+ setup for me, so I'll show you and talk you through and you'll understand why I had the confidence to take the trade in the first place. I shared this with my elite group, and I promised them that I'd go through the reasoning behind why I took the trade. So, this is the 5-minute chart. We created the low in London, and we rallied higher. I mean, this in itself was a nice setup. We took out the lows, the Judas swing, breaking market structure, fair value gap, order block, relative equal highs. We hadn't run this high yet. We came back down into the order block, small little fair value gap, and then really dug into the buy side liquidity above these equal highs and this high over here. And then we retraced between London and New York. After the New York session had opened, we'd run up and clear the buy side liquidity of this high created between the London and New York session. And at the same time, we closed in this hourly fair value gap. So the remainder of this city that was left open, we closed that just before the numbers were coming out at 8:30. We'd also had this behind us. So this is why understanding order flow and reading the tape is important, because this is how we can build narrative. We've already cleared buy side liquidity above here, and we also rebalanced. So all of this is the same as what we had over here. We had the buy side, we ran it, and rebalanced. We had the buy side liquidity, we ran it, and we rebalanced. So having that narrative and framework behind me, I also noticed that we had a really big divergence between the British pound, the dollar index, and the euro. So at this moment, I noticed that we had failed to make the higher high in the euro. We had failed to make the lower low in the dollar, but we had posted the higher high in the pound. So this gave me an indication as to where price wants to go first, right? Notice what I said there. It gave me an indication of where price wants to go first. We ran buy side first, and then took sell side liquidity. After we ran buy side liquidity and closed in that fair value gap, we had a break in market structure, right? Now, I'm not expecting this high to be broken. So any upside movement, I'm anticipating an order block forming, right? At the same time, I'm looking at this as an intermediate term high. We have a short term high to the left, a short term high to the right, and we filled in that sell side imbalance on the 1 hour time frame, and we ran buy side liquidity first. So we've engineered sell side liquidity pre-CPI. So before the news is released, we've got a pool of liquidity that's been taken, which is buy side, and a pool of liquidity that has left untouched, which is the sell side, right? So after having that context behind us, I'm looking at the fair value gap within the order block, which we have here. If we zoom in into a 1-minute chart, we have this high, low, higher high, so this becomes our breaker. And then we have these two up close candles, which is our order block. And we have from this high to this low, we're above 50% into our optimal trade entry area. At the same time as this was happening, the pound posted a higher high, whereas the dollar index failed to make that lower low. So we had some SMT divergence with the context behind us, with having all these nested PDOAs, which led me to take a trade. And I got in at just above this candle's high. So as price was trading back up into there, I'd set a market order just as we got above this candle into this fair value gap. So 0.97428, and that's where I got in, 0.97428, right there. And then obviously we tanked off. I got out at 96671, which was just below this low. So this yellow line was 96771. We did actually go lower and took out the old sell side liquidity at 96354, but I didn't honestly think it was even going to get that low. But it did. So mad volatility. I mean, it was fun being in that trade, but I wouldn't recommend it. Unless you're going to see like the number of things that was behind this trade. It did give me the confidence to take it, but 9 times out of 10 I'm not going to be trading CPI. And just because I have done it, I don't want you guys going in there thinking that is a good thing to do. You've got to respect the risk in this climate at the moment. I'd like to say just thank you for all the feedback for the psychology section that I've done. I'm going to hopefully be building that out over the coming weeks and really answering a lot of the questions I've been getting. If you do have any questions related to anything to do with psychology or things that you want to know, which aren't related to charts, then please send me a DM or just ask in the mentorship chat, and it can give me something I can talk about, so I do welcome that. I have about 10, 11 different topics I've already got wrote down, so I will hopefully be releasing them over the coming weeks. But yeah, I hope you guys found this one insightful, and I'll catch you guys again in the next video. Alright guys, welcome back. Hope you guys enjoyed your weekend. So this is where we left off last week on the dollar index. We might be trading to Monday depending on when you're watching this video. Anyway, dollar index daily chart. So as you can see, we ran buy side liquidity and the sell side liquidity. We ran equal lows and dug into this daily fair value gap, and also found some support on the discount end of this fair value gap from this low to this high. I haven't got a mark, I don't know why. And we've pretty much been range bound inside of this fair value gap. So very ranging price action last week. It wasn't easy to trade, not an easy week at all. Where we go from here, it's not very clear, if I'm being honest with you. I'm not calling the top on the dollar index still, but I can't really distinguish a clear bias. There's cases for both sides, which we'll get into. We're still within this deal range from this side to this low, and as you can see around that 50% level, we had a lot of back and forward price action inside of a daily fair value gap. So this is when you're going to get your seek and destroy profiles, or you're going to get consolidated ranges, especially on the higher time frame. When you're at 50%, this is when you're expecting it. The bodies, the wicks, and around consequent encroachment of this fair value gap, which is also within that 50% of the deal range. So expected to have consolidation, which is why I've said for the last couple of weeks, we're probably likely to consolidate. We have this volume balance up, we have these up close candles through it, so we may want to dig down in here a little bit deeper. I don't want to see price violate the mean threshold of this last down close candle. Yes, this is one order block, but because we've got the volume balance that separates the two, I'm looking at this down close candle as my main order block. So I'm permitting price to come down, but not through here. If we do get through the mean threshold of this candle, then we're likely going below this and lower, because we have this balance price range as well. So we're going to break back down through it. This is algorithmic, and this will end up acting as resistance if we're going to get any downside movement. From where we are, like I said, we're still in this range between this high and this low in that fair value gap. So we could see it ranging. Maybe for the next week, we don't want a lot of high impact news that's coming out this week, so I do expect some volatility. We have left these relative equal highs, so if we do see any upside movement, this will be the drawn liquidity. How likely it is at the moment, I'm not convinced, I'm not 100% sure. The markets are moving in sync very well at the moment. And normally when you get times where the markets are moving out of sync, it's another case of just having consolidated range-bound markets. So we want to see some sort of volatility injection coming. We do have the elections coming up. There's a huge economic crisis going on around the world. The Eurozone, the UK, what's going on with our government and the Prime Minister. So these are difficult trading times. You have to really respect the risk. We just about made a higher high in the dollar index, but at the same time, we failed to make a lower low in the euro. So this could suggest a turning point. On the 5-year T-note, this is the bond price. We did reach our discount objectives, and we're closing our volume balance quite nicely over here. I expected to see a rally in the dollar index as this was dropping, but we didn't see that rally. So is that suggesting again weakness in the dollar? So we'll have to see. There's a few other things I'm going to talk about in this lecture today that we can start piecing together what's likely to happen in the coming weeks. The euro. So again, within this range, we found support at the discount end of the fair value gap. This may want to reach higher, maybe clear out the buy side liquidity above here, and maybe retest this balance price range. If we get any more downside movement in the dollar, then and we break above the balance price range over here, then we're likely going back above the 100 big figure level, and maybe clearing some of this volume imbalance up here. We've only traded down through it, so we have sell side delivery. So there's not a lot of buying up here. This would be my next upside objective if we are to break higher. Note the bodies, how we respected the consequent encroachment of this monthly fair value gap. So we've had quite a lot of support over there. That might be crucial going forward as a potential turning point in the market, but it's a little bit too early to say at the moment. So we'll monitor things over the coming weeks. Again, I don't want to see prices violate the mean threshold of this last close candle. If we do, then up here, like I said, is a likely draw. S&P 500. So we did push higher, closing in this volume balance, and then we retraced down into this down close candles where the order block, which also overlapped with this previous day volume balance. And as you can see, we found support and really pushed higher. The close of this candle really respecting the premium end of this fair value gap. So this is looking more bullish to me at the moment. We've closed above this volume balance, and we didn't close below the mean threshold of this down close candle. So the next area for a draw on liquidity is likely to be, if we can get obviously above this balance price range that we've noted in the previous lectures, then this is a likely draw on liquidity. We have buy side liquidity resting above these relative equal highs, and we also have this imbalance that still needs closing in. So that could be a potential draw over the coming week, especially with the volatility that's going over this next week. We might even see that at some point. So British pound. Like I said last week, we were likely to consolidate, and that's what we've seen this week. We do have buy side liquidity resting above these highs, and we did come down close this balance price range and broke market structure here, came back into the order block. So if the dollar does see more downside, then this is going to allow cable to really reach for the buy side liquidity above them too, and even up to here. We have a small little fair value gap still that's left open. So we could potentially see buy side objectives on the pound. Again, I'm really staying away from the pound at the moment with everything that's going on in the UK. But gun to my head, we're likely to probably push higher from where we are. So gold. I had somebody ask me if I could do some analysis on gold, and I can tie this in with what we're currently looking at across the different asset classes at the moment. So we have the relative equal highs that are being left. So this is again a really big draw on liquidity if we have to push higher. We have the relative equal lows. So these three lows, we raided that and dug into this buy side imbalance, sell side inefficiency, which is also sat within these last two down close candles. So we have one bullish order block. We have this low, high, lower low. So the last up close candle is going to be our bullish breaker. We're also from this high to this low in a deep discount, so optimal trade entry area. Gold hard one. Again, with the state of the economic climate, many people might be wanting to turn to gold as the store of value because nobody really knows where to put the money. I'm not going to lie. Crypto's all over the place, stocks all over the place, inflation's eating up everybody's money, so people want to keep it at the banks. I suspect from where we are, if we see a break above this high, we may want to be looking at the relative equal highs because there's a lot of buy side liquidity resting above these, and we've already cleared the sell side liquidity. This is on a weekly time frame. So also we failed to make a lower low in gold, and that was confirmed with a failed higher high in the dollar. At the same time, we haven't been seeing any higher prices with the dollar as the yield price has been going up. So across the board, they're all going higher. We should be seeing the dollar follow the yield price. We've already seen that the bonds dropped, and the dollar didn't do anything in consolidation, and the yields are still going higher. So this is suggesting that could be underlying weakness in the dollar index. Looking at the open interest on the euro, if you haven't gone through ICT's month 5 content, you'll find out how to interpret COT data, open interest, and all the things I'm about to show you. So I'm not going to really reteach in here. It's not necessary. I'm only bringing this up because as a group we can all use this as study material going forward and seeing how open interest, COT data, market structure, all the different asset classes that we brought together, how they're all interacting with each other as we move forward. So this is a good study for everyone basically. So this is why I'm throwing it in there. I don't always use it. Probably at the beginning of every month I have a look at the open interest, I have a look at COT data, and see if there's certain clues I can find that's going to give me a directional bias on what the dollar is likely to do. Realistically, that's what I'm looking at is I base everything around what the dollar is likely to do, and that'll give me an indication of a directional bias I can take going forward. During this period of consolidation, if you look at the open interest was increasing, and then right at this area when we have this change in state of delivery, after we run through the open of this last up close candle, actually run through both of them and leave this fair value gap, and then we sort of consolidate higher into it, into the volume balance, into the fair value gap, and then we drop. As we've seen this happen, open interest absolutely tanks. So all of this is profit taken. So all the positions that they're accumulated, they're not offsetting and taking profits, and they're reducing open interest as we're going lower. This area was that monthly consequent encroachment. So we found support here, and at the same time we're still seeing open interest declining. So this is telltale signs that there could be potential reversal on euro, which again could give us that lower high that we're making in the dollar index versus the yield price. Could in fact be heaviness on the dollar index and maybe potentially lower prices. At the same time as we were seeing this consolidation, again this is taught in month 5, but this is how ICT looks at the commercials and COT data. So this is just the commercials lines that's plotted. So these are your central banks, and this is the lowest low and the highest high in the range. We split that into two. So during all of this time they were net long. As open interest dropped, so during this period over here, at the same time we see the commercials change their position from net long to net short. Now the commercials are offering counterparty to the large specs because the commercials are their liquidity providers. So because they hedge their positions, again this is interesting with the divergence that we're seeing on the euro versus the dollar index. And after everything I've already said, this is again another clue that we may be seeing a change in sentiment and potentially be shifting directions. Still getting a little too soon. I want to see price break above this 100 level. And if we are to go higher, then we have liquidity resting above these highs, and then this imbalance that still hasn't been fully closed. So potential upside, we'll see how things go. Nobody knows 100% what's going to happen. And like I said, we're in very volatile, crazy times at the moment. Anything can happen. But when we do our intermarket analysis and we pull out fundamentals, we're looking at behind the scenes of what could potentially happen. So it's worth keeping our eyes on this. Anyway, S&P. So this is last week's price action. Somebody asked me if I could show how I actually divide my charts. Now I still do this manually. I know you can get indicators, but I like to do it at the beginning of the week because I feel like I can get in sync with the chart there. It's just a personal thing to me. So the way I do it is I pull up my vertical line, I toggle it so it's a dotted line, and then I'll use the red colour for the beginning of the week. So Monday, New York open is where I plot my first line. Then I change it to black, and then plot that vertical line on midnight New York for each of the days. I don't know why that's there. That should be on that candle. My bad. And then I get a text tool, and I literally write out Monday, Tuesday, Wednesday, Thursday, Friday. I already have all my lines delineated from like the higher time frame, and generally I only keep the daily levels on above my charts, and on the lower time frames I like to keep them clean. So it doesn't really, when I have too much stuff on my charts, and I only really do it like this just for the sake of these lectures, but my charts are usually a lot cleaner. It's a tip that I got from ICT is where he has a notepad and he has key levels on the notepad that he knows, so he's looking at price and this line, and this is pretty much how I trade nowadays. I only have the price line, so I'm looking left through, going through all the candles, and I do this on each time frame. Usually I have my daily 1 hour, 15 minute, and 5 minute chart open at the same time with my daily levels on it, and that's pretty much about it. And I'm just looking left and getting into institutional order flow and market structure. Anyway, let's see what transpired last week. So straight away from Monday, New York Open, we just shot straight up into that premium end of the daily fair value gap. On Tuesday, we dropped lower, filling in some of this imbalance. We have this low, high, low, low, so this last close candle coupled with that imbalance. And you see the body's respecting the discount end of the daily fair value gap. Then we rally higher, taking out Monday's high. After we took Monday's high on Tuesday, we break below this swing low. So this is our breaking market structure. We also can see SMT between the Dow. I'll leave that on for your studies. At the same time, whilst we've seen the shift in market structure. This is further confirmed as a valid break when the leg that breaks this swing low has a fair value gap in there. ICT dubs this an intermediate term swing because we filled in a daily imbalance and then we broke market structure with that fair value gap signature in there. So I do not expect this high to now be violated. So the dealing range from this high to this low, we should stay in there. If we extend that fair value gap out, you can actually see on Thursday how we come into it beautifully and then drop lower. We also have this high, low, high, high, so we've got a breaker. Again, that overlaps with that fair value gap, which also overlaps with the daily volume imbalance and the daily consequent encroachment area. From this high to this low, we're also an optimal trade entry. And then price sells off, closing in this imbalance and digging back into the daily volume imbalance. And from this low to this high on Friday, we come down to optimal trade entry in that daily volume imbalance. We break market structure, leave this imbalance, and tap the daily bullish order block open and into this balanced price range. So we view wicks as gaps. So this is wick up and down, so this is inefficient price action. When we see a wick and a fair value gap that overlap, this again is another balanced price range. And when we wick into it, we expect higher FED. And price rallies higher, closing back above the daily fair value gap premium. So next buy side objective is the buy side liquidity resting above this high, and then the relative equal highs on the daily with the fair value gap resting above that. So potentially higher prices on the S&P going over the coming week. Now, I didn't trade on Thursday or Friday. I wasn't in front of my charts, I was busy, so I didn't manage to catch any of this. I was in front of my charts on Tuesday and Wednesday. Didn't really see anything on Tuesday. I mean, in hindsight, there was probably something I could have gone with, but I wasn't very comfortable in this area just because I felt like we were going to consolidate within this daily fair value gap. I did take a trade on Wednesday around this area. It doesn't look like much on this chart. And I had a question about how do you look for high probability setups. I trade usually the 1 minute chart and below. So if I can get institutional order flow behind me, I can really go into the smaller time frames. And I'm using the same leverage. When I'm getting 5 points, 10 points, I'm using the same leverage. And if I can get a 1 to 2, 1 to 3, 1 to 4 risk reward, that's perfect for me. I don't need to have a massive move. I think a lot of people think that the more pips you get, the more money you're going to make. It comes down to how you're going to leverage your risk. You can use a short stop, the same amount of leverage, and have a shorter pip target. So to give you some more detail before I get into my actual trade, a lot of it was based on what you can see in front of you. So I had the daily levels mapped out, and I'm looking at how is price reacting to these levels. I'm trying to build a narrative and contextual framework about where price could likely go if I see something happen. Again, if I see this, then this is likely to happen, and this is predominantly how I trade now. I don't specifically have a model anymore. After going through everything that ICT's done and through all his models, I don't really use his checklist stuff to develop my own. Got a few questions regarding the different models and stuff. You can make this as unique as you possibly can to yourself. It doesn't necessarily have to be what ICT uses. You may like SMT, you may not like SMT. You may want to incorporate cut data or open interest. You may not, it's not important. I didn't use it for many years. But the more comfortable I've gotten with my trading, the more comfortable I've gotten with reading price, I can start adding different dimensions to my trading. So I can bring in fundamentals, cut data, open interest, dip to data ranges, seasonal tendencies. The model that we have in our academy is based on the YouTube model. And it's a very basic, easy model that we can all employ. I use that as a foundation to a lot of the models I'm looking at, as you can see with all the examples that I go into. But having a model is one thing. Understanding the narrative and understanding where prices come from and being able to read the tape. In my opinion, I think being able to read the tape is the best skill you can have. Because if you know what price has already done, it's easier for you to work out what price is likely to do. And I'm at a point with it where I sort of just trade what I'm seeing, and I'm able to use multiple models in order to find this out. And nowadays, 1, 2 trades a week is enough. When I really scaled down the amount of trades I was taking and really went for the higher probability trades, my equity growth was a lot more consistent. I only took the 1 trade this week, and I was done for the week. And I think it took me maybe 5-10 minutes. And this suits me as my personality because I hate being on the high time frames. I can't hold positions more than an hour or two maximum. So hyper scalping for me works. I like to get into the smaller time frames. But what works for me might not work for you. Essentially, price is fractal, so the same setups, the same entries. I mean, you could pretend that this chart is the daily chart, right? Everything I'm showing you is salient to all time frames because of the fractal nature of price. If you don't like being in the 1 minute charts, I know they're not for everybody. You can still apply institutional order flow, market structure, understanding where price has gone, where prices come from, and where prices likely to go, understanding where our liquidity draws are, where our fair value gaps are. And like I said, the algorithm only does 2 things. It wants to rebalance inefficient price or seek liquidity. The algorithm was created a long time ago, and it's not that intelligent. It has parameters that it has to stick to, and there's only very few things that it can do: consolidation, expansion, reversal, retracement. So from a lot of the questions I've gotten this week, people are really overcomplicating things. I know I'm waffling on a little bit, but I try to answer some of the questions I can get because trying to type all of this is very difficult. So hope you can permit me that I can take a few minutes just to tell you that, because I feel like you don't need to overcomplicate this. Anyway, so now when I'm selecting the highest probability trades, I like to see what price has already done. And when you apply algorithmic theory, market structure, and institutional order flow behind this, it gives me more of an X-ray view of what price is doing. And from that, I can make a judgment, once time aligns with price, whether I want to get into a trade or not. So I can see that we have this breaker. We have the breaking market structure already that I've explained. We have this high, low, lower high, that last down close candle. That's our mitigation block. We have this high, low, higher high. We break below it. This is another breaker. So we have 2 breakers behind us. We also have this last up close candle is our order block. We also have this buy side imbalance, sell side imbalance, and then we've hit that create a balanced price range. I'm looking at all of this around 8:30 on Wednesday, and this is everything that I can see before my trading window opens. So now with all the context behind me, when I go into the lower time frames, I can start fleshing out the times and refining some of these PD rates. So on the hourly time frame, this was one large order block, which I can now refine to these last 2 close candles. And that mitigation block that was on the hourly now becomes a breaker. We have this high, low, high, high, and we run below it. So now these last 2 down close candles are my breaker. Let's go down to the 1 minute chart. Now, I had a question again in terms of time. When am I looking at the charts? Now, ICT teaches 8:30. He says look at the previous highs, lows, inefficiencies prior to 8:30. And if that's your model and you want to use that, that's perfectly fine. What works for me, I like to wait after 10 a.m. Why is that? Because 9:30 we're going to have the opening bell, and we're going to get a lot of volatility. I like to wait for the volatility to die down before I look at trade setups. So This is 9:30 opening bell, and we have obviously this spike in volatility. At this time, I'm also keeping an eye out across the index averages to see if there any institutional accumulation or distribution, so SMT basically. Now, post 10 a.m., price settles down. We have this breaking market structure. Fair value gap, order block, breaker, last close candle, low, high, low, low. So if you wanted to get in here, that would have been a good buying opportunity to go above these highs. I didn't do that. I waited because I have all this narrative behind me. So for me, I was already looking at, look, we're likely to go lower because of what I've seen on the previous day. Now, when we came back up into the refined order block, which had everything else behind us, I was waiting to see what reaction we're going to get. After we took the buy side liquidity, we ran higher into our refined order block on the 15-minute time frame. So let me zoom in here. Once we dipped into that order block, I seen this last swing low before that drive higher. We break it here. So as we move through this last close candle, we now have a change in state of delivery. So a sell program has been initiated. Now, why can we be confident that sell program started? This is a value change in state of delivery. Well, that's because of the context and the framework I've already outlined. After taking buy side liquidity, we've had our run on stops into a premium level as time is aligned. I can now trust this as a valid breaking market structure on the 1 minute time frame. From this high, this low, higher high, we have again our breaker. So we send that on time. And we also have from this low to this high. I don't know why it's down there. We have our fair value gap. So as price was coming up here and making these up close candles, I got a market order right in there, and I was going to ride it from this low to this high. We had that 50% level, which also is inside this buy side imbalance, which also overlapped with this sell side imbalance. So we had a balanced price range. So when we got down here, I actually closed my order, and the reason for that is because we don't know, we could always bounce from here. We could always bounce higher. And I was in good amount of profit, so I wasn't going to risk it. Even though I did expect us to go below these lows, which of course later on in the week we did, I was out around here. So this was my actual trade. So as you can see, I got in right there, and my stop was above this high over here because this is where the breaker was. So I didn't want to see it violate that breaker. Usually I don't like seeing the mean threshold be violated. So anywhere above the high of the breaker is a good idea. I use this one because we also had this dotted black line as a low of the refined order block on the 15-minute chart, and we also had this order block. A very aggressive stop. You can put it above the high of the candle that created the imbalance, which would be here, but that's safer because it can always wick up through that. I didn't manage to get a screenshot when I closed the trade, but it was around this area. So as we dipped into this balanced price range, it was almost a 4-to-1 trade. I think it was like 3.8 or something. But that's all I need. That's all I need. 1 minute time frame, 1 to 3 with decent leverage. I mean, that's all you need. You don't need the massive home runs. You don't need it to even take out the lows of the sell side liquidity. That 50% going from there to there is all you need. You manage your money right. You don't over leverage, but you can make a full career just on that. Anyway, I've waffled a little bit on this one. So I hope you guys found this one insightful, and I will catch you guys again next week. Alright guys, welcome back. I hope you guys enjoyed your weekend. So we have the daily chart on the dollar index, and as you can see we traded lower last week, clearing out liquidity below these lows. I had a few questions regarding the fundamentals and the analysis that I do with like the intermarket analysis, how often I do it. I have the bonds, like the 15-minute time frame up on all 3, the 5 year, 10 year, and the 30 year. I have them up all the time on my screens because I'm always looking at the relationship between the dollar and the bonds and commodities and the bonds. So the reasons that I was feeling like the market might sell off, the dollar might sell off, was obviously looking at the COT data, looking at open interest. Now I don't use open interest and COT data all the time. Usually if I'm expecting a higher term structure shift, or if I'm expecting a quarterly shift in the markets, so every 2 to 3 months, smart money starts recycling and moving money around the markets, and they cycle the money through different asset classes. And when you combine that with seasonal tendencies and you combine market structure and you combine open interest, COT data, and the fundamentals behind it, you can really get in sync with where smart money is taking the money out and where they're putting the money in. So all of that is taught in month 5 of ICT's mentorship, the core content which is now free on YouTube. Of course I've been over this dozens of times already, and the truth is when I first went through it, I almost gave up with ICT stuff. I just, like many people who come into ICT's material, you're coming from a background of where we were just using indicators, maybe support, resistance, trend lines, Fibonacci. We didn't think too much about, well, me personally, I didn't think about the relationship between all the other asset classes and how all the asset classes are on the same string. If you pull one end of it, all the asset classes are going to move. So really understanding that took a long time, and it was a huge leap forward when I finally gave in and thought, right, if I'm going to do this as a professional and I want to make this a long-term career of mine, I've got no choice but to really understand how these markets interact with each other. And month 5 really goes into detail of how intermarket analysis really works. It's very dense. You have to go through it a lot of times. You have to backtest them, and the problem with the fundamental side of things is that a lot of the higher time frame setups take a long time to pan out. And over the course of nearly 5 years, I've seen this many times now. But obviously, I'm looking at the high time frame, so the experience that you get isn't as, say for example, when you're looking at low time frame entries, you see them all day long, and you get good at the low time frame entries. But without the high time frame behind you, without high time frame order flow, and really understanding intermarket analysis, in my opinion, I think you're trading half blind. It might be different for other people. I know people who do have like this basket approach, and they're only looking for really one setup and a liquidity pool to target, and that's fine if that works for them. Do I think that we've made a turning point in the dollar? Well, you have to operate in a grey area, right? Yes, I called the move last week saying I would like it to go lower, and as you can see, all the evidence that I had supporting it, and we did see it go lower. But does this mean there's going to be a complete reversal in the dollar and we're going to completely now tank? It's possible, but again, we have to see the state of the economy. I know a lot of people are interested in the politics side of things and the economy side of things, but this is the business. We're in that business of understanding how these markets book, and in order for us to do that, we have to see what's going on around the world. The global economics on a macro level directly affect our career, so it makes sense for us to really stay on top of that and learn it. So we broke below this key low. Now, why is this a key low? Because we have this high, and we have this low, then we have this high. And between this high and this was the last swing. So we have our 3-bar swing pattern. Also, we came and we closed in this fair value gap when we were over here. So this becomes this intermediate / long-term swing because we are on a daily chart. So when we come down and break this key low, we now have to assess a certain number of things because it was a key level that's now been broken to the downside. Where's the pool of liquidity and the PDO is resting below this key low if the market is poised to go lower? Well, we have this volume imbalance still that we haven't traded to, and we have this sell-side liquidity resting below these lows. We've only had buy-side delivery through this volume imbalance. So has this efficiently been traded? No. We're playing almost as a detective in the market to sort of try to predict the likely movement of price based on all the information that we have. Now, this is something that I've grown in my understanding over the years, is always making a case for both sides of the market. Again, this is something that ICT has taught us, and there was a lecture a few years back, and it was really a turning point for me when he said, if you can make a case for both sides of the market, that's when you're in a low probability environment. And since then, I've always tried to see if I can make a case for both sides of the market. And sometimes you're not going to be able to call it, and it's going to be 50-50 either way. And when you're in those environments, that's when you know you need to sit on your hands and wait for more information. The times you want to be trading, for me personally, especially when the daily time frame is poised to go in one direction over another. When we were over here, and we were obviously finding support within this daily fair value gap, consequent encroachment, and we had all the nested arrays behind us, and with the analysis that we did on the open interest COT data, the yields of bonds, that painted a picture which made it likely for us to go below this area. right? Which ended up happening. Now, once we take out a kilo, we have to anticipate some form of retracement, right? Where can it retrace to? Well, the most obvious one, which I know you guys should see yourself, is the fair value gap resting between this candle's low and this candle's high. What does the algorithm do? It seeks liquidity, number one, and number two, it seeks to rebalance inefficient price action. This is inefficient. There's only sell-side delivery through this area, right? So the algorithm is most likely to offer buy-side delivery to rebalance this sell-side inefficient price action. Now, once we get there, that could be a short-term play for us, right? It's likely from where we are that the algorithm wants to reprice higher from where it currently is. But does that mean we're going to keep going higher? No. What it means is we have a short-term target on the lower time frames, and again, depending on when you're watching this may have already traded up through this and even past it, but that would be a short-term, low-hanging fruit objective for me. On Mondays, I don't normally trade. This may go up Monday, and if it goes up Monday and I've missed it, I missed the trade. If I find it sort of consolidating, because on Monday you typically see consolidation at the beginning of the week, and then if I see a setup on a Tuesday with a kill zone, I'll be targeting this area after we've taken out some sell-side liquidity and hit a period rate. Once I get to this area or we filled the fair value gap, then again I want to sit on my hands and wait for more information. Once we get to this area, if this acts as resistance, and we see something on the lower time frames that suggests we're likely to now go lower, then it's likely to continue lower and take the sell-side liquidity below these lows and then maybe the volume balance. So we've already got a framework behind us, and when we're looking at algorithmic-based trading, we want to look at if price has already done one thing and what could be the outcome and the conclusion of that. If price doesn't do what we're anticipating, then that could indicate that we're offside and we need more information. So what do? We have to sit on our hands and wait for more information. A lot of this game is waiting. Normally I have the daily chart open, the 1 hour chart, 15 minute, 5 minute, and 1 minute open all at the same time if I'm looking at the euro, for example. And I have the same charts up and the dollar index. I'm always looking at the relationship between the euro, the dollar, and then obviously looking at the bonds as well. But you don't need all of that. I've grown into that. At first it was on just one time frame on one chart, and you build on that. So I know I've had a lot of questions where people have become quite overwhelmed with the number of different moving parts and things that you have to pay attention and focus on. You have to just build up to it. You're not expected to get this overnight. So if you're feeling like you're not fully understanding everything, just stick with it. And I was in the same boat. This was all going over my head, and it took me a long time to really digest all the information. Right, so this is a potential area. Right now, this is all I'm really looking at is this fair value gap on the dollar index. I want to see what price does once we get there. We could just continue moving higher, and this may have just come down to take out the stops, and we're going to continue to go higher. And there is a few cases for that, which I'll go into in a minute. So between this candle's high and this candle's low, we're also above 50%. So that fair value gap is in a premium range relative to the range created from this high to this low. Why this high and this low, not this high and this low? You can use this high and this low, but I'm looking at the leg that broke this kilo. And for me, because we're all inside of this daily fair value gap, this is all consolidated price action. And this again was an indecisive candle, but then we had a really energetic move to the downside that raided liquidity below these lows. We also had this up close candle. I'm going to change in state delivery as we run through that. So this is why I'm looking at the dealing range between this high and this low. We have a high, a low, and a lower high relative to this high over here. So the last down close candles between the high low and the lower high is these two down close candles. So this for me is the mitigation block. Inside of that mitigation block, we still have this fair value gap. We also still have the discount end of this daily fair value gap. So it may even want to trade higher into there before going lower, or it may trade higher into there, find a little bit of resistance, and find support back on this fair value gap, because we might just trade right through it, creating a balanced price range, come down after support and continue higher because we have these relative equal highs over here. That for me is the problem, because it's like a neon sign to say I've got a lot of liquidity up here, come and take me. So I did mention these equal highs, and there's a few reasons why we might still want to go higher, and this might not be the top. It could be, of course, but we'll have to look into it. Euro dollar. So we ended up finding support at the discount end. In last week's video, I recall me saying that we had this candle that found support at the discount end and we were likely to go higher, and if we did, we'd be trading up into this volume imbalance because we only had sell-side delivery with this down close candle. On Monday, we dipped down, order block, mean threshold, and the premium end of the daily fair value gap. I don't know why that is there, it should be extended out under that candle's low. We found support there and we really rallied higher, and we pushed right through that balanced price range, found support, and then rallied higher again into the volume imbalance, and clearing that 100 big figure level. Now, if we do get any more downside movement on the dollar, we are likely to then attack the liquidity resting above these relative equal highs. This has become a balanced price range, and obviously we're trading inside of this balanced price range. We also have this daily order block, which we've already found support from, and we have this fair value gap still that could be traded into. We've got this buy side imbalance, sell side efficiency still left to be traded into. So we could see this decline lower and maybe tap the order block again. If we do go lower, the high of this order block, this last down close candle, to the open, that's going to be quite sensitive because we do have a volume imbalance in there. So if we do get any more downside, I'd like to see this hold up a support and see some sort of sensitivity around the wick area of this down close candle. If this doesn't hold and we break back below into this daily fair value gap and below the mean threshold of this candle, then it's likely that we're going to clear these lows down here and fill the monthly fair value gap discount. Relative from this high to this low, we are in quite a really high premium level, right? We also are within this mitigation block. So we have low, high, higher, low. So these last two up close candles in that swing is going to be a mitigation block. So the arrays within this mitigation block, if we are to go higher, should be supporting price, and we shouldn't want to see these broken. Again, if we do, then the lows down here are likely to be attacked next. Interestingly, on euro, we have come into that volume imbalance, and we've also cleared the buy side liquidity resting above this high as we dug into that volume imbalance. On the dollar index, we haven't yet took the low, so the liquidity resting below this, which is the equivalent high here, we've already run that. We haven't run this low yet. Our 3-bar swing signature, and don't forget, it's the daily time frame, so there's a lot of liquidity resting below this low. We haven't yet tapped into that, nor have we tapped into the volume imbalance, right? So that's something that we might want to keep an eye on, because if we don't trade any lower on the dollar index, then this could be a sign of institutional accumulation. On the 10-year T-note, so usually if I'm looking at one other asset class to gauge against the dollar, I'm looking at the 10-year T-note, so this is the bonds price, not the yield price. The yield price is inversely correlated to the bonds, so obviously this is being going lower, we would expect the yield price to be going higher. Now, we obviously had this turning point, and this pushed the bonds higher, and we obviously seen the dollar index over the last week or so fall off a little bit. We've come into these up close candles is obviously one bearish order block, and we have this fair value gap sitting inside of it. Now, we had quite a strong reaction from the open of the bullish order block, and we closed below the volume imbalance that was created between these two candles. So that could be a bearish sign for the 10-year T-note, and potentially see lower prices. And again, if this does drop lower, then we're going to look at the dollar index going higher. We have the buy side liquidity resting above this high if we are to go higher, and obviously the sell side liquidity resting below this low if we do fall off. We're around the 50% area relative to this high and this low, so, and we're also currently trading inside of this volume imbalance. As you can see, we had a lot of consolidation around here previously. So when are we likely to see consolidation? When we're sitting at equilibrium of the dealing range on the daily time frame. Do we want to come up back into this fair value gap? We might not even need to do that. This might just roll over and completely sell off. I'd like to see this candle hold the support, this up close candle. For me, this would be our accumulation block on the left side of the curve. And I wouldn't like to see it really dip any lower into this order block over here. I'd like to see the support price and move it higher if we are going to get institutional sponsorship in the way of this going higher. Another point worth noting is on the 10-year T-note, we've run this high into the discount of this fair value gap and into the low of the daily order block, the bearish daily order block. At the same time as this was happening, on the 30-year, we failed to make the high, and we found resistance on this bearish order block. And on the 5-year, we've seen the high, and we've come into this fair value gap and this order block. So this could see a turning point again in the bonds, and it could continue to go lower. So that divergence we were seeing between the bonds and the dollar index, that might well just be the dollar coming down to take its sell side liquidity and run higher. It's a little bit too soon to still say, but with the divergence in the bonds on a higher time frame, don't forget this is a daily S&T, so these are usually quite strong. So I wouldn't be surprised if we did see the bonds just fall off from here and run sell side. So this is something worth paying attention to over the coming weeks. S&P 500. So that fair value gap that I had outlined in last week's lecture, we did in fact trade up into that. On Thursday, we came and found support, bullish forward block, and the premium end of the daily fair value gap that started here. We have this volume imbalance between the body of this candle and the body of this candle, and as you can see, we traded up to that. Now this can act as resistance from here, and we can see maybe price sell off. We've had a really big push over here, and we've cleared all the buy side liquidity. Above these equal highs, rebalanced, and come back into the volume imbalance. We have this high, low, and a high high, so we've got these two down close candles. We have the breaker that's also resting inside of that volume imbalance with this up close candle, so we have our bearish forward block as well. So quite a few nested periods. I wish I zoomed back a little bit when I took this screenshot, so you can see that we're in a premium range relative to the high and low of the daily range. So this may well act as resistance and see price drop lower, depending again, like I said, what happens between the rest of the assets that we're looking at. We have this down close candle over here, which filled in this fair value gap from this candle's low to this candle's high, and also inside of the breaker, so low high, low low. So these two up close candles. So I want to see sensitivity. I don't really want to see price trade back below this fair value gap because I feel like we've balanced that and then traded through it. So together with the body of the order block, the wick should have some sort of sensitivity around that area, and we should find support on the premium end of this fair value gap if we are to retrace, which makes sense from where we are because we've already cleared the high and come into the volume balance. So if we are to see any upside, I don't want to see a break below this fair value gap again. If we do, then that could act as resistance because this is pretty balanced, and again we'll see price go down and attack the lows and maybe down here, so it's a more longer term objective. If we are to get any upside, then these are the levels I'm looking at. So between this candle's low and this candle's high, we have this fair value gap, and we also have from the open of this candle to the close of this candle is our volume imbalance. Now inside of this volume imbalance, we have an actual gap. So the low of this candle and the high of this candle, there's no trading there, right? So this is a real gap in the market, right? We did trade through it with this candle, but this is all sell side delivery, right? So is this efficiently balanced? No. So if we do get any upside, then we're having relative equal highs being left and potentially come back up into this area, which is what I would be looking at if we're going to get more upside on the S&P. I'll be surprised if I'm honest with you. We know that nothing happens randomly, right? There's a reason for the dollar to be held up the way it is being held up, and because of the strength of the dollar, we're seeing a risk-off environment in the premium asset class. So until things settle down a little bit, I still feel reluctant to call it top on the dollar. I mean, wrong. If the market shows I'm wrong, then I'm wrong, and I'm perfectly happy to say I'm wrong. But for us to get up to these levels, we're going to still need to see more downside in the dollar. And with what I've just shown on the bonds, there's a graphing correlation there going on already on a daily time frame. So I'm not massively convinced that we're still going to get higher prices yet, but we'll see how things go. Bitcoin. So we've left these relative equal lows, and we've cleared the equal highs, so the buy side liquidity resting above these two equal highs over here. And we're also around the consequent encroachment of the fair value gap between this candle's low and this candle's high, which if you look left, we are quite, this has been balanced. So we had our sell side delivery, then we repriced, we redelivered with this candle, and now we look like we've rebalanced here. If we get any more upside, I mean, I can't really see it, if I'm being honest, it just looks too good. I mean, again, with the sell side liquidity resting below here, and then we've got the sell side liquidity resting below this line to the left. Unless we're going to get above this high, I'm still looking for lower prices in Bitcoin. I know when you see this little pop higher, everybody gets really excited, and people want to start calling it a turning point in Bitcoin. In my opinion, I think we're just coming up to clear the buy side liquidity and rebalance, and then potentially go lower. Like I said, I may be wrong, I don't really trade Bitcoin, but I get a lot of requests about it, which is why I'm throwing it in there. The algorithm works in Bitcoin as far as I can see. What I don't like about it is how it's kept in such large consolidated ranges, and then we've got these wicks back and forward because there's a lot of manipulation in Bitcoin. Obviously, compared to the other assets, this is still small. I mean, the volume in Bitcoin is still nowhere near as much as some of the other classes, so all this wiki price action is to be expected. But I still see a lot of algorithmic signatures that does work in the crypto market. So if you are looking to go long, personally, I would just hold off until we maybe get above here. I want to really see, I should have again zoomed out, but this purple area is a balanced price range. I want to get above 25, 26,000 before we start saying, okay, we may go higher. So again, it's not financial advice. You guys do what you want to do. British pound, we came up, cleared the buy side liquidity above these highs. Again, what I said was likely to happen. But then we come into this daily volume balance, and we consolidate around here. Personally, I think we're going to probably consolidate a little bit more. And again, whatever happens with the dollar index is going to determine whether we're going to go for the buy side liquidity and run higher. We found resistance at the volume balance. We have this last close candle, so we've got our order block. We've got this fair value gap between this candle's high and this candle's low. So we've dug down into that. We've also got fair value gap between this high and this low with this order block. So this might want to retrace down, maybe find support. If we get again any more upside on the dollar index, then we're going to probably go down back below here. Where the next sell side liquidity is below this low and this low, and then back into the volume balance down here. Let's get into last week's price action on the hourly time frame for S&P. Monday's price action. We dropped down after New York Open straight into the daily consequent encroachment of the fair value gap and the daily volume balance. We then seen displacement and a market structure break here. We drop down into the order block, fair value gap, the daily volume balance, and then we take off and then consolidation at the end of the day. And we were looking for higher prices on the EMA anyway, so that was the daily fair value gap that I pointed out. So we had the premium end and the discount end. On Tuesday we dropped lower and we took out the sell side liquidity below this low, ran into the order block and had the displacement higher, really running through that daily fair value gap. We consolidated going from Tuesday into Wednesday and again pushed higher. Now we had an S&T divergence on the hourly time frame, so Tuesday's high was taken out on Wednesday, but on the Nasdaq we failed to see the high, so we didn't run Tuesday's high. So this was the tip off earlier on in the week that we were likely to see lower prices come in throughout Thursday and Friday. As you can see, Wednesday was that turning point, and then we made the opposite end of the range on Thursday, and then Friday just exploded. But we had no direction on Friday, and to be honest with you, even ICT didn't expect this movement, and this is again the signs of how the markets are moving right now. There's a little study I'm going to go into, which I've had quite a few questions on Friday, which ICT actually posted on his Twitter. So the advantage of you guys being here, I'm going to do a little study on that myself. On Thursday, we consolidated overnight, left these equal highs. We ran the equal highs into the fair value gap, and then we dropped lower, and we kissed the premium end of the daily volume balance quite nicely, and dipped back into this order block and into the fair value gap premium end. So quite a number of nested arrays there. And then we rolled over on Friday lower, and then exploded higher. But let's take a look at Friday's price action. Right, ICT said that he didn't, I can't remember what the tweet was word for word, but it was something along the lines of he didn't hold a bias and he was waiting for displacement, and the two arrays he was looking at was the previous day's low and the previous day's close. So I'll get into a little bit more detail with what he hasn't taught publicly, but you know, you guys are going to get here. So this is what he was looking at, right? This was the previous day's close, so I've delineated that with this black dashed line, and this is the previous day's low, right? So I've delineated that with this black dashed line, and this is Friday's trading, and this is Thursday's trading. So between the low and the close is where we were within this range. Now, when we have that, it makes it very difficult for us to determine the directional bias. So we look at the previous day and we look at the arrays that we can see based on the daily chart, and the only two that ICT has mentioned in public is the close and the low. So he was looking for a displacement, a breaking structure, and to get in sync with order flow to determine whether we were going to in fact take the sell side liquidity below this low and dig back into the daily volume imbalance, or if we were going to break higher, target the previous day's close. Well, as you can see, price ran right through that and cleared this high into the daily volume imbalance. So now this is a little bit more of an advanced teaching. I'm not going to really go into the specifics of it because it requires a lot of background work and it's probably more private level mentorship, but it is what it is. In this candle, we have the open, high, low, and close. If you follow ICT's work, you'll understand that the open, high, low, and close of every daily candle is a sensitive level, right? Now, when we see price do this, we've had this really long wick and then we've snapped back up really quickly, right? This wick, it found support at the premium of the daily fair value gap, and it also cleared in this imbalance. So from this candle's high to this candle's low, we have that imbalance in there. I probably should have shaded that so you can see it. But is this efficiently traded? No. You see, price ran down and then went back up really quickly. So this is inefficient price action, right? This wick is also classed as a gap. It's an imbalance because this is inefficient price delivery. We had no body here, there wasn't much volume, and we traded lower and went straight back up again. So this is inefficient price delivery. We have a third level when we see this, is the equilibrium price point of this wick. So we take the equilibrium price point and we extend that out in time. And when I get to the lower time frames, you'll see why this is such an important level. Keep that as a reference point in mind when we now drop down to the lower time frame. We have now our 5-minute chart, right? And we've got Friday, this is the opening price, and I delineate that with this black dotted line. Now, we ended up dropping after midnight open, and we gravitated towards that equilibrium price point. So we've got our previous day's close, is this dashed line, and this is the previous day's low, which is this dashed line. Between that is the equilibrium price point. We gravitate towards that, spend a little bit of time, and then we drop into this order block and fair value gap combination. So we've got the fair value gap here, and then these two down close candles is our order block. And as you can see, we found support there, and then broke market structure, had displacement in the form of the fair value gap, and we had this buy side imbalance, outside inefficiency, with this up close candle, which is our propulsion block, right? Look at the sensitivity at the high of the propulsion block, and then we move away. So that was our first clue that price is looking to go higher, right? We cleared sell side liquidity. From this low to this high, are we at a discount or a premium? We're at a discount relative from this low to this high. This is a discount region, right? So price has travelled lower from midnight New York. This has been our Judas swing all the way down into the order block and fair value gap, and then we've seen displacement. The problem is the time window, right? Now, this was during London, so if you trade London and you've seen the sale, then that's great, you would have caught it. ICT teaches us that we shouldn't trade until 8:30, right? Well, this is 8:30. At 8:30, we see price drop and come into that equilibrium level, so the consequent encroachment of that wick that we've seen on the previous day between this close and the low, we nail that beautifully. At the same time, we have these three down close candles as our order block. We have our fair value gap there. It trades through it, finds support at that daily level, and then we move off, and then drawn towards the previous day's close, and much higher than that as we saw in the previous slide. So, in short, when we see long wicks, the 50% level of that wick is going to be sensitive. Euro dollar. So this is previous week's trading on the euro dollar. Monday, we drop, hit the premium end of the daily fair value gap into the daily balance price range, break market structure, and then consolidate for the remainder of the day. On Tuesday, we drop below the initial consolidation, so this is a market maker sell model in lower time frame, into the daily order block. Spend a little bit of time around there, and then we explode higher right through that balance price range and the fair value gap. So that was going to give us an indication as where price is going to drive to. And this is Tuesday's trading, so that gives us Wednesday or Thursday to make the high of the week. I said if we got through that balance price range, then we're looking at the volume balance, and as you can see, we found lots of support around this balance price range, the premium end of it. On Wednesday, again, trade higher. We had just touched the discount end of the daily volume balance, found support back at that 100 figure level after clearing in some of this buy side balance, and then we run higher into the daily volume balance. Clear the buy side liquidity above this, break market structure here, and then back into the order block. And then on Thursday, we also seen this S&P divergence between the dollar index. This is showing weakness in the euro and institutional distribution in play. We sold off, left the fair value gap, came back into it, and then dropped off, taking out the liquidity below this low, and filling in some of this imbalance. And then on Friday, we consolidated around the daily fair value gap. Now, this is an area I'm going to take you in for a study. This has gone a little bit longer than I intended to. Pay attention to this daily volume imbalance. So this dark red line is the discount end of the daily volume imbalance, right? Now, I got into a trade around here, and this is what I was looking at. And before we begin, I was wrong on the trade, but I still made money. And I'm going to show you my sales, my entries, and my thought process as I was doing it. So, I seen this initial consolidation. So, for me, this was the start of the market maker buy model. Then we had the 1 hour fair value gap that I expected to fill in and take out this buy side liquidity. I felt this was just far too clean. This is a good study for not only myself, but I've had a couple of questions about when do we not expect to see the initial consolidation liquidity run, right? This was a counter trend trade for me. Now, we came and swept sell side liquidity low here, and then we had this energetic move higher in this displacement as we broke market structure. We came back down into this fair value gap order block, and then we rallied higher. Now, because I was expecting this buy side liquidity to be run and dig deeper into this 1 hour fair value gap, I was waiting until London close and looking at what price was going to do as we open. Now, with the context and the framework behind me, I'm waiting for the algorithm to tip its hand. At 10 o'clock, we see that we have this displacement as the London close session opens. As price was coming back down into here, we have this distribution block. So this little up close candle on the left side of the curve is our distribution block, accompanied with the displacement fair value gap that we see on this candle. I took an entry right there. So this was where my entry was. As we were dipping into this area, I took my initial entry there. I put my biggest position on over here. I had my stop loss below here. And then as it rallied higher and cleared the rejection block over here, I actually moved my stop to break even. So I didn't trade with stuff like that. It was a little bit lower. Then we had a little bit of retracement lower, and then we again rallied higher, clearing the buy side liquidity above this high, and we left this little fair value gap over here. So I entered again over there, took another entry. This was half of the position I got on over here. And then, because, as you can see, I had my take profit up here, right? I was waiting to see if we would get one more entry to push higher, to take the relative equal highs up here. I had this low, high, lower, low, and as we broke back above this high, I'm expecting this as the final leg before we take the liquidity above these highs. Usually, when we're in the final leg, we do not see a run on stops. And because I seen the breaker, I felt that that was a good area for me to get in, which, as you can see, I got in again right there. And I was expecting an explosive move higher to take that. But we started to consolidate, and I didn't really get the run, especially when we got to this level. Now, I was conscious about the daily discount end, so this dark red line was the discount end of the daily volume balance. When we started to consolidate, I thought this might not run the highs, so I ended up moving my stop loss higher, so I got to break even because this was my biggest position over here, and I just wanted to assess what price was going to do. After we broke below this last up close candle, I realised, okay, we've had displacement, we closed below that last up close candle, we have now a high, low, high, high, so this last down close candle becomes a breaker, and that's when I ended up collapsing my whole position, because I was like, yeah, it's not going to reach the highs. So, sometimes it's going to do this. You're going to manage a trade, you're going to have a target in mind, and looking at the liquidity above there, I think it's fair to say that, yeah, that's a good area to take profits, but you have to remember that this is a 1 minute chart, and this is a mistake I still make, and I did make, is I was in the 1 minute chart too much, and I lost concentration of the higher time frame narrative. This is a daily level. I'm looking at 1 minute liquidity pool. This is a strong level. So when I went back, and again, you guys can see this yourself, so this is a good study topic for yourselves as well. I decided I'd go back to the high time frame and zoom out and realize, look, I had this buy side imbalance, and I had this sell side imbalance. We already traded up to it, and then up through it again. So this is institutional order flow entry drill, and this is a balanced price range. There's no need for price to come back up here. And at the same time, we also had this last close candle. So we've got the order block, mean threshold of the order block. We've already had a balanced price range, and we've also got the discount end of the volume imbalance. So there's multiple high time frame PD arrays. Really, I should have looked at, and I should have thought it's unlikely to take the highs again and dip back into it because it doesn't need to. So yes, I was wrong on my target, but I still made money, as you can see. So you don't always need to be 100% right. And the important thing is going back, and when you're wrong, journal it and go back and look for instances where you've not been accurate, but try to find why you haven't been. If you document it, journal it, hopefully you'll learn from the experience and mistakes. So this one's a bit of a long one. I'm knackered now. It's going to take me a while to edit. So I'm hoping to have this out at least at some point Monday evening maybe, I don't know. But thank you guys for the patience as always. And I will hopefully try to get these out a little bit sooner at some point. But yeah, I'll catch you guys again next week. Right guys, how's it going? I hope you guys enjoyed your weekend. I've not been feeling too great over the weekend myself. I did end up eventually getting ill. Sat down to record this last night, but I had a mad headache, so I went to bed early. So kids have been at school Monday, and I haven't had a chance to sit down to record these until Monday evening. So I've had to readjust some of the slides based on what's actually happened and transpired over the course of Monday's trading. Firstly, we're in a period of where daylight saving hours are coming into effect, and we've also got the general elections coming out, so on Tuesday for the US. So there's probably going to be some sort of volatility in the markets, and personally, I'm not going to really be doing too much this coming week. Last week, again, we had a lot of high impact news. I didn't trade last week either. As you all know, there's a lot of tension going on around the world. And I keep saying, you need to respect the risk. And I think any good mentor would tell you that right now. Don't be going out and just taking silly trades. I haven't been, like ICT, I haven't been in the forex markets myself. I'm mainly sticking to the S&P 500 at the moment and really staying in the index market. I'm going to try to quickly go through the analysis and a few teaching points today. So hopefully this won't be too long of a video. So this was last week's trading when I took the screenshot from Sunday. And as you can see what transpired, I said that if we ended up running through this fair value gap, we may find support, which we did look at the bodies of the candles and we were wicking through this, so we wanted to stay above this fair value gap, dipping back into this order block. Again, rallied through the discount end of this fair value gap, and then found support, and then found resistance at the premium end of this fair value gap. Then on Friday we absolutely just tanked, closing below this fair value gap. So we've dipped inside of this order block, and this has become a balanced price range for me. So from this candle's low to this candle's high, we've gone down, we've repriced, we've whipped through, and then rebalanced. So in hindsight, my intention was to say that I expect price on Monday to probably trade higher into this balanced price range, and then we're expecting probably lower prices to take out this low, and I wanted to keep an eye on this mean threshold. Of course, I didn't end up recording, and this is what ended up happening. So we ran higher into the balanced price range, and then found resistance and sold off. Now, we did close below the mean threshold from, well, when I took the screenshot of this downfall candle. We ran liquidity here. Closing below that, the next area would have been this rejection block, so this last downfall candle. And I think from where we're currently are actually below the rejection block. If that's the case and we close below it at the end of the day, then the sell side liquidity underneath these relative equal lows, and possibly down here. This dotted line is a bullish breaker. So that would be like my initial first target, to sweep the sell side liquidity down here, and then dip in maybe to this volume balance, because again, between the bodies of these two candles, this is a really thin price action, so there's not any volume there. We did run through it, but only offered buy side delivery, so we may want to run sell side liquidity below these lows, and dip further down into this volume balance to maybe leave the body in there and rebalance some sell side delivery. So are we going to keep going lower? Time will tell. I'm still not 100% convinced that we've seen a turning point, but if we get below here and get below the volume imbalance, then yeah, it's possible that this could be a more long-term high for the dollar index, which would create a risk-on scenario for the rest of the assets, really. So we have to bear in mind with the general elections coming out, there's going to be a lot of manipulation in the market. So we really want to tread with caution over the next coming weeks. Euro dollar. Again, I took a screenshot from Sunday. We had come into this balanced price range. We found support around the consequent encroachment area of the fair value gap, and then really pushed higher on Friday, back through the balanced price range. So we've gone down, up, down, up, down. This is area being quite efficiently balanced. Price came up into this volume balance, and we had the order block. So I was looking at whether we could potentially get above this high and dig deeper into the mean threshold of this order block, maybe get back above this 100 big figure level. We have traded through it once, but we didn't spend a lot of time up there. We still have this volume balance left open above these highs, so we've got buy side liquidity above this order block and the closure of the volume balance. Where we go there, this is what we have today. We're currently trading around that mean threshold level. So we'll see if it goes back above that, then the buy side liquidity above this is likely. So if we're expecting high targets, this might be a decent short-term draw. We've gone back above that 100 level, so that may act as resistance if we do trade down into it again. We have that old high there, and these up close candles will become an accumulation block on the right-hand side. So a few things that could send us higher. But it's also likely that with the elections, we have some really volatile price action. And this might just come up to sweep all the buy side liquidity, rebalance, and then continue lower. We have this trend line forming down here. So there's a lot of sell side liquidity resting below this, and we still have the monthly fair value gap still left open. So it makes more sense with the way things are going on. And interest rate hikes and stuff are still expected. Once the elections are out of the way, we'll see what sort of direction the market really wants to continue in. S&P 500. So we ran higher and dug into this volume balance, found some resistance up there, cleared buy side liquidity, and then ran lower, closing below this down close candle, touching the premium end of this volume balance. We rallied from there and closed above the daily fair value gap, the premium end. So we may want to find a little bit of support, and then coming into Monday, Tuesday, I haven't actually looked at the chart for the S&P today, so it's likely we'll clear in maybe some of this fair value gap, go above it. We're inside of this daily order block as we are, and then from the wick to the body, we're inside of this breaker, so we've got the high, low, high, high to run the stops, and then broke below it. So we may want to spend a little bit of time in here, even come back to touch the discount end of this fair value gap and go lower. This becomes a balanced price range for me, really. So unless things change and the top is in place for the dollar, and we do keep going lower, then this may want to go higher and take out relative equal highs above here. I mean, we've already had this stop run to clear sell side liquidity below this low, and then we've had a breaking market structure. We've come down and found support back onto a balanced price range, and we're also inside from this low high, lower low, inside of this close candle, so we're in that bullish breaker. We have had a breaking market structure here. So if we don't find any levels up here that's going to offer us any resistance, and we are likely to clear buy side above here, we do have this fair value gap as well. So it'll be interesting to see if we do get higher, do we close above this fair value gap, and if so, could that offer us support and still continue to go higher? From this low to this high, we have found support at that 50% level, so this could likely even consolidate around here and allow the forex market to move. So we may see volatility coming in into forex, but as it stands, I'm still keeping an eye on the relationship between the different asset classes at the minute. It's worth noting that we have quite a long-term SMT divergence between the averages. So on the S&P, you can see we failed to take the higher and then broke market structure. On the Dow, we have taken that equivalent high, so we've run that buy side. and Nasdaq was really weak compared to the other three. We haven't taken the high, and on more of a short-term daily time frame still, we haven't seen the high posted in the NAS 100, which we have seen in the Dow and in the S&P. So that could be potential smart money distribution with a structure break. But like I said, until we get a really clear direction at the minute, like this is it's really difficult to put your finger on it, because we've had a market structure break in both directions, and we're currently sitting around the 50% level. So is it high probability trading? On small time frames, you can probably find some setups, but that's probably why we're really leaving it to right now, is in and out and short quick scalps. On the bonds, so this is the actual bond price. Again, we have more of a long-term S&T. The 30 has failed to make that high, whereas the 5-year and the 10-year, we have posted that high. So if we do continue with sell-side delivery, then the sell-side liquidity resting below this low is where we're targeting. And if that's the case, this is going to put upward pressure on the dollar index, because if we do continue lower in the bonds, it's going to send the yields higher, and therefore the dollar index should carry on higher. Unless, of course, everything starts moving out of sync. And personally, I wouldn't be surprised, just by the way the market's been moving and behaving over the last month or two. There's a lot of things that are out of sync that we're noticing across the board. When you have that, and again, it's something ICT has taught us, is that when you've got correlated asset classes that are moving out of sync, that is a period of time you're going to get low probability trading. So which is why I do tend to keep an eye on different classes to see what's going on. It gives me more of a general overview. When you've got things that are moving in sync, and they eventually will start getting back in sync, that's when you get your salad days, as ICT calls it, where you've got your nice, easy trading. Unfortunately, I don't see that on the horizon anytime soon. So I keep saying this and trying to reassure people, because I get so many messages of people really struggling right now. It's not easy. Like, I've really cut back in the number of trades I've been taking. I'm only really trying to take really high probability setups. So you're not alone. People have been doing this for years, and I speak to people still more experienced than me, and I get advice from them, and they tell me the same thing, that for all the years they've been trading, they've not seen the markets move the way they've been moving. It's a very difficult time to learn, but as the old saying goes, the strongest are made in the hardest times. I think I've heard that somewhere. We also have more of a short-term divergence between the bonds. So we failed to post a high in the 10-year and in the 5-year, and we posted a high in the 3-year. So again, does this show underlying weakness in the bonds? And if so, we should theoretically be going lower. Like I said, this is all going to be a good study for all of us, myself included, to see how these markets pan out. While I'm on the topic, I mean, I don't like to go into tinfoil hat talks and stuff, but if you're in the UK, especially, like, they are talking about blackouts and, you know, energy shortages, food shortages. It's all on the horizon. You know, I know ICT goes a bit crazy. I mean, we know ICT loves his tinfoil talks and stuff, and he loves to have a rant. But if you listen to what he actually says, the guy has a point. And a lot of the things that he says, even though they're really long-winded, he's been in this market a long time, and we have to respect the fact that this guy has a lot of experience. And not all of his conspiracies I agree with, but with the way the markets are moving and the current state of the world, the current state of the economy, I do believe we're headed to a whole new monetary policy. I think there's going to be a huge shake-up coming at some point. And whether you believe what ICT says or not, I think it's sensible for us to at least take it on board and maybe prepare just in case. I think that was probably a sensible thing, and I don't want to scare anybody, but there's no harm in being on the safe side at the end of the day. That's the way I'm looking at it. I've stocked up on things myself personally, and taken provisions just in case that we do get, you know, the heating goes off. A lot of the talks of these blackouts are going to be happening in the coldest time of the year, and I mean, we don't have the greatest weather in the UK, and in the winter it does get really cold. So I personally bought like wood burners and you know, logs and dry wood and stuff like that, just in case I need it. I'm hoping I don't. But if you're looking at what's going on with the news, they're already talking about it, and normally when that happens, whether it's fearmongering, whether it's true or not, I think what we've seen from COVID, and I know everybody has their opinions on that, and I've got my own, but I won't go into the details. What we did see factually is how people reacted at that time of crisis. Now, you know, people were punching each other over toilet paper. Like, it seemed at the time that civilization was collapsing. And based on what we saw previously, how COVID, I believe, was like the test of what's to come, before shit hits the fan, and being in this group, being in this mentorship, and being able to listen to what ICT says, we're in a little bit of a more unique position to have to predict what may come. Like I said, the markets aren't moving right, and there may be a black swan event on the horizon. And if there is, there's probably nothing we can do about it apart from getting our houses in order, really, stock up on long-term supplies. I'm not saying you need to go crazy with it. You know, every time you're out or you're going to the grocery store or shopping, just pick up a little bit extra. And things like you might need: candles, torches, batteries, stuff for heating. I picked up a couple of generators recently just in case, you know, just to charge your laptops and phones and whatnot. I'm hoping internet stuff doesn't go down, because I know it's make it difficult for me to do this. So I've paid myself a generator just in case I do have that event where the electricity does go. I'm hoping it doesn't happen, because we are heading into scary times. I'm not gonna lie. You know, I'm not personally scared about myself. What's going to happen is going to happen. But I think when you've got family, you've got children to worry about. I think that's when, me personally as a father, that's the scary part. You know, if we end up, you know, going into a war, or we have no food, we have no electricity, it's difficult being in a position where you have younger children, and you need to consider them above yourself, really. And in that situation, it's a lot more difficult. I mean, look, it's not going to hurt us just to stock up a little bit extra. And if we don't need it, we don't need it. At least we've got peace of mind. And if we do need it, we're going to at least be like, you know what, ICT was saying this for a long time. We had a lot of time to prepare ourselves, and now we're in a situation where we need the stuff and we can't get hold of it. Because if things really get out of hand, you've seen what it was like when COVID hit. You couldn't get anything from the shelves; they were empty. I guess as a mentor here, I'm just trying to look out for you guys as well, you know, so please don't take this like I'm not a conspiracy theorist, really. I'm just trying to think logically, and based on what I've seen myself, and don't forget I was in the middle of COVID working as a pharmacist, so I've seen it on the front line, really. I think it's more important than ever for us all to take care of one another, you know, so my biggest worry is desperate times make desperate people, and people will go to like some extreme lengths to feed the children, for example, you know, so God forbid things get out of hand. I just wanted to put my 2 cents in there, really. I've had a few questions what my thoughts were on it and stuff, and like I said, I try not to get too political, and I try not to get too conspiracy theory stuff, but you've got to really sometimes take a look around and think, right, is there validity to the things that people are saying? And I think with where we are at this point in time, things may get hairy, and we're going to regret it if we don't do our best to prepare ourselves whilst we can. So that's all I'm going to say on the matter. Anyway, I've digressed. I was taught by ICT, wasn't I? Right, E-mini S&P. So this is last week's price action. So we obviously had non-farm payroll last week, and I didn't trade last week. To be honest, the family was ill, so I was playing mum and dad, and then got ill myself towards the end of the week. So I guess it was a good thing it was non-farm payroll, because I really do scale back a lot and do very few trading the first week of every month anyway. But let's go over price action and see what transpired, and I'll give a few teaching points today. So Monday, the red lines at the beginning of the week, end of the week, Monday, Tuesday, Wednesday, Thursday, Friday. I want to do a little bit of teaching about dealing ranges, right? Now the markets move in ranges, and there's a lot of different caveats and stuff that as we get deeper into the mentorship, I'm hoping to delve into a little bit more. But the essentials to a normal dealing range is, realistically, the markets move with a program which we have spoken about in the Academy, and this ICT's concept is accumulation, manipulation, and distribution. If I could say the one thing how the algorithm really operates, its main go-to program is accumulation, manipulation, and distribution. In that AMD cycle is where we develop the dealing range. Right? So ICT has told us that the dealing range occurs when we take out a swing low, a swing high, and then the expansion is the dealing range. So on Friday, we had this swing low. We took the sell side liquidity here after we opened up on Friday, and then we ran the buy side liquidity here, and then we had this expansion, right, all the way into the daily volume imbalance on Friday. So the dealing range created was from this low to this high. On Monday, we retraced, consolidated, just typical for Monday, and then we had the algorithm go into this spooling cycle on Tuesday. Now this spooling cycle is done to engineer sell side liquidity below market, and it just goes higher and higher and higher and higher until it takes out Friday's high. That now is an algorithmic signal where IPDA has cleared buy side liquidity. So we've taken a daily high, right, and then we have aggressively, when news has come out, ran the sell side liquidity and broke market structure below Monday's low. So this is a key low created on Monday, this is a key high created on Friday, right? How do we break through that? We let displacement, right? So this is after we've filled in a daily PD array, right? After we ran the sell side and broke market structure, we went back into another spooling cycle of consolidation. And what is consolidation? If there is engineering liquidity above and below the market, right? So on Wednesday, we had these relative equal highs, and we ran sell side first, right? That's important. We ran the displacement, and we left the buy side liquidity and the fair value gap, and then found support at the premium end of the daily fair value gap. The news came out, and this is all manual intervention, right? This is why we don't trade high impact news drivers, because you're going to get this, and that's basically a stop run. It's a run on the buy side liquidity and back into a daily high time frame PD array. We also had these last close candles, so this is one bearish order block, which is the high probability order block. This one. Why is that? Because it's inside of a high time frame PD array, right? So ICT teaches the low to the mean threshold is the most sensitive area of an order block. All of this above here is running stops, right? We run stops above that. And then we have change state delivering broke, leaving displacement. The order block starts with this candle, and this candle is also inside of that daily premium array. So this is going to be a high probability order block in these series of up-close candles. It's not always going to be just the up-close candle before the down move, even though we've seen this displacement, and this looks like, yeah, this might be the high probability order block. Then you have to look at the hierarchy of the time frames. This is a daily PD array. This is a 1 hour up-close candle, right? We also have this last down-close candle in here as well, which is our distribution block. We get into that nicely. And we have from this candle's low to this candle's high, we have this hourly fair value gap, which is also nested inside of the daily volume imbalance. So they ran price higher, clearing out the buy side liquidity above these equal highs and into the higher time frame premium array. And then as you can see, price really rolled over, attacking the sell side liquidity below this low, and it travelled right through the fair value gap. We then had a little bit of a bounce higher, came into the daily fair value gap, back into this high, low, high, high, so we have a breaker. And we also have the consequent encroachment of this daily fair value gap, so we found resistance there. Price rolled over and into the opposite end of the daily volume imbalance. So we had a daily volume imbalance up here and a daily volume imbalance down here. Interestingly, we open right in the middle of these two volume imbalances. And if you extend that weekly open out in time, we nail it perfectly on Friday. If we take this low to this high, not this high, this high. Why? Because as we broke structure here to the upside, this becomes a new higher high, right? So we have to extend the dealing range. So initially, the dealing range was from this low to this high. Then when this high got violated, the new high becomes the high of the dealing range, right? If we run a fib from this low to this high, we get that 50% level. Number one, you should notice around that 50% level is where we're likely to see fair value gaps form. If we extend that out in time, the 50% level, look at the bodies respecting that level there, right? So this was all manual intervention, but the bulk of the volume still respected the 50%. Also notice that at that 50% level, we also had another displacement in fair value gap, and the consequent encroachment area lies perfectly in that 50% level. This is algorithmic market structure essentially, right? Now, how did we break the dealing range low? We let displacement, right? Again, that's an algorithmic signature. Where did the dealing range start? So price fall over here was inside of the dealing range from this low to this high. Well, this is where the initial dealing range started. So this is your initial consolidation, right? So we had our accumulation, then we had our manipulation, then we had our distribution. So we ran the lows, we ran the sell side, the buy side, and create our initial dealing range, right? So our initial dealing range from Monday, Tuesday, Wednesday was created on the Friday. Now if we take high and the low and we project our fib standard deviations, 1, 2, 3 standard deviations almost gives us the high, and 1, 2 standard deviations down, we get 3704.5. I'll left the cursor hovering above this candle, and we come in at 3704.25. So 0.25 off. So again, IPDA is going to look at these dealing ranges, and where the initial consolidation is with these dealing ranges is where it will project standard deviations. It's based on mathematical formulas, really. So the whole structure is based on mathematical formulas. To go into a little bit more detail, we broke this low, so the dealing range low, we broke that with, again, displacement, so again, algorithmic. And then we came lower and made the low on Thursday, right? So the high was made on Tuesday, and the opposite end was made on Thursday. So the new dealing range, after we broke the dealing range low, is going to be from this candle's high and this candle's low. Why this high and this low? What did we have here? Well, this is our accumulation phase, right? This is accumulation, manipulation, ran the buy stops, and then distribution, we ran the sell stops. So initially the dealing range was from this high to this low, and then we extend it because we broke the low, but we have the high still intact. So until this high gets violated, or we see a smaller short-term dealing range, which you can always get dealing ranges inside of dealing ranges. You want to keep on the high time frame dealing range structure. So we're here on the hourly time frame, of course, you're going to get smaller micro dealing ranges when you go to a lower time frame. But again, just like how we're using the high time frame PD arrays and high time frame narrative, that's the same way you want to look at it when it comes to high time frame dealing ranges. Once we broke below this low and we extended the dealing range from this high to this low, 50% of that dealing range also sits inside of this fair value gap. And on Friday we came back and nailed the 50% level again from that dealing range, which also overlaps with the weekly open, which started that initial cycle. So when you start blending dealing ranges, premium discount arrays, market structure, time of day, liquidity pools, consolidation areas, high impact news events, it's impossible to think that, like, knowing what we know and how we can now see price and how price reacts to levels where we anticipate now, it's very, very, very difficult to say that there isn't an algorithm that runs these markets. And when you dissect everything down, you have to understand that if everything is based on time and price, and the algorithm is very limited in what it can do, there has to be certain macro points that the algorithm has to refer to. Whether it's macro points in time and macro points in price, the low, the midpoint, and the high all have significant implications when it comes to them being respected or broken. And that is another way how we can understand bias and narrative. Of course, we have to put order flow behind that. And I think when many people come into learning ICT concepts, you see, oh, there's an order block, there's a fair value gap, and it looks like it's easy. Now, some of you have been here a while, and you can see that it's not as easy and straightforward as it looks. This goes a whole lot deeper, and it goes deeper still. I am still only really scratching the surface of things here, but I call this algorithmic market structure. And the reason for that is because the algorithmic market structure is based on macro price points. It's based on macro price points that the algorithm should retain in its logic. And in between these price points, it will engineer liquidity in the form of spooling cycles and consolidations. Anyways, I've waffled on this one. I'm drugged up with medicine, so allow me. So hope you guys found this one insightful, and I'll catch you guys again next week. Right guys, welcome back. Hope you guys enjoyed your weekend. So we have the dollar index daily chart. As you can see, last week we had a fair bit of movement. We did dip down into our volume balance and we left our body in there, but we really ran through that. I didn't expect us to run this low, if I'm being honest. With the recent price action that we've seen, especially during CPI news, we've had a lot of volatility, so I guess it should have been expected. I wasn't in last week, I wasn't trading, I was just sitting on the sidelines observing and waiting for more information. I said that if we got below the volume balance and below these lows and this balanced price range, then it's likely that we may want to continue going lower. From where we currently are, we've already run through this balanced price range and run through this last close candle, so we're below that breaker, we're below the volume balance. We cleared sell side liquidity resting below these relative equal lows, and we've just tipped the premium end of this value gap. We also have this low, high, low, low, so we cleared sell stops here, so this last close candle becomes our breaker, and we've travelled into sort of the mean threshold of that breaker as well. So this is the dollar chart on the weekly time frame. As you can see, we really rejected from that monthly fair value gap premium end. We really rolled over, breaking market structure a few times. This was a key low for me. We've taken the sell side liquidity below these relative equal lows and then dipped into this fair value gap and this last down close candle, which is our order block, which sits inside of that weekly breaker. So there's a few arrays over here that align up for a bullish move higher as a retracement. Because we've broke below this low, and we've travelled through the open of these two book close candles. For me, this is a change in state delivery and a breaking market structure at the same time after we've come into a higher time frame monthly PD array. So this might want to hold as a long-term high, which will be interesting if it does. From the open of this candle to the high of this candle is our fair value gap, and if we split that in half, we've got our consequent encroachment, which again overlaps with that daily fair value gap and the other arrays that we've just highlighted. So I'm expecting some move higher. I think where we currently are on a Monday, whilst I'm doing this recording, we've travelled into this fair value gap. We've had buy side and we've had sell side. So first we need to get back above these lows and above this fair value gap to see how far high we could retrace. From this high and this low, we have this breaker, so high, low, high, high. And this was the last down close candle before we ran the highs, closing in that monthly fair value gap. So we obviously broke down. So if we do get any retracement higher and we do get back above these lows and back above the fair value gap, then that breaker might provide some sort of resistance and see if we want to continue going lower. From where we are and how far we've travelled down, I'm less bullish now than I was last week on the dollar. I still don't want to call the top, and again, this is something that ICT have learned over the years. Picking the tops and bottoms has always been a bad idea. You want to let price tell you and prove to you what it wants to do. Now that we've had a structure break below this low, and we've had a change in state delivery with the order block. But anyway, from where we are right now in the dollar index, I'm expecting a little bit of a move higher. My first objective is to see if we can clear above this fair value gap, and then see what happens when we get into the breaker if we get there. It might not get there. We might just get into this fair value gap because we reach the premium end of consequent encroachment and then roll over and attack the sell side liquidity below these lows. So on Monday we haven't got a lot of news, so we might just have a day where we just choppy price action going up and down. So we want to look towards mid-weekly economic calendar to see what price might present to us. Euro dollar, so monthly time frame. So we have this up close candle, and the low is that low of this order block. As you can see, the body's respected that quite nicely. We have keyed off this fair value gap, but we haven't yet closed that in, whereas on the dollar index we did see that close in. So if you remember back to the lecture about divergences between premium and discount arrays, this may be a turning point again. We've already gone through previous lectures about the open interest, the COT data, looking at the T-notes and the bonds and the yields. So until I had more information, I wasn't ready to say that there was a top in place for the dollar. And I'm still not bullish, I'm less bullish than I was last week. So with that information, we may be expecting higher price still to come on foreign currencies. The weekly chart for the euro dollar. So we have this down close candle, which is our mitigation block. Why is this a mitigation block and not a breaker block? There's no swing high here. We have a swing low, high, and then we break below that low. So this is our mitigation block. The mean threshold of this candle sits inside of this order block. The open of this order block, we've got a little fair value gap there above these highs. So we have some buy side liquidity resting above these highs with a little fair value gap and our order block and mitigation block. So from this low, high, lower low, this is the last close candle, so we are inside this breaker. So I want to see us first break above this to see if we're going to give any levels up here. Whether we get up here and then reverse, again, it's possible depending on what's happening with the dollar. If we get any retracement, we have this order block high, so these last two down close candles. This high sits inside of the breaker, so if we do get any retracement, these levels may act as support, and then we may want to continue higher to fill in this little fair value gap and back into the order block. We also have a volume imbalance over here, which also sits above this buy side liquidity above this high, which we haven't yet tapped into. So going into next week, we may see a retracement lower first, and then maybe continue to push higher, filling in this volume imbalance and then this little fair value gap. We don't want to look too long term at the minute. We just want to look close proximity and see where the levels are, where's the likely draw on liquidity, and again let price tell us what it wants to do. Daily chart. So as you can see, we broke through the volume imbalance and we ended up dipping back down into it, finding support from the volume imbalance and that balance price range, and then we really pushed higher, filling in that volume imbalance that was left open and cleared the buy side liquidity above these relative equal highs. We really pushed higher. We still have these equal highs up here. I'm surprised if it coming this high up, it didn't want to pop into it once more, especially with that volume imbalance still sat there. These are upside objectives if we do get any more downside on the dollar. E-mini S&P weekly chart. So we've come into the mean threshold of this monthly order block. We still have this volume imbalance. We've had buy side, sell side delivery. I want to see price maybe come back up into there one more time, and that may offer us some resistance. Of course, if we do travel through that, then this is going to act as quite strong support, and we're probably pushing higher. We have this high, low, we run through that, so we're still inside of this breaker, inside of a premium level. So I'm not convinced at the moment that we completely turned a corner. I am giving caution to these high time frame levels, especially with the move that we've had. We really cleared a lot of buy side liquidity, especially above these equal highs. So any more upside movement, if we get above this volume imbalance, then I think buys are going to be a little bit more safer. From where we are currently, short-term buys maybe to get back up into here, but once we get here, I want to really reassess. If we get here, I want to really reassess what price action is likely to do. We have this last down close candle separated with this volume imbalance. We have this down close candle. So we found support within that volume imbalance and the open of this candle. If we do get any more upside, we also have this accumulation block which sits inside that volume imbalance. So this may be another area where we may start accumulating more long positions if we get above this volume imbalance. So that's basically how I'm playing it at the moment. So once we're here, we want to really look at the lower time frames and see if that's going to give us any clues as to what price is likely to do next. Daily chart. So we found support within this balanced price range. and obviously price exploded, taking out the buy-side liquidity above these relative equal highs. And we dipped into the daily fair value gap, so between this candle's low and this candle's high, tapping into this daily gap. So between this candle's high and this candle's low, there's nothing there. That's an actual gap in the market. And we have sell-side delivery, so this is really inefficiently balanced. It looks like it would want to move higher. We have, like I said, that weekly volume imbalance. We can narrow that down to the daily volume imbalance up here, so it's like darker shaded blue, which sits around the consequent encroachment of the daily gap as well. So if you were to raise up here, like I said, this might offer us resistance to send us lower, and that could just be a retracement to go back higher. So when we're at the extremes, especially on the higher time frames, we want to go right down to the lower time frames. And the extremes is what's going to set up our opportunities, and then we can trade going from one end to another. When we're in the middle of the ranges, that's when you're likely to get your consolidated price action, and that becomes a bit more difficult to trade. I mean, of course, there are models that you can trade within consolidations. I have my own personal model in consolidations, but I prefer to trade at one extreme of the range and the other extreme of the range. I had a question regarding that, so I just quickly answer that one. So keep an eye on the low time frames to see what happens down here. Again, if we get back above these levels, then these should hold as support, and we're probably likely to be pushing higher. We have this candle over here, which is an accumulation block. This is the left side of the curve from this low, and this is the right side of the curve. So this book close candle on the left side of the curve, we extend that out, becomes an accumulation block, where we're likely to find support, which also overlaps with this daily volume imbalance, and also overlaps with this low, high, lower, low. So this last book close candle sits inside of that daily volume imbalance, as well as these 4 down close candles. So this is one bullish order block. So if we do get any retracement, this area over here is where we might find some support for us to continue higher. If we go higher first, then this is going to be likely a breakaway gap, and we're going to continue higher. So this is the dollar index on the monthly time frame. Now, as you can see, I've got quite a lot of data on the chart in front of you. And today I'm going to do a teaching on the higher time frame. And this is really in response to a question that I got asked this week. And cut long story short, the person asking the question, he likes to trade high time frames. He's more of a swing position trader. And he wanted to know, which is a fair question really, is how can the low time frame precision, how can that be used on the high time frame? So when we have things like central bank dealers range and standard deviations and how we can get it so precise as you've seen throughout this mentorship, I'm going to do my best at least to try to keep it simple but explain how, regardless of time frame, the algorithm is fractal in its nature. Now, the hypothesis for me was a few years back when I sat down with the charts and I was doing deep study about central bank dealers range in different ranges, and it baffled me how accurate and how precise sometimes I could call the high and low of the day. And it got me thinking that if there is an algorithm that dictates price in the market, then there has to be a mathematical formula that is going to predict price projections, which we already know about deviations and standard deviations and whatnot. Now, a deviation of a range is taking the high of the range, the low of the range, and mathematically projecting the difference of that range either higher or lower. So say we have a range of, say the high comes in at 300 and the low comes in at 200. We have there a range of 100 pips. Now, if we take that 100 pips and we multiply that, say by 2, 3, 4 times, that's going to give us standard deviations of that range. So this got me onto a deep study about ranges, and how something that ICT once said to me is the market moves in ranges. And when I really sat down and chewed on that, and I thought about what are ranges, and when I understood the foundations of what makes a range, I was able to go into the markets, and I came up with this concept known as algorithmic structure. You haven't heard this before. ICT hasn't mentioned it. It's not mentioned in the forums. It's not mentioned anywhere. ICT has given us clues about algorithmic structure. Algorithmic structure is based on price. It's not based on candlesticks, right? So the beginning point for me to understand ranges was to really understand accumulation, manipulation, and distribution. So our A and D plan. And the reason for that is because when we clear buy side and sell side liquidity, and then if the reprices in a certain direction, the clearing of liquidity on both sides of the market is a reset. And that sets up a buy or sell program because we clear liquidity and now a buy or program can start. When that buy or sell program ends is when we have the high and the low of the dealing range, right? When I started looking into dealing ranges and finding price points within the dealing range, it allowed me to combine market structure, algorithmic structure, as well as premium and discount rates. So I'm really trying to find a better way how to articulate what I'm trying to say, and it's quite difficult. So I'm going to try to show you how there is something other than market structure that is influencing these charts, and this is what I believe is algorithmic structure. Anyway, let me just get into it so you'll understand. So this is the highest high, and this is the lowest low in the structure that we can currently see, right? So if we line up from the high to the low, we get our 50% over here, right? Now, if you take a look at these highs up here, yes, we went higher with this candle, right? But the bulk of the volume is in the bodies, right? And as you can see, we went higher over here with the bodies. So this is the highest body candle, right? So we closed above the rejection block over here. Now, these down close candles is our sell program before we go higher. So in a way, you can look at this as your breaker. So the bodies run through that rejection block. So now I want to anchor the fib from the highest body candle to the lowest body candle, right? And I'm going to get that 50% line, right? Now, ICT has also said that there is usually 3 main parts of a deal range. We have the high, we have the low, and we have the 50% level, or the mean threshold. And this is true also for many of the macropedia rates I'm looking to, right? We usually have the high, the low, and the midpoint. Take an order block or a fair value gap, for example, right? Now, what do we see at 50%, especially on a high time frame? And I've mentioned this many times throughout this mentorship already. Now, we're likely to see a consolidation. As you can see, right at that 50% level, we have a consolidation, right? We have the consolidation high, we have the consolidation low, right? We run buy-side liquidity when we run through those highs, and we run sell-side liquidity when we run through those lows. So this becomes its own dealing range, and price from this high to this low has stayed in this dealing range until we run through it over here, right? If we take a high of that dealing range and the low of that dealing range, 50% sits exactly within 50% of the larger dealing range, right? There's a green line on top of that green line, right? I haven't changed the fib tools or anything, so that sits right in the middle of it, which is quite interesting. We have another dealing range from this high to this low. Inside of that dealing range, we've taken the sell-side liquidity here, we've taken buy-side liquidity here. So this is now a dealing range, right? This was all sell side, so we're in a sell program. After we've hit our accumulation, manipulation, distribution. Our distribution leg is a sell program. This leg ran sell side liquidity over here, right? Inside of this dealing range, this was all again consolidation. I'll get to that part in a minute. If I take the high and low of this dealing range and I project half deviations upwards, I get almost the very high of this range, and I almost get the very high of this candle as well. If I take this dealing range low after we cleared sell side liquidity, we cleared buy side liquidity when we run through here, right? So from this low to this high is another short-term dealing range inside of this larger dealing range. If we split this dealing range into 25% sections, 25% deviation higher, we get the close of this candle, and 25% higher, we almost get the rejection block of this candle as well. Look how that offers support around here. Why these levels are important. We clearly have a market maker sell model here. This is the lowest point, right? If these deviations were to hold some sort of weight, surely they should respect price points on the left side of the curve, because the algorithm moves based on price points within its logic. We call these premium discount rates, right? If we extend these out, what do we see here? We see the discount end of this fair value gap, also the low of this order block, and also the low of this break block. If we extend this one out, we have a low fair value gap, and the low of this order block. If we extend this one out, we get 50% of these 3 close candles, which is our accumulation block. Funny that we accumulated inside that accumulation block. If we extend this one out in time, we have this fair value gap, order block. And if we extend this one out, fair value gap. We run these lows here. So this becomes a new dealing range low, right? Then we run these highs here. So the dealing range from this low to this high, if we extend half a deviation upwards, and move that out, we get the very top of this rejection block. So these last down close candles is that breaker that we have, right? If we also take the middle range from this high to this low and project deviations of 50% higher and lower, we also get this level here, which also aligns with that same macro price point. If we take the range high and low and we calibrate to this anchor point, which is one of our deviations, look at how all the other deviations align up perfectly, right? Once we've run our sell side liquidity with this distribution leg, and then we had a change in state delivery, the sell program ended here, and then this set up our consolidation range, right? If we take the low to the high of the range that created the consolidation, everything was still inside of this range. That 50% level also hits the level that we outlined between this high and this low, and also the level that we outlined between our initial sell program. I know from the looks of it, it looks like you're pulling levels out your ass. But if you go back and you backtest this over different time frames, and yes, you're not going to be exact with highs and lows. A lot of times you're not going to be, because like I said, there's going to be differences in the prices between brokers. And there's always that slight deviation where we have that 1 to 5 pip rule. But this is a monthly time frame. And looking at structure this way over the years and understanding that, okay, essentially algorithms are based on mathematical formulas, right? So there has to be a mathematical formula that's running beneath the surface of the markets. And the way I can interpret that mathematical formula is based on what I've shown you here. This for me is algorithmic structure. And within this algorithmic structure, I can then identify where my high probability PD arrays should or shouldn't form. This also gives me an indication of how high or how low price can go. It also gives me an indication of when I should expect consolidation. It also gives me an indication of where my high probability fair value gaps may form. And this goes deeper still, and this is like sort of the foundations of the hypothesis I had a few years ago, which I went and delved into. The closest thing that ICT has got to talking about this is where he's grading his price swings. Now, when people ask me questions and I try to give them an answer, you have to understand there are so many different components that have to be blended together in order for me to explain it. And this has been very difficult to explain. You have to understand many different things: dealing ranges. You have to understand market structure. You have to understand premium discount rates. You have to understand consolidation, manipulation, distribution. You have to understand price grading. You have to understand equilibrium points. You have to understand liquidity. When you blend all of these things together, you get algorithmic structure. And based on algorithmic structure is when you can start understanding the hierarchy of the PD arrays that are in place. And that's a whole other topic. So yes, it gets deeper, and you can get really, really precise, and you can get on the right side of the market once you really understand how all these concepts blend and work together. I'm not going to get a lot of questions about this thing up here, and this is based on buy and sell programs and buy and sell macros. It's again a very long-winded thing, but I wanted to include. I don't even know why I included it into this one because I'm not going to get loads of questions on it. But I just wanted to show you the precision elements of how they still all align. Everything works hand in hand. You know, it's not random. There's a structure. There's precision. The algorithm is super, super precise, and it's super efficient. And when you understand how everything blends together, you can start going towards the PhD level ICT stuff. Please don't share this. This is not supposed to be public knowledge, and it's taken me years to really identify things like this in the markets. And this is the first time I've ever taught it. I'm going to expand on things as we go throughout the mentorship. But people think I'm just regurgitating free level ICT stuff. I have no idea how far and how deep this actually goes, and the time that I've actually invested into these markets and learning what I know. So I hope you can appreciate that and keep this kind of information just for our group. Picking the right price points and understanding the timing of these macros is a whole other topic. And again, it requires a lot of background. And like with everything with ICT stuff, requires a lot of preliminary understanding. So, but this is just to lay the foundations of when I said that there is algorithmic structure behind price. This is what I'm talking about and what I'm referring to, is that there is a structure based on mathematical calculations and not just candlesticks. So with that said, I hope you guys found this one insightful, and I will catch you guys again next week. Alright guys, how's it going? Hope you guys enjoyed your weekend. So, before we begin, I've had quite a lot of feedback from last week's video, especially in regards to the algorithmic structure. It's been mixed reviews. I've had the highest number of people who left the mentorship after that video. But at the same time, I've had a lot of feedback from the more experienced students who have really been blown away with things that they've managed to go back through their charts and find. Now, there are many things in the charts that have yet not been spoken about by ICT. And you can end up going down some crazy rabbit holes. My advice is not to lose sight of the bigger picture, right? When you're doing your backtesting, the extra things that you learn, which will help with precision entries and stuff like algorithmic structure, don't let it take over everything else that you're doing, alright? The reason I brought it up was really to answer a question and show that the algorithm is super precise and there is an algorithmic structure. It works on every time frame and it gets so much more detail than what I've already shown. In order for me to really fully delve into it and explain it, that I'm probably going to leave to if I ever come out with a chart level mentorship, because there's a lot of background things that you need to understand, and there are a lot of very brand new people to ICT concepts in this mentorship, and if I go down that rabbit hole, I'm going to confuse a lot of people. So the truth is, you don't need to know it all. You don't need to go that detail into the algorithm. I could spend hours and hours and hours talking about a single chart, and I know that can sometimes be quite daunting for brand new students who, I can imagine, when I was first brand new to ICT and I got thrown into the deep end, I was like a deer in headlights. So I do fully appreciate it, and I'm not here trying to make anybody feel like this is just impossible to get, because it's not. And you don't like to need that kind of detail to make money in these markets. The high level stuff that I teach is more towards the more experienced students, and if you don't fully appreciate or understand it right now, you have the videos. I recommend that everybody download them. And a year down the road, 2 years down the road, when you've really understood the concepts properly, and you can go back to some of those videos, and I promise you're going to find things in there that you missed the first time. It happens to me when I go back through ICT's videos, and I still go through his old commentaries. I've been through them quite a few times now, and yes, it takes a long time. But when I go back, sometimes I'm amazed with the things I've missed, because I didn't fully appreciate it or understand it when he was first talking about it. And then when I went back through them again, I'm like, wow, it was there all the time. Anyway, the charts are still printing as I'm doing this recording, but I create the slides on the 18th. So I want to get through this quickly before we really have any major moves. So we have the dollar index on the daily chart. Now, as you can see from last week's price action, very consolidated. We did travel higher into the weekly fair value gap, so it was a great shaded area. Came to a consequent encroachment, found some resistance, and we did sink a little bit went below the fair value gap. We found support on this daily fair value gap, and then really consolidated between the weekly and that daily fair value gap. So when price is between two fair value gaps, that sometimes is quite common. It's a common area where you'll see consolidation. We do have these relative equal highs, so this area, we have a fair value gap from this candle's low to these two candles' highs. So price is most likely going to dip in there. I had a quick look this morning, and I think we'd already gone above these highs and dug deeper into the fair value gap. We do have the balanced price range still above us, so it's be interesting to see what happens once we get there. Do we want to break down, or do we want to continue higher? Of course, if we continue higher, then the next area we're looking at realistically is this volume imbalance, which sits inside of this breaker. So from this candle's high to this candle's low, that takes us back above 50%. This candle is the energetic one that runs sell side liquidity. So if we do get any more upside, then this is another area we're looking to see what happens on the lower side frames. Of course, if we get back above that volume imbalance, then maybe we could be going back to revisit these highs up here. Right now, from this candle's low to this candle's high is our dealing range, and we're currently in a deep discount. I have a few mixed opinions of where the market's likely to go, which we'll get into during this lecture. From where we currently look on this time frame, at least, it looks like it wants to break down and go low below these lows, but there is a case for both sides here, which makes me a little less bearish right now from where we are, and I'm sure you'll understand once I go through the slides. Right now, we have dipped into this area, right? So this is a market maker sell model at the minute, right? This is your initial consolidation. We ran the lows here, we ran the highs here, but prior to running this high, we have these equal highs and these equal lows. So this for me is my initial consolidation. This is the beginning of the deal range, right? Now we've come into the equilibrium level, so halfway of that initial consolidation, we dipped into it. From where we are, this is number one, drawdown liquidity is the equilibrium of the consolidation. And from here, we're either going to obviously drop below and take out these relative equal lows, or this could be accumulating for another leg higher. Now we've been looking to call the top on the dollar, as you all know. Market structure still looks bearish to me, but let's go through a few things which will give me a case for the other side. Interestingly, if we take the high and the low of this consolidation and we calibrate it to this black line, which is the weekly fair value gap, we get 3.5 standard deviation, nails the very high of our dealing range. Again, price is fractal, so you'll see this work on all time frames, so it's one for your studies. I'm not sure what this blue line is, I apologise, just ignore that one. I must have been doing some backtesting stuff and left the line on there. Anyway, this is something that I don't know if it's been introducing this free content or not, but I'm introducing it here. When we have a high, and then a lower high to the right, and a lower high to the right, this is what's known as a low resistance liquidity run, where we have a pool of buy-side liquidity, right? Like it will attack and run through these without much resistance, hence why ICT calls it a low resistance liquidity run, right? Over here we have a lower low, right? So we already ran sell-side liquidity below this low with these lows over here. We have relatively equal highs up here still, and that still looks to me suspect. And just with the late liquidity and that low resistance liquidity run, this is why I've been a little bit dubious about calling the top on the dollar. I may be wrong, but right now on the charts, based on this lower low, we have a high resistance liquidity run signature to the left, right? And we have a low resistance liquidity run signature above us, above the market, right? So this still for me could be as a longer term draw on liquidity. Of course, there are a lot of factors that are going to determine what the dollar does, and it's going to have an impact on the rest of the market. From where we are, even if market structure does look bearish right now, we have come into our initial consolidation into the equilibrium level. We do have the weekly fair value gap that we dipped into, and we have that daily breaker. So there's quite a few arrays here that should support price. If we can travel higher and get back above the weekly fair value gap and the balance price range, I want to see how price is going to react once we get to this volume balance. We still have this fair value gap, so fair value gap, volume balance breaker. This could easily go back above the equilibrium area and find resistance and come lower. We could also just consolidate in this area, and with everything that's going on, I wouldn't rule that out because we're also going into a time of the year where the markets do tend to move out of sync, and when that happens, we usually get a consolidated market, and that's the reason why ICT from mid-November to the beginning of February doesn't trade. From my own experience, I've had hit and miss over the years. Yes, price action doesn't usually move as smoothly when you don't have like seasonal tendencies and other factors in play, but we obviously have much bigger problems going on around the world right now, which is why he's staying completely out of the charts. I'm not going to make that decision for you. You guys are, you're all people you can think for yourself. My advice is if you are planning on trading, just approach it with caution. Understand that when we get decoupled markets, we are likely to go into periods of consolidation. So don't look for over-exaggerated moves during this time of the year. I'm not saying it can't happen because I have seen quite good price action, to be honest with you, during this time of the year in previous years. But I've also seen horrible price action as well where I got eaten alive. So tread carefully over the coming months. Another indication that the dollar may be going higher is we have this S&T divergence between the euro, the pound, and the dollar index. As you can see, on the dollar index, we failed to take as low, so we made a higher low. On euro, the same opposite high, we've already run that, so we made a high on the euro. And on the pound, we still failed to make that high. So the euro is diverging higher. So this is obviously S&T divergence and potentially underlying accumulation of the dollar index. Looking at the T-note, so this is a 5-year T-note, this is the bonds price. Now, we came and last month ran into that volume imbalance, which we highlighted last month, and we've had a retracement higher into this balance price range, right? So on the monthly. This doesn't really give us any major signs of it turning around at the minute. We still have the sell-side liquidity, so these relative equal lows, so there's a big pool of long-term liquidity resting below this. That still, for me, looks like it might be the draw. And if that is the case and we do go lower, I mean, we still have this fair value gap to trade into. Ultimately, if we do get down here, that's going to push the dollar higher, because obviously the yield is going to go higher as the bonds come down and the dollar index follows yield. So comparing the 5-year, the 10-year, and the 30-year, the bonds prices, as you can see with the 5-year, we've come into that monthly balance price range, this is on the daily chart. We've got a low resistance liquidity run signature, so we've got a higher low, and so this low is higher than this low, so that validates this as a low resistance liquidity run, so it's the opposite of what we've just seen in the dollar index. And again, that's true for across the board for all three of the averages. Now, we found resistance. Look at the bodies of the candles respecting that monthly balance price range, and we've come into this last close candle. We have this order block. It's worth noting that we've travelled through and rebalanced the daily fair value gap on the 5-year. We've done the same thing on the 10-year, but on the 30-year we haven't had the legs to come up into its premium fair value gap. So this could suggest underlying weakness in the 30-year. At the same time, if we zoom in and look at the recent highs, we failed to go higher on the 5-year, failed to go higher on the 10-year, but we made that higher high in the 30-year. So could this just be taking out highs before we go lower? I do like how we closed below this volume imbalance, and we've also closed below the fair value gap, and we've run the open. So potentially a change in state delivery. If we break below this low and then get back below that monthly fair value imbalance, then this is likely to go much lower. And if that's the case, it's going to send the dollar higher, which is again a risk-off environment. So be interesting to see. It's worth noting, so this is the open interest, this purple line for the dollar index. Now this is the daily chart. So as you can see, we've come into the fair value gap and we've dug into that and found support. Whilst we were having this big sell-off on the dollar, open interest was declining, right? So this could suggest that the banks are taking profits down here. And at the same time, this is the dollar index call report. So this red line is the commercials. If we take the equilibrium level, so from the highest high to the lowest low in the last 6 months, we get our new zero line, right? So again, this is all in ICT's YouTube month 5 content. Once we get the zero line, we can split the commercial report. So anything below the zero line, the commercials are net short. Anything above that zero line, the commercials are net long. So as we've been dropping, the commercials have been buying. So with the reduction in open interest and the commercials being net long, this could be a potential area of accumulation. There's many other factors, and this might not just alone be enough for us to say that this could be a turning point, but I think you'll agree that there are a lot of factors here that suggesting that we could be moving higher with the dollar index. Euro dollar. So last week we did in fact run into, I think this was a volume balance or a small fair value gap that we ran into, found resistance on the mitigation block. I've had a few questions regarding what I think the future of currency is going to be. Honestly, I don't know. Central bank digital currencies are most likely coming out. I think that's inevitable. I'm not going to be able to escape from it. And when that comes out, we're going to see crazy stuff going on. And I don't want to be in this asset class when there's so much uncertainty, and that's just how I'm looking at it. ICT hasn't been trading forex, I think, the last year. I'd rather focus my attention on the index market because those major corporations and companies, they're still going to be doing the same thing that they've always done. So there's always still going to be a market there. Over the coming months, I'm going to shift a little bit of my attention onto the commodities market with food in particular. So soybeans, corn, grain, wheat, sugar, coffee. Personally, I think those are the markets that you really want to be in over the coming next 6 months to a year. I think we're going to see some really big moves in that market. Again, Michael's been talking about this the last few years in his private mentorship, and recently did a space on Twitter where he touched upon it. So I'm going to do some analysis on that market in the coming months as well. So I'm not saying that you should do the same. If you want my opinion or my advice on it, this is what I'm doing. But I'm no ICT, and you guys are all independent thinkers, and you can make your own decisions on that. But yeah, anyway. Again, we've had a bit of a consolidation going in from last week. Again, as expected, we've had the dollar in consolidation last week. So at the minute, I'm looking at this fair value gap. And again, whilst I'm talking, it's probably already traded down into this now. What time is it? It's about 2 p.m. on Monday. That's my time. This is going to be my first area. And the reason, again, I have those relatively equal highs on the dollar index, which I think we're likely to trade up into. And if that's the case, then this is going to be the draw on liquidity for euro. It'd be interesting to see what happens once we get here. Do we accumulate and go higher? Potentially. Like I said, we're still inside of this breaker. But with everything I've outlined on the dollar index already, I'm less bullish on euro than I was last week. So it'll be interesting again to see if we do go below this fair value gap and we do get a run higher on the dollar index, then we've got this volume imbalance I might want to revisit to again. Of course, it has this fair value gap below here as well, which also sits inside of this breaker. From this candle's open to this candle's high, below 50% is where that fair value gap is sitting. And we also have that weekly order block, so this is the high of that weekly order block. So we have discount levels sat in a discount market. Why the open of this candle and the high and not this candle's low and this candle's high? Well, you can do this candle's low and this candle's high. But when I have an extended move like this, again, this is probably not taught publicly, this is not high level chart teaching, but we had a change in state delivery after we run the open of this candle. So if we take our fib and we run it from the open to the high, we can use that as a range as well. He's taught it somewhere in one of his commentaries. I can't remember whether it's a chart level commentary, but now you guys know. So yeah, okay, you're going to get a little bit of benefits out of this. I can't fully remember 100% if things are even in free YouTube or they're in his private mentorship anymore because of the amount of information he's released this year. So I want to see what happens once price gets down here. Do we want to travel here Monday, Tuesday, continue higher, potentially? But again, I'm emphasizing what happens on the dollar. S&P 500. So last week, I said that we were likely to travel up into this daily volume imbalance, which I refined from the weekly volume imbalance. So between this blue line and this blue line, we can refine that to the daily volume imbalance, which is this like darker shaded blue. We stabbed into that on Tuesday, and then I said we're likely to find support with this accumulation block, the volume imbalance, the breaker, and the order block. And as you can see, we dipped into that nicely, found support. We pushed away and broke above Thursday's high. So do we need to go back and revisit this low and maybe fill in some of this buy side? Honestly, I'm not 100% sure. This accumulation block here, this accumulation block here, there's a lot of arrays around here for support price. Or we may just want to consolidate in this daily gap. This is why you tend to get consolidation. So we're going to build up sell-side liquidity below the market. We're going to tap into old areas of accumulation and then potentially continue higher. Now, this is obviously if we're going to end up getting a drop in the dollar index. We could just be coming up here and then just continue lower. We have a low resistance liquidity once we below the market still. Sometimes when you're in an area like this, it's hard to say. So you have to wait until we get out of this consolidation and let price dictate where we're likely to go next. Personally, I'm neutral at the minute. I want to see what happens once we break out of this range. Higher or lower is going to give me more context and something else to work with. So last week, I said we were likely to trade higher into that daily volume balance in the darker shaded blue. How we got there, we ran the previous high. So we took liquidity there. And then we ran the low, took liquidity. Ran the high, took liquidity. Ran the low, took liquidity. So what does this look like? It's a sequence row profile. We're just clearing liquidity above and below the market, so very difficult to trade in this environment. I took a position, I think, was it Monday, Tuesday? Can't remember. It's in here somewhere, and I just got hammered. So I took a full stop, and I realised that we're just likely to probably go up and down, so I wanted to wait until we got out of this range before I took any more positions, which I did on Friday. Interestingly, it's answering another question, so we can make it do this, but this was the opening price, and anything above the opening price is our Judas swing, right? So if we take the opening price, and we run a fib from the opening price to the highest body, right, so this last close candle, and we project deviations downwards, we almost nailed the very low of the week. I had a question about, and I touched on this in previous mentorship videos, about using the Judas swing as a calibration for deviations. Well, yeah, you can see that's a range of deviations, and we do get that. That almost nails the very low, so again, very accurate. But yes, this is an algorithmic signature, and you'll find that you can use that as a deviation range. Generally speaking, if you've got a longer wick like this, I'm going to just get rid of the wick and focus on the bodies, and more often than not, you're going to find that lines up better with previous arrays. Anyway, I'll leave that one for your studies. On Wednesday, we travelled higher and dug back into that daily gap, and then we dropped down, leaving this last down close candle as our breaker. So we had the high, low, high, high. On Thursday, we ran these highs, so we took our buy side liquidity, dug into that breaker, until these three consecutive close candles, so we had our order block. And then we travelled lower, down into that daily volume imbalance, and the daily order block open that I highlighted on the daily time frame. After coming into this area, we bounced higher. We left the fair value gap here that we trade back into, and we also traded back into this fair value gap, so we had a balanced price range. And we also had this order block, so the open of this order block, this is a reclaimed order block. Again, high level teaching. If we don't break the nearest term high, and price retraces back into an order block, that is fine, that's classed as a reclaimed order block. Obviously we have other arrays aligned here, so we have the balanced price range, we have this fair value gap, and we have this down close candle, so this is again another order block inside an order block. So a few arrays over here that supported price, obviously from this low to this high, we had an optimal trade entry, which sent us higher. On Friday, we open, we drop down, take sell side liquidity, then rally higher through the daily volume balance again, and clearing the buy side liquidity above this high, and then back into the order block and the breaker. And look closely. We cut through candles here. We're not supply and demand. If I had a dollar for every time he said that. We have this opening gap, right? So over here there was no wicks, no body, so this is a real gap. When we found some resistance on the discount end of that opening gap, and then as you can see, price dropped, just about clearing the sell side liquidity below this low. I'm going to take you into Friday's price action. I'm going to do a bit of teaching on this. Now, normally I don't trade Fridays, but because of the early part of the week was horrible and I took a loss on Tuesday, because why I traded the Friday for. I didn't take any screenshots, you're just going to have to take my word for it. So this is Friday's price action, right? So we have our 12 AM open price, and we have our close on Friday. Now, this red line delineates 8:30, and this red line delineates 9:30. Now, what did we do prior to 8:30, 9:30 opening? We opened here, we dropped down, we created a low today in London, and then we rallied higher. So overnight price action we've been going higher, right? And we come back up into that breaker on the hourly time frame. We run Thursday's high, so we run buy side liquidity, and into that opening gap. 8:30 opens, we go lower, run higher one more time into the opening gap, and then we drop and break market structure here, leaving this fair value gap. We also have this high, low, high, high, break low. So the last down close candle is our breaker inside of these three up close candles in our order block, and we had an old high. So many arrays nested in there with a structure break. At the same time this was happening, we see this higher high forming in the Dow, whereas the NAS we failed to make that high high, and we failed to make that high high in the S&P. So this was our S&P divergence with all the context behind us. Now we've dropped lower. This initiates our sell program. Once this happens, I'm looking at the initial consolidation, right? I'm looking at the sell side liquidity resting below that. Why? Because now I'm anticipating a market maker sell model. Okay, we ran the lows here, we ran the highs here, and then we broke through the consolidation on this candle. Return back to it there. For me, this is the initial consolidation, right? At 9:30, as we came back into Thursday's high, you see how the bodies respect that really nicely. We really sell off, we leave displacement, and we run this low, and we run this low, so the sell side liquidity resting below this. We come back up, and we have our distribution lock. So on the left side of the curve, so it comes our distribution lock, so the down close candles in here. The down close candles on the left side of the curve was previous areas of buying, right? So smart money is buying in the down close candles, and they're selling in the up close candles. So they're always diametrically opposed. That's how they do it. They're hedging, right? So they're buying here, and then they're mitigating and picking up new sell or short positions here, right? We have a little fair value gap, trade back up into the distribution block, and then we travel lower, clearing the sell side liquidity below this low, right? We leave displacement in the form of fair value gap. We have this last close candle over here before this down move. So we have our order block. As you can see, we find some resistance in that area, and price moves away, clearing out the sell side liquidity below this low. After running sell side liquidity, we have one more pop higher and run buy side liquidity above this high, and back into the order block and these down close candles. So our own distribution block, right? Once we're here, we mitigate, collect more sell positions, and then we run the sell side liquidity below this low and the sell side liquidity below this low. We just dip through that there, and then we move higher. With that being such a shallow run, I wouldn't be surprised if this attacks it one more time, but again, we'll have to wait and see what happens. If we take the low from this candle to not the high of these candles, the nearest higher time frame macro is going to be this opening gap, right? So we calibrate from the low to the opening gap because that's in really close proximity to the highs. Them highs are respecting that gap. They may wick through it slightly, but a lot of that is broker stuff, right? Pull a fib from this low to the opening gap, and we have deviations down. We get 39.42.5, right? I have the cursor hovering over this candle, so the very low of this candle comes in at 39.42.5, 39.42.5, so perfect. It isn't always as simple as taking lows to highs and projecting ranges and deviations or looking for optimal trade entries, and this all fits in with my IDR concept, and this all fits in with algorithmic structure, algorithmic order flow, and calibrating levels is something that you'll pick up with experience, right? It's a huge paradigm shift for you to move away from looking at candlesticks and start focusing on algorithmic price. Remember, IBDA has to target macros in its price, right? So these price levels are price macros that is programmed into the logic of how it operates. It's stored in its memory. We have to understand that the way the markets move is we're going to get deviations based on price and broker and all the other crap that goes on with the markets, which is why a lot of the time we're going to find, say, like how the body of this candle respects the high, because what is the high? The high is a premium array, right? It's programmed into the logic. And so where's the volume going to be? It takes some getting used to and looking at price the way it's supposed to be looked at as an algorithm, right? The candlesticks here realistically are a distraction. And once you start trading your eyes, you can start understanding where to anchor your fibs and where IBDA is likely going to derive its deviations from, right? I took a trade, I've forgotten where it was now, 1 second. I took this here, so I went from here. So I had a limit set at the low of this fair value gap, at the consequent encroachment, and at the high of it, and had very, very little drawdown, and I got out below this sell side liquidity over here. Yes, I know, I could have run it all the way down here. And I already did these projections to see how low it would go, but this deviation, it was very close to the daily volume balance, so that discount end, and it was also below the sell side liquidity. So I think I bagged like 12, 13 points, maybe a little bit more than that. So that was a good trade for me, and it more than made up for the loss I had earlier on in the week. You don't need a lot, you just have to be really selective, and you really have to wait, right? I waited until after 9:30 because I know that at 9:30 we're going to get a lot of injection, and it's going to be volatile. So once I seen this displacement and we ran sell side liquidity here, distribution block, order block, fair value gap, as soon as it comes into that, high frequency algorithms are absolutely hammering this. They sell, orders going straight into that. So I did the same thing, and that's essentially what we're learning here from ICT. It's interbank level trading. This one's loaded with a lot of information. It's packed with gems. So I hope you guys have really found this one insightful, and I'll catch you guys again next week. Alright folks, welcome back. Hope you guys enjoyed your weekend. Before we begin, I'd like to apologise if you can't hear me properly. I've got quite a bit of a sore throat going on. I've been just about out of bed this morning. If you guys have kids, you'll know what I'm talking about when they pick up every illness you can think of. And naturally they pass it on to you, so, part of being a parent, I guess. So right now we have the dollar index chart. It is a little bit busy at the minute. I'm going to go into the high time frame a little bit to help clear things up a little bit. But last week I said I wanted to see what price would do once we got to this balance price range. If we were to break above it, and then that would add to support and potentially send us into this volume balance. We've had buy side, we've had sell side. I like the idea of it coming higher to maybe touch the discount end before going lower. Now we're in between a higher time frame weekly fair value gap, 2 weekly fair value gaps. Generally when we're in an area of a higher time frame fair value gap, we're likely to see back and forward price action. So you might find this consolidates up and down. And again, based on the time of the year that we're in, this is likely to consolidate. We do have the sell side liquidity in the form of these relatively equal lows resting below the initial consolidation. So this is potentially a target for us. From the open of the order block to the low, we did go back above that 50% level into the balance price range. We haven't yet closed below the discount end of the weekly fair value gap, which is this black line. Again, I'll show you that in a second. What I am looking at is this rejection block. So the last down close in this range, I'm seeing if price wants to trade below that level. We also have this sell side liquidity, which sits above the rejection block, which I think we've actually tapped into today at the point of recording this lecture. This rejection block is key for me, and the reason being is we've already run buy side liquidity on euro, right? So this suggests an SMT divergence, and we've run the rejection block as well. I'm waiting to see if we can run the right rejection block on the dollar, and then see if we can see any SMT divergence really play out with a break in structure. Just because we've got SMT divergence on the euro versus the dollar doesn't necessarily mean from here that we're going to see a reversal. We have to have more framework behind us, but with this rejection block not being closed through, this suggests that we have a mixed market, and when we have that, we are likely to see consolidation. Price might make runs for either end, so we'll go for sell side and then buy side. And again, because we're sat resting between this weekly fair value gap and this weekly fair value gap, as you can see, price has consolidated for the last couple of weeks, and we failed to close below the discount end of this fair value gap. We're also inside of this last down close candle, so we have our order block over here with our fair value gap, so this becomes high probability order block. If we have to get below the fair value gap on a closing basis, because this is all looks pretty balanced if we do go below it, then obviously the sell side liquidity resting below this, which I think we've actually tapped into today. Then we have sell side liquidity resting below this low, and we have this fair value gap as well. So downside on the dollar, this for me is going to be the high time frame draw on liquidity. At the minute, I'm sitting in neutral. I don't really have a bias either one way or another at the minute. So during this time of the year, I tend to take it off, if I'm being honest. If I am trading, it's going to be really short-term scalps. We're in mixed market territory. There's a lot of divergence on a lot of asset classes, and a lot of things aren't moving in sync. I'm sure if you've gone through your charts, you probably feel the same way. That's not to say that we can't find moves. It's just for me, during this time of the year, we get low probability, sort of choppy price action. But we'll see what happens over the coming month. If you are to trade, really dial back quite a bit. Right now, I don't really have a case for high probability trading. In my opinion, I think during these next month or two, you really want to focus on your studying, enjoy the time, enjoy the holidays, review your performance throughout the year and where you can improve upon. I use this time for reflection, really, and just really try to collect data. I'm going through like my journal throughout the year to improve upon my model. So it's a good opportunity to do it. You're not missing a massive amount. When you're in low probability environments, capital preservation is key. For euro dollar, you can see last week we came into that fair value gap and we really reacted quite nicely from the discount low. From the order block close to the high, we came back below that 50%. And then we did rally. I think today we actually took out this candle's high, and then so far we're below this daily volume imbalance. If we stay below that volume imbalance, then that could send us lower to attack the sell side below this low, and maybe clearing this gap down here. Comes down to whether or not we're going to go higher or lower on the dollar index. Personally, I can't really make it out at the minute, so I'm just being honest. Coupled with that huge divergence that we're seeing between the euro and the dollar index, it's a very mixed market for me at the minute. Yeah, I wish I could give more information on it. Short term is all I'm really looking at. The key levels here, we have this fair value gap if we are to dip lower into there, and then this order block. So if we want to go lower, maybe find support from there. If we break down below the mean threshold of this candle, then potentially we have sell side liquidity resting above this weekly order block high with this fair value gap and the breaker. So there are targets to the downside. I want to see first if we can get above this daily volume imbalance, and that will obviously act as support and send us higher. At the minute, we seem to be in this little bit of a trading range, again typical of the time of year. Even in the S&P, so we consolidated around this volume imbalance and popped higher, closed above the daily gap and back into that weekly volume imbalance. I want to see if we can get above this weekly volume imbalance. From this range high to this range lower in a deep premium. If we are to get any more upside, then obviously the high above here to close in this weekly volume imbalance, or the daily volume imbalance, we've got the daily fair value gap still left open, and this volume imbalance order block, buy side liquidity above this high, sorry, I should say buy side liquidity. And then the volume imbalance sat above this buy side liquidity. We also have a mixed market in the index futures, where we failed to make a high on the S&P, and on the Dow we've run higher, again giving us signals as a mixed market. I do apologise, I should have had the slides up and I did screenshot it, but I'm not sure where it's on. That's something that you might want to look into your own charts. We could also potentially be an accumulation, manipulation, distribution profile. We can fill in some of this range if we end up getting lower, and we've got low resistance liquidity in this trend line. Because of inflation, because of the cost of living, people aren't spending as much money, and if that's the case, the stock market really shouldn't be rallying higher. So this could just be to build in a premium, build up a lot of sell side liquidity and then attack this lower. We've had 1, 2, 3 drives higher into a premium area. So again, you just want to tread with caution. I get asked all the time, when can we tell when we're in high probability or low probability conditions? The best way of telling is when we have mixed markets. If correlated asset classes are not moving in sync, and we're seeing a lot of SMT divergences between different asset classes, that usually indicates that we are in mixed market conditions, and that doesn't bode well for high probability trading conditions. And typically during this time of the year is when we really see it, and this is the reason why ICT generally takes these couple of months off. I've had quite again a few requests on gold. I still like these relative equal highs as a high time frame draw. We have moved higher from where we last were, and we brought market structure over here, dipped into this fair value gap on the weekly chart and into the order block, and we have retraced lower. So we have this mitigation block, this is the high, inside of this low, high, low, low, so we've got this breaker, the last up close candle, and we found support and rallied from there. Now, I like this low resistance liquidity run for the buy side to continue higher. The only thing I don't like is how clean this looks down here. So this could potentially be the initial consolidation and we run higher, because I got a feeling that a lot of people, because of inflation, are going to start piling the money into gold. But if I was making this market and I see this, this might just be getting everybody excited that, look, gold's going to go higher, and then we end up breaking down below these lows again. So honestly, I don't know. I keep getting asked, where's your money safe? Is it in gold? Is it in crypto? Honestly, I don't know. And I think this is a problem that many people are having, is they don't know where to put their money. If it's in a bank, inflation's eating it up. I don't really trust the crypto market at the minute. I think blockchain technology in itself has a lot of room to grow, and I still think it's in its infancy. So yes, over the coming years, I think we'll see a lot of innovation in that space. Whether it's the best place to put your money right now, I honestly don't know. I still feel like Bitcoin wants to go below 10k. ICT doesn't have any faith in it, but let's be honest, it's a bit of a dinosaur as well. So I'm not ruling out crypto completely. At the minute, I think with the whole FTX scandal and everything that's been going on, they definitely don't like crypto. By they, I mean the banks and the institutions. Of course, they want everything centralized. Decentralization is not their goal, and if I'm being perfectly honest, we can see that the algorithms work. So they control Bitcoin and crypto in itself. It's controlled and manipulated just the same way as everything else is. And I guess being ICT students, we have an inside understanding of the algorithms and how they work. So, like I said, this is not financial advice, and I don't want to advise anybody to say, look, where you should put your money. At the minute, I don't really trust anything. I wish I knew. Even ICT doesn't know what to do. So I do hold some gold, like physical gold, which I don't think is a bad idea. I've got stablecoin in USDC. I do have a little bit of crypto still. I've had dozens of questions about the same thing, so I thought I'd address it here. I'm not a financial advisor, and God forbid I ever gave you the wrong advice of where to put your money and it doesn't work out. So I'm humbled you guys asked me that question. I don't know myself, so I'm just going to be honest with you. But yeah, anyway. We have this dealing range high and this dealing range low. So we took out the low here, and then we took out this near-term high here. So within this range, we had half standard deviation, and we tapped that nicely, and we've come back into this area. Between this candle's low and this candle's high, we had the remainder of the fair value gap. We came into consequent encroachment of that fair value gap, lined up with all the other rays over here. So do we want to see a leg higher, potentially? If we do get back below this low, and long-term bullish ideas might have to be put on hold, I'd like to see this left open, and we continue and rally higher, attacking this buy-side liquidity. And how we run through these big figure levels over here is going to give me some indication of what gold wants to do. Are we looking to reach higher prices quickly? Is the algorithm in a hurry to reach those high prices? But I've had a few requests on gold lately, and I guess people are again wondering where to put the money. I still think that we're likely to go higher from where we are, but this is something that I wanted to highlight. It's very clean. A retailer can look at that and say, oh, that's strong support, and a lot of stocks resting below here if they think that gold is the saviour. And again, like I said, I'm not sure, so I just wanted to point that out. Even the S&P, so hourly chart, this is last week's price action. So from Sunday, Monday, Tuesday, Wednesday, Thursday, and Friday, and we have our daily levels. On Monday, we ran this low, creating the low of the week. Tuesday, we run this low into this order block. This order block is the last down close candle in this range, right? But this particular order block is the last down close candle that ran this sell side liquidity. So this is going to be a high probability order block with sell side liquidity resting above it, right? We dip into that. At the same time, we're seeing the NAS 100 going lower, whereas the Dow and the S&P failed to make that lower low. So this is SMT divergence at a support level, where we're already anticipating higher prices into that daily volume imbalance, with the framework of this daily volume imbalance and order block behind us. So we found support and moved from there, breaking market structure here. So when you align all that together, this SMT then becomes quite a strong valid SMT. On Tuesday, we break market structure here, and then we have order block fair value gap we dip into, and then rally higher, back into the daily gap. Again, at the same time, we've got that lower low made in the NAS, whereas the Dow and the S&P failed to make that lower low. On Wednesday, we consolidate and go into the seek and destroy profile, and then we find support in this fair value gap and run higher. And again, at the same time, we're making that lower low on the Dow, but failing to make that lower low on the S&P and the NAS 100. On Thursday, we make high of the week, and then dip down into this fair value gap, and then close the week. So classic buy week, we open up, we drop down, and then rally higher. So classic power of 3. So I'm going to do a little bit of bonus teaching, and again, this is a little bit more of an advanced level teaching. Again, it's not necessary for you to know this. I'm just showing you a little bit more algorithmic structure theory. So on Sunday, we open, we run higher, and then we begin a sell program all the way down into Monday's low that runs the sell side liquidity, right? So this was the initial high, and this is the initial low of that first sell program. 1.5 deviations higher, we get 40, 48, and 3/4. if I hover my cursor over this last put close candle, we get 40, 48 and 3/4, right? What else can you notice around these deviation levels? Pause the video for a second and have a look at what you can see around each of these deviation levels. At this low, if we go across, we have this fair value gap. At the 50% range, we have this gap, we have this fair value gap, or we've had a trade entry. At the premium end of the range, we have this fair value gap, order block, entry. 0.5 deviation, we have this fair value gap, entry. 1 deviation, we have this fair value gap, entry. 2 standard deviations, we get the very high. If you extend this one out, I think today you'll actually see that we have the opening gap in that area. And if you extend this one out in time, you'll find something else on today's price action. I'll leave that one to your studies. Like I said, this is not important for you to find profitability in these charts. So I get tons and tons of questions and people get overwhelmed when I start getting into this kind of detail. I'm merely just showing you and giving you little breadcrumbs so when you go into do your own research, you can start seeing levels yourself. And again, I'm just proving the point that there is a structure to the markets that is based on price, as opposed to market structure based on candlesticks, right? So with that said, I hope you guys found this insightful. Hopefully I haven't waffled too much in this. I feel terrible. Hopefully I'll see you guys again next week, and hopefully I'll feel a little bit better by then. So yeah, see you later.